services inflation that on average leaves us around 2%. So I think that's the world we're back in. We may actually see a little bit, especially during the holiday season, more of that pressure on the price level. So outright price declines in electronics and in big ticket items in particular. But they're coming from very, very high levels. So there is room to fall.
And Julia, just spinning that thought forward, of course, we're also at 10 a.m. getting those University of Michigan sentiment readings as well. And even though we've seen a bit of an uptick when it comes to some of these sentiment surveys, still at pretty depressed levels, taking a historical perspective. But if we did start to see retailers maybe lowering their prices, maybe on the good side, things getting a little bit less expensive, what would that mean from a sentiment standpoint?
Well, I think we would probably continue to see that sentiment recover. We have had this conundrum of low sentiment and, fantastic economic indicators. And, that disconnect seems to be a uniquely U.S. phenomenon. And, we can sort of wonder why that is the case. At the end of the day, though, consumers have been spending. So sentiment is always a very unreliable predictor of actual behavior. As long as consumers have jobs, they will spend. Exactly how much they spend and with how much they lean into the holidays, et cetera, is certainly up in the air still. But they are spending. Hiring is on track, so we still have that positive feedback loop. At least in the U.S. economy, there's more global weakness. Nike cited China. The UK numbers didn't look so great. So globally, there's a little bit more weakness. The U.S. has been the leading economy of this cycle and continues to be. We've been boosting our Q4 GDP tracking as the data come in yet again, and it still looks pretty solid.
Julia, as far as headwinds for next year, I am wondering about the potential for a weaker dollar, which is not what a lot of people have been expecting, but we've been seeing. Does that raise the specter of importing inflation, or not at least importing disinflation, which is essentially what's gone on with such a strong dollar?
Yeah, the dollar has certainly played a role in contributing to some of the easing in inflation that we've seen, but it's not the primary driver. I think the primary driver really is the normalization of supply chain operations globally, and that continues to look pretty good with the caveat of what we've been seeing in the Middle East. But overall, still a much smoother picture for goods flow. And commodity prices just, yes, dollar weakness could put some pressure, but, generally speaking, that was the dog that didn't bark in 2023, right? Everybody came in thinking China reopening, upward pressure on commodities. We're in a new regime of globalization that's going to be putting upward pressure on commodities. Just has not materialized. So input costs are subdued. Supply chain pressures are fine. So I don't really see a resurgence of goods inflation should the dollar weaken. The dollar weakening seems to me, I would think, to be mostly tied to expectations for easier Fed policy. And again, the Fed has some room. The Fed moves so aggressively, they have a little bit more room to cut than some of the other global central banks.
Julia Coronado, thank you so much, and Merry Christmas, Happy New Year. See you in the new year. Thank you for all of your contributions to surveillance. Julia Coronado of Macro Policy Perspectives. She's talking about the likelihood of actually killing the beast of inflation. And this is basically right now the consensus trade. The Bank of America Fund Manager survey that came out earlier this week showed that 62% of respondents expect bond yields to fall.
Mission accomplished. There you go.
Yeah, you buying it?
At least 62% of people are, if you think that's the trade.
And this is sort of going to be the key question as we wait for the data that comes out in less than 2 hours' time. Coming up, Javier Blas of Bloomberg Opinion on oil, especially with Angola leaving OPEC. What does that mean in terms of the integrity of the oil union? This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
We think on the margin commodity prices are likely to be rising from here, and there are a number of indicators to lead us to that conclusion. There are going to be a lot of geopolitical headlines in the coming year, whether it's elections or further issues or challenges around hotspots in the world, and commodities can help hedge against that.
That was Eric Knudsen of Neuberger Berman telling us why he expects commodity prices to rise despite some of the recent turmoil. Oil extending its biggest weekly gain in 2 months as Houthis escalate their attacks in the Red Sea. Angola, meanwhile, announcing its exit from OPEC, which has perhaps another significance. Javier Blas of Bloomberg Opinion saying the departure is more critical than it seems, writing, quote, "It makes it more likely that Riyadh will have to let the UAE produce even more oil over time. The risks for OPEC start in Luanda, but ultimately end up more dangerously in Abu Dhabi." Javier, I'm so pleased to say, is joining us now. I want to start there. This was a sort of significant move, considering that it has been a while since any kind of member state left the OPEC union. What was the reason for why, and why is it so pivotal?
Well, Angola has been having a fight with OPEC, and particularly Saudi Arabia, about how much oil Angola can produce in 2024. Angola has been struggling with meeting his own OPEC target level, and Saudi Arabia wanted to reduce those targets. At the end, there was a big fight on the last OPEC meeting. Angola said they was not going to recognize the new production targets introduced for the African country, and ultimately yesterday announced that it was leaving the cartel. At first sight, you say, well, this is not significant, this is irrelevant, because Angola is a very small producer within OPEC, and actually cannot really increase production, whether it's inside or outside the cartel. But I think that, to me, is more interesting what he says about the battles that are within OPEC, the internal battles, and particularly the battle between the United Arab Emirates and Saudi Arabia. The UAE wants to produce more oil, has been fighting an internal campaign to get a higher quota. It got his way a bit this year, and I think that they are not done, and I think that over time they're going to be trying to push for more production within the OPEC limits.
If you zoom out, this is sort of set against the backdrop of the United States pumping a record amount of oil, more than 13 million barrels a day. Their increase in production has really outstripped anything we've seen in recent history from the OPEC members, and this raises a question: have some of the cuts of Saudi Arabia essentially subsidized the U.S. shale industry and forced the union to lose some of its market share to the United States?
That has been happening. I mean, if you look at the production cuts implemented through the last year by Saudi Arabia unilaterally and OPEC in coordination among themselves, those cuts have served to boost prices, at times close to $100 a barrel, and that has been subsidizing the U.S. shale industry. And perhaps more dangerously for OPEC, one thing that has happened over the last year is that both the U.S. shale industry has been growing production, but it has been making money and rewarding shareholders. This is very different to what the shale industry was a few years back in that period of 2014, 2015, where it was growing production, but it was not making much money and certainly it was not paying the shareholders. Now it's doing both. It can grow production and it can pay shareholders. This is more sustainable. The longer than Saudi Arabia and OPEC keep prices where they are, about $75, $80 a barrel, the more the U.S. shale industry is going to be growing.
And some people have made the connection between what we've seen when it comes to U.S. shale production and what we saw in 2014. Of course, the last time we saw a big episode of U.S. shale production strength, you saw OPEC really flood the market with crude to try to gain back that market share. Is there any risk that we see a repeat this time around?
The market, Wall Street, is really very excited about this theory. They flush the market where Saudi Arabia in 2024 will increase production, bring prices down, and therefore regain control of the market, kill that growth in the shale industry. I don't see that happening yet. I think that the Saudis are still confident that their analysis of the market is right, that the demand is going to be strong, that the non-OPEC growth will slow down in 2024, and that therefore they will be able to start increasing production over time. That means the Saudi production, the OPEC production. But I think that it's very risky, and it really 2024 is going to be a make or break year. Either the Saudis are right on their analysis of the market and the slowdown in U.S. shale growth materialize, or therefore they have a problem, prices are too high, and therefore they need to change the strategy. We're going to see it, but I think that that doesn't come really until the second half of the year, second half of 2024, and I believe that the jury is out on what scenario is most likely to happen.
So a lot to keep an eye on in 2024. Let's talk a little bit more about OPEC membership, because you point out in your column that, of course, if you look past over the past couple of years, Indonesia, Qatar, Ecuador, all making the decision to leave OPEC, and of course, Angola just this week. Do you see more exits to come?
Potentially, we can see some exits. I mean, there are a number of countries within OPEC that one wonders what they are exactly doing there. I mean, but their production is insignificant in the global scheme. I mean, thinking about countries like Republic of Congo, of Equatorial Guinea, I don't think that they gain much from the membership. Perhaps more important, looking at the membership of the OPEC Plus group, that enlarged group of allies that work alongside Saudi Arabia. We saw Mexico participating initially and then taking more of an observer status, where it still participates on the meetings, but it doesn't take any production action. I will be keeping an eye perhaps on Kazakhstan, a country that has really struggled to meet with any production cuts mandated by the OPEC Plus group. But as I warn on my column, we have to be very careful about not really rushing the obituary of OPEC. I think that the three most dangerous words in the oil market, the three words that could get you completely wrong, is to say OPEC is dead. Don't say that yet. The death of OPEC has been really grossly exaggerated.
I love the three most dangerous words in oil is OPEC is dead. The three most dangerous words in investing is this time is different. I guess that's 4 words. But I'm just, Javier, looking forward, I am wondering if the conclusion maybe underpinning everything that you're saying is that even if OPEC doesn't fall apart, there is going to be a lot of pressure not to cut production too much, and thus that there's going to be a lot of supply that's going to pressure prices for the foreseeable future.
I think, to me, the focus into 2024 is supply. How much oil is coming from the United States? How much oil is coming from Brazil? How much oil is coming from Guyana? Also, keep an eye on how much oil is going to be coming from Canada next year. I am more concerned about the supply for a source of instability for oil prices than the demand. I know that a lot of people worried about global oil demand growth. I see that as doing fine. Probably we are going to get 1.1 million barrels a day extra in 2024. That is within the normal. That we are coming back to what historically was normal, 1 million barrels a day plus of incremental demand. That has been the average of the last 20 years. The increase in 2023 of more than 2 million was because of the recovery from COVID. We are back to normal, but I don't think that global oil demand is any way weakening significantly.
Javier Blas of Bloomberg Opinion, thank you so much for being with us. Always wonderful to get your perspective and some insight in what not to say. OPEC is dead. Let's not say that.
I'm going to put that on the naughty list. Do not say that.
Exactly. You know, I got to say, yesterday we were speaking with Frank Aquila of Sullivan Cromwell, and he was talking about the merger and acquisition backdrop. And he was talking about how the medical consolidation that he expected was significant. We're already seeing some of it. This just out from the Wall Street Journal, that Bristol Myers Squibb reached a deal to buy a neuroscience drug developer, Karuna Therapeutics, for $14 billion. This is basically Bristol paying $330 a share in cash for Karuna and his experimental schizophrenia drug, which is now up for U.S. governmental approval. I will just say, okay, you might say, I don't know any of those drugs. It's not Ozempic, so what's the bigger trend? Can we really get into it? But here's the thing. This is interesting to me because it goes to exactly what Frank was talking about, that essentially you need a bigger suite of drugs because any one of them needs to pull their weight at any given time, and the generic sort of cycle takes off the revenues pretty quickly. So you need a big pipeline, and the way to do it is consolidation. You are starting to see it after a year that basically has been somnolent when it comes to all M&A.
Exactly. Yeah, you think about that stat that we trotted out yesterday. Globally speaking, falling below that $3 trillion mark for the first time since 2013. It's going to be really interesting, of course, when we start to see consolidation in the medical space, in the energy space. We're starting to see that already, what that portends for 2024, especially if the Fed does actually cut rates in a meaningful way. It feels like that's been the holdup for a lot of different industries.
But it matters why they're cutting, right? I mean, again, this goes to this question, if they're cutting because people are feeling bad and the weakness is really
so maybe you band together, pool your resources and weather the storm.
Hug each other. Maybe that's what we're going to see next year. Kumbaya. Coming up next, Kumbaya with Ed Yardeni of Yardeni Research, who's been talking about the roaring 20s. He has gotten it right, at least for 2023. How about 2024 at a time where there are great expectations for immaculate disinflation? Right now, we are seeing not a lot of action to end the week. We're seeing basically a flat S&P. 10-year yields, 3.86%.
From a mining company, which frankly is dirty, it's big, now you want to reposition the company into green energy powerhouse. Are you a walking contradiction, or what did you learn along the way?
Well, in the early days, it was considered completely impossible for anyone. Doesn't matter if you're a huge company, like back then it was Anglo-American tried to break into the iron ore industry, and they spectacularly failed, even though that back then they were the largest mining company in the world. Now, for an upstart, a tiny little company with next to no cash at bank, no ground, no anything, for them to announce that they were going to break into the iron ore industry, the global seaborne iron industry, probably the most protected, viciously protected resources industry in the world, and then take them on head on, it was just considered impossible. It was just like a fairy tale. However, we stuck to the plan. We always tested each other by making sure that we were starting where we wanted to finish, which is as a major iron ore producer. And then we took all the steps back. We calculated what the steps would be, even though some of them seemed impossible. Now we have a strategy, and we've got to go flesh that strategy out and pursue it with single-minded focus.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation? Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
If the market goes too far on its own, then the question will be, what more does the Fed need to do?
The Fed is likely to cut next year, but every time the Fed announces cuts, the market doubles those cuts.
The reality is the Fed may get us to a hotter landing, but the markets have to adjust to that, and they haven't.
If the markets are rallying, that's okay with the Fed. The Fed doesn't have to push back on a rally because they don't like a rally.
I do think the Fed put us fairly back.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
90 minutes until the most important moment of the week. Good morning from New York City, worldwide. Welcome back. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, Lisa Abramowitz, Tom and John, both off today. Katie Greifeld, very much in. Thank you for being with us.
I was waiting for this call. I was thrilled to come back this morning.
All right. Well, I am so glad that you're here. It's always a wonderful thing. I'm curious what you're looking for in about 90 minutes when we get core PCE, the most important data point, arguably, of the week and heading into the end of the year.
Is it this continued march lower in inflation? What do we start to see here? Of course, when we heard from Jerome Powell last week, I thought one of the more interesting things he said is that he doesn't necessarily expect the last mile of inflation to be that difficult. And that had really been one of the themes of this year when you think about the economic community. We haven't really seen that so far, and in this last leg to 2%, at least Powell thinks it's going to be smooth sailing.
Really echoing what we heard from Treasury Secretary Janet Yellen just days before. What we're seeing right now is PCE, core PCE, is around 3.46%. Currently, the expectation is for it to come in at 3.3%, and that's down from a high in February of 2022 of 5.6%. So a big way. Can we get all the way down? And this comes along with this question of, okay, but does it come down with the ongoing strength that we continue to see in almost all of the indicators and earnings as well?
And does that really affect how people feel about this economy? I mean, this is one of the running themes that we've been talking about, is that people are still miserable. You've seen that in the sentiment surveys, even with a tick up, we're still historically depressed. And that's because the absolute level of prices, it's still super high.
Maybe it's just because we're all addicted to social media.
Yeah, exactly. We're all on TikTok.
Just looking at horrible images and trying to...
get in carpal tunnel.
Exactly. So it's a really good, wonderful, beautiful thing. Good morning. Anyway, taking a look at markets right now, we do see a little bit of just a range-bound stasis as we head into the end of the week. 47.95 S&P futures, basically flat. Euro dollar, to me, is really interesting. 110.27, up just a hair, but still eking over that 110 line to the highest level for the euro, the strongest euro versus the dollar going back to July. And this is not coming because of European strength. I think that that's important to note, and I want to sit on that for a second. Katie, this is in the expectation that the U.S. is going to cut rates even into strength, and that the European region is not going to, just simply because that has not been the rhetoric out of the central bankers.
Yeah, you've seen that divergence, at least when it comes to the rhetoric from the Fed, from the ECB. How long that's sustainable, maybe before the ECB has to bend to what the Fed is doing. That feels like the playbook that typically goes. But for at least right now, it's been to the benefit of the euro, the fact that you do have that gulf.
And meanwhile, what you are seeing in the U.S. is a real consensus trade that you are going to get inflation lower, that the last mile won't be that difficult, and that you see yields coming in, and 62% in the recent fund manager survey done by Bank of America found that they expect yields to go lower next year. And you're seeing that in price action today, about 3.86% on the 10-year. Here's what we're looking at for the day ahead. 8:30 a.m., personal income and personal spending, as well as drumbeat, the PCE core deflator. This, to me, is the key indication, considering that the Fed watches it and may hinge off of this disinflationary narrative to continue with their thoughts about rate cuts, whether they admit it or not. 10 a.m., new home sales, as well as University of Michigan sentiment survey that will also be getting forward-looking projections for inflation expectations. Does sentiment start to pick pick up. And Katie, you raised a really good point, which is sentiment has been very depressed. Do we see that start to shift, especially because oil prices are down? This tends to track pretty inversely with oil prices and gasoline prices, but also because if you take a look at the sort of mood, particularly with markets, it's making people feel a little bit more holiday spirits.
Yeah, it'll be interesting to see what that means for markets, for the economy when we do see sentiment pick up. Julia Coronado made the great point to us that it's been a really unreliable predictor of consumer behavior.
Which is the reason why, I guess, Jonathan Farrow tries to dismiss it. Today, the Treasury markets are closing at 2 p.m. because they got the message and are happy about the holidays. Stock traders can stay in their seats until 4 p.m. So we will figure out whether they will eventually get on board and close early as well. Joining us now is someone who's gotten it right all year. Ed Yardeni, president of Yardeni Research, who called for the roaring 20s, is leaning into that now, talking about disinflation. We're seeing it now. What keeps you up at night, Ed, considering that so far you've gotten a lot of things very right?
Well, I've been sleeping pretty well, quite honestly. I guess I do worry about the Middle East, the geopolitical situation, the fog of war. You never know how things unfold once a war starts. And we have this fairly contained, localized war in Gaza, and that the risk is that it becomes a regional war and it affects the price of oil. But so far, the price of oil has been telling me that there's not going to be a regional war going on here anytime soon.
So putting aside some of those tail risks, is the risk in your mind that people aren't bullish enough, considering that everyone's been upping their expectations for end of the year targets, but we're catching up to it really quick already, and it hasn't even been the end of the year?
Yeah, I think that's true. At the beginning of the year, I was talking about 4,600. That wasn't bullish enough. We're already above that for the end of this year. And then I'm looking for 5,400 next year, and now there's more people talking about over 5,000. And then for 2025, I'm talking about 6,000. So I think I'm bullish enough. I don't think things can get much better than that. So that's kind of at the top end of the scale on optimism, I think. But I think in the near term here, we've got everybody seems to be too happy, at least in terms of the sentiment indicators. So that's on a near-term basis. I don't lose any sleep over it, but I do watch it.
And with only, a week or so left until 2024, the fact that everyone is maybe too happy right now, is that why you haven't boosted your year-end target for this year? I believe that was at 4,600, and we're pretty firmly above that right now, Ed.
Yeah, well, I don't fine-tune my forecast that much because we are, as you said, we're only a week away, so what's the point of getting cute about it? Instead, I am talking about 5,400 by the end of next year and 6,000 after that. So that just puts me in the bullish camp. It's pretty clearly.
Yeah, if I, of course, had to put out these forecasts, I think I'd revise on December 30th every year and just nail it every single time. But I do want to talk a little bit about 2025 because 6,000 is a staggering number and 2025 feels very, very far away. What is the work that gets you there, and how do you project that with a certain degree of confidence?
Well, first, on a short-term basis, looks like there's still some what I call die-hard hardlanders who think that we're going to have a recession next year. I've been talking about a rolling recession for the past 2 years, and I think in the next 2 years we'll have rolling recoveries. Clearly, we're starting to see a rolling recovery in the housing market. I think we've bottomed in terms of retail merchandise. A lot of inventories piled up. Now I think consumers are going to go back next year and buy some goods in addition to services. And I think commercial real estate will be in a rolling recession in this coming year. But then beyond that, I think there will be a recovery. So I think that's the way I look at the business cycle, is sort of spread out. But most importantly, I think we've got a labor shortage, significant chronic labor shortage. And I think companies will use technology to increase productivity dramatically. Right now, we're averaging about 1.8% over the past 5 years. I think that by the end of the decade, we'll be looking at 3.5% to 4.5%, which sounds far-fetched, if not delusional, I admit. But that's the way productivity boom cycles have gone in the past. This one should do the same.
Does it worry you at all? And I realize that anecdotes can't tell entire stories, and you can't extrapolate out an entire research paper from one particular example. But let's take a look at Nike. They came out and they said that they're going to be cutting workers. They're going to be having cost cuts. And it is because, yes, they are working down their inventory, but because of weakness, and weakness that they expect to continue going forward. Does that kind of contradict some of your optimism about the recovery in the retail space?
Yeah. Well, that's a good point, and that's why I think a lot of forecasters missed the past couple of years and had this attitude that or view that the only way inflation could come down in the United States is if we have a recession. You mentioned the phrase immaculate disinflation, and I think that's what we've had. We've had inflation come down without a recession, and the reason for that is because the Chinese and the Europeans have done us a great favor. They've had the recession. So on a global basis, particularly China has been exporting deflation. Their PPI is down on a year-over-year basis. Even their CPI is down a little bit on a year-over-year basis. So I think the United States is going to benefit from the recession, the property depression in China for a long time in terms of having a low inflation. And I think Europe starts to recover from its shallow recession next year, which will help us on the export side.
And let's bring this conversation to the bond market, because the reversal that we've seen there has been stunning. And of course, you've done a lot of great work on deficits, what that means for bonds and the demand for bonds. And it felt like for a while, maybe the bond vigilantes were reappearing. Why did deficit concerns seem to fall off the radar?
Yeah, I've had the point of view for many years that I'll care about the deficit when the bond market cares about the deficit. In the past, supply really hasn't been much of a problem because you get the biggest supply in recessions when the Fed was cutting interest rates. We had this brief period where the bond vigilantes saddled up and started to move on concerns of fiscal excesses, and that period didn't last very long. Basically, from August to October, we saw this monstrous increase in the 10-year bond yield from basically 4.25% to 5%. And here we are back below 4%. I think, there's an expression, don't fight the Fed. Maybe we should also say don't fight Janet Yellen now that she's at Treasury, because she very cleverly cut back on the supply of long-term bonds and notes and issued a lot of bills. And the bond vigilante said, oh, if that's the way you're going to play the game, we can live with that. Meanwhile, I think the big story has been how inflation's come down. I mean, it's been only the past couple of months that the consensus really has become that we can't have immaculate disinflation. Even Fed Chair Powell in his press conference seemed to indicate that, you know what, we may actually get it.
And everybody let out a collective cheer, and you still hear that cheer today. Ed Yardeni of Yardeni Research, Merry Christmas, Happy New Year, have a wonderful, wonderful end of the year, and thank you so much for everything that you've been giving us through the year in terms of insights. I am just looking right now at the forward-looking expectations for inflation baked into Fed funds futures and baked into break-even rates. Break-even rates now, 2.13% when you look out 5 years forward, so between 5 and 10 years out from here. Shocking.
There you go. And of course, we're going to get a read on what consumers and actual people think about in terms of their inflation expectations. That's coming at 10 a.m. in that University of Michigan release. 1 year out and 5 to 10 years out. The 1 year inflation look ahead currently at 3.1%. That is the expectation, at least.
If you are just joining the program, we can see a little bit of a range-bound market, maybe a little negative inflection, but really nothing to write home about. 47.95 lower, just a touch, but basically flat on the S&P. Coming up at 8 a.m., we've got Joe Quinlan of Merrill and Bank of America Private Bank as we parse through some of the investing themes heading into 2024, what the consensus trade has been, what it will be. I honestly think that right now the consensus is that we're going to get disinflation. It's going to be steady. It's going to be accompanied maybe with some bumps. Those are all buyable bumps, evidently, because we heard everybody say buy the dip yesterday. And that we'll trod forward and somehow move to the next phase of the cycle with maybe a recession that's very shallow or no recession at all. That's the consensus that it feels like to me.
And it's pretty amazing. Again, you think about this time last year, it feels like everyone said that the recession is coming in 2023. Of course, some people were bandying about the idea of a soft landing, and then that turned into kind of a meme. Everyone was making fun of it, and here we are a year later, and it looks like a real possibility.
Which maybe is the reason why Kim Wallace of 22V Research maybe said the most interesting thing so far in terms of the lack of liquidity as the balance sheet keeps coming down, as some of the effects of some of the higher rates come through the system. Do we start to see liquidity issues, both on the public and on the private side?
Definitely one huge thing to watch. That balance sheet hasn't really made much of a bite yet. Maybe that changes in 2024.
Coming up, we're going to be speaking with Bloomberg's Michael Shepard in Washington on myriad issues going on both domestically and internationally. This is Bloomberg.
Was going to keep reading World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Countries together are committed to enabling Ukraine to stand on its own strongly, militarily, economically, democratically. That's why President Biden's supplemental budget request is so critical, and why we'll continue to work with Congress to pass it.
That was U.S. Secretary of State Antony Blinken speaking in Denmark as the two countries signed a defense cooperation agreement. Blinken highlighting the need for more Ukraine aid. This comes as the U.S. does announce some new sanctions on banks found to be facilitating payments for Russia's military-industrial complex. This, according to Bloomberg reporting, it's the latest move from the Biden administration to curb Vladimir Putin's ability to fund Russia's invasion of Ukraine. Michael joining us right now, Michael Shepard, executive editor, joining us now from Washington, D.C. I do want to get your sense about how much this move to sanction certain financial institutions is sort of a makeshift way to try to bridge the gap between Congress funding Ukraine in the new year.
Well, the timing of this certainly looks to be more than a coincidence. Congress left town earlier this week, as you noted, without passing this very critical funding package that the president had asked for back in October. It would have been $60 billion in new money to help fund Ukraine's war effort, and they just couldn't get it done. There were disputes over the border, and that has held it up until early next year. So where that has left Joe Biden is looking for another way to go after Russia and try to somehow slow Putin's role as he is gaining, if not ground in Ukraine itself, but at least gaining momentum.
Do you get the sense that there is enough critical mass to actually get some sort of additional aid passed for Ukraine in the new year, or is this going to really drag out beyond what Ukraine can handle in order to keep up their counteroffensive?
Well, that's a great question, because what we're seeing is lawmakers saying that they will take it up in the new year. Before leaving town, Chuck Schumer on Tuesday told reporters, including some of ours up on Capitol Hill, that it was just a difficult issue to get agreement on. And it's not just the Ukraine aid. The support remains high on Capitol Hill and in the American public. When you look at surveys taken nationally, they still support Ukraine's war effort. The trouble is, a number of lawmakers, including some Democrats, are wondering whether we need more border security and more needs to be done as a record number of migrants come here. So that has been the issue standing in the way. They will have to get this done when they come back the week of January 8th, with only 10 days before another big deadline where they have to enact a funding package to avoid a government shutdown.
And I definitely want to get to that government shutdown. But when it comes to the border, you mentioned that has been a hurdle when it comes to actually getting this Ukraine aid passed, despite broad support still. How high is that hurdle, though? When, of course, Congress comes back and this is back being debated, what does that compromise, what do those negotiations look like?
Well, part of it, Katie, right now boils down to who will blink first, in a way, and who will be willing to give some more ground. Republicans are sensing a political advantage right now. When you look at even Democratic cities like New York and Chicago and Los Angeles, they have been inundated with new arrivals, people seeking shelter, people seeking asylum, and it is costing those cities a lot of money. New York is reporting that it will incur a deficit of as much as $7 billion in the coming year. So the pressure is real, and the pressure is being applied to the Biden administration. Democrats, however, find that some of the Republican measures for now, the ones that they are calling for, are too restrictive and too harsh.
And of course, those discussions will be complicated if the government does indeed shut down. And when we think about the past year or so, it's been defined by these last-minute deals that averted at the last minute. Is that the playbook that we should be expecting this time around?
It's already last minute. By the time January 8th and 9th roll around, when the two chambers get back into town, they will have almost no time on the calendar to actually get one of these spending packages through. And that means they will have to put together something very quickly on the fly, and it runs the risk of upsetting some of the hardliners and new House speakers, Mike Johnson's Republican majority, and they will hold his feet to the fire. And if he doesn't meet their demands on spending or on social policy in one of these spending packages, he could be in trouble.
Meanwhile, we've been talking about Ukraine and some of the aid there. When it comes to Israel and aid for that country, how much is there a little bit more dissent within the president's own party as we head into the new year, and as the president's own ambassadors have been basically encouraging Israel to take a very different tact in the new year?
Well, that's right. On Israel, we are seeing the administration putting more pressure on Benjamin Netanyahu's government to ease up on the offensive it has been waging in Gaza since the attack in October by Hamas. What they are finding is that it has been heavy-handed and not targeted enough against Hamas officials, with far too many civilian casualties. The U.S. is backing now a resolution in the UN Security Council calling for a ceasefire, and this escalates and echoes calls by the administration directly with all this diplomacy we've seen from Anthony Blinken. Now, what that means for aid is that it's a reflection of misgivings, especially within Biden's Democratic Party, over giving additional aid to Israel at this time.
And I want to bring you a Quinnipiac University poll that I'm sure you saw, but I thought this was very interesting, that the poll found that support for sending financial aid to Israel to fund the war with Hamas is quickly deteriorating. In December, 45% of registered voters said that they want more aid for Israel. That is down from 54% last month. How does Biden, the presidential candidate, handle this issue?
Well, Katie, that's a great question. And when the Quinnipiac poll came out the other day, that was when we were looking at the results, that was one of the things that really stood out to us, that this could be an area of vulnerability for Biden within his own party. In other words, that may mean that voters are less enthusiastic about the president as they head to the polls in November, if this conflict and if those misgivings last that long. We are a long way from the election, of course.
A long way from the election. I'm sure it's pretty much all we're going to be talking about next year, though. So let's talk a little bit more about it right now. Of course, Donald Trump seems to be, of course, the GOP nominee. When do we start to see other GOP hopefuls start to drop out?
Well, the first big tests are coming up next month. On January 15th, we have the Republicans' first nominating contest in Iowa, and that will be a test of whether Trump's efforts there to score a decisive victory have paid off. He is really looking to put so much distance between him and the next two second-tier candidates, Nikki Haley and Ron DeSantis, that there is no way for them to catch back up. Nikki Haley, however, is gaining some ground in New Hampshire, which holds the nation's second nominating contest, the primary there on January 23rd. And what we could see is that if she keeps it close or somehow even pulls off an upset, that could change the state of the race a little bit heading into the third primary, and that's in her home state of South Carolina later in February.
Bloomberg's Michael Shepard, thank you so much, as always, and wonderful to see you. Have a wonderful new year and happy holidays. Coming up next, we've got Deborah Cunningham of Federated Hermes, but before we do, I've got to say, as I was thinking about the sort of political season next year, I don't know. I'm curious about which narrative is actually going to end up being the driving force, given that right now we're talking geopolitics, but almost always it comes back to the economy and to domestic issues. And it's going to be really a different scene potentially on that front.
Exactly. I mean, you think about the average American voter and its domestic concerns, the economy that really tend to trump most things there. So it'll be really fascinating to see. And of course, that conversation around third-party candidates, we didn't get to it with Michael. It happens every cycle, but it is especially happening this cycle when you think about the likes of course, Robert F. Kennedy Jr., et cetera. And when it comes to the GOP nominee, as Michael said, Nikki Haley has been gaining some ground.
Yeah, but still kind of dwarfed by Donald Trump. I do think it's interesting with Robert Kennedy. When I was looking at some of the poll numbers, he's pulling voters from both Trump and Biden, and it's a pretty significant critical mass. It's not a small amount of voters. That said, how much of this is really just protest voting? I mean, when you talk about the actual polls that are inconsequential, people can just sort of feel angry and express it. It's kind of what we've been seeing in other polls. It seems like there's a lot of anger out there right now.
Exactly. And when you're actually in the ballot box in November, I think that, of course, that's the only thing that matters. These polls at this point, a little less than a year out or so, how much do they actually portend for what the actual result will be?
We're getting a read on anger coming up today at 10 a.m. with the University of Michigan Sentiment Survey. Maybe people will be feeling a little bit less angry than they have been, or at least not very good. Right now, we're basically seeing a very quiet market, 47.96 unchanged in S&P futures. Euro dollar, to me, this is really interesting, crossing the 110 mark for the first time.
the reception, the acceptance of Puro Sangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro Sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So a 250,000 cars in a market where there are million and million of cars every year.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
60 minutes till the most important data point of the morning, core PCE deflator. That is the key metric. It sounds so exciting, but it's the key metric the Fed watches to understand where we are in inflation. In markets, it is a quiet day to start the week, or to end the week, I should say. It feels like we're ending the year right now. S&P futures and NASDAQ futures basically going nowhere. Russell 2000, a little bit of a lift, up almost 0.1%, which has basically been the way of the morning. In the bond space, you are seeing a bid. This, to me, has been the most consistent theme. And Katie, I really am watching this closely to understand, can we end the year 3.85% on the 10-year, bang in line with where we started it?
It would be really poetic, right? I mean, after all the turmoil, et cetera, that we saw this year, we were really obsessed with the deficit, for example, for a hot minute. To end right where we started would be pretty amazing. Not obviously the case when it comes to the equity market. Quite a rally.
The fact that the Bank of America Fund Manager survey that came out earlier this week showed that 62% of all fund managers surveyed said that they expect bond yields to fall. This is the consensus right now pretty much out there, and that's what you're seeing in the bond market.
Well, when do they start to migrate out the curve? Because we have $6 trillion or so sitting in money market funds, the very shortest dated paper. It could be an incredible move, or maybe they're happy with 4 to 5%.
It kind of depends on rate cuts, which is the reason why we're watching the euro versus the dollar. The euro strengthening to the most strongest that we've seen going back to July, crossing that 110 figure, 110.34 versus the dollar at a time where people are expecting the U.S., the Federal Reserve, to cut rates more aggressively, maybe, than the ECB, even though the ECB maybe has more reason to cut, given some of the more dismal data coming out of the region.
Yeah, and if you take a look at what the market expects, basically the same amount of rate cuts coming out from the ECB and the Fed, but they do expect the ECB to go first, or at least that was the balance when I checked a couple days ago.
Yeah, but it could shift given the fact that people seem to be kind of toggling between those two. Under surveillance this morning, core PCE due out in about an hour. A Bloomberg survey of economists predicting the index will fall to 3.3% in November from 3.5% the previous month. The data may bolster expectations of Fed rate cuts next year after data Thursday yesterday suggested the economy is cooling. We did see that revision downwards in terms of GDP, as well as that revision downward in terms of inflation for the third quarter. To me, my real question is, what's the balance of risks in markets, right? An upside surprise or a downside surprise? What would be the most disruptive right now, given how much disinflation and rate cuts have been priced in?
Well, it'll certainly be fun to watch the lines at 8:30 a.m. because it feels like everyone just rushed to one side of the boat. It's very heavy at this point, the positioning that's really been put on in the past 2 months. It picked up again last week. So the bar is pretty, low here for some sort of big move, especially when you think about it's December 25th. 22nd.
Exactly.
Keep checking that.
So just to make sure it's still December 22nd.
It is.
It still
indeed.
is?
Yeah.
Thank you for that check. All right. Elon Musk, meanwhile, blasting public markets, saying indexing has gone too far. His latest rant coming 3 years to the day since Tesla joined the S&P. In an interview with ARC's Kathy Wood, he said pressure from shareholders limits company efficiency. Musk said keeping SpaceX private has allowed him to take more appropriate risk compared with Tesla, and that he wouldn't recommend companies go public, quote, unless they really have to. He also, I believe, talked before about Twitter, about X, and how it's really nice that it's not public. I bet it is for him. I bet it is.
I would think so. And of course, this happened on an X Spaces. I don't know if you tuned in. I did not, but I saw a lot of the people I follow where there's actually some really interesting pieces in here. We know that Elon Musk doesn't love passive indexing. You know, he's made that point before, but the comments on staying private, of course, that's been helping him out with Twitter. But to go public, I mean, there's a lot of annoying homework that comes along with that. The fact that you have to basically give out your report card 4 times a year. Not every company would want to be in that position.
I love the offset, though. Then he said, but it did allow Tesla to access public funding, which is exactly the point of going public. So, I mean, to a certain degree, okay, how much is this griping about the fact that shareholders can be a pain in the butt, and how much is this basically that they have to be held accountable versus remaining private, taking a longer-term view? But he's not alone. Other people have a similar kind of feeling that if you can have a longer-term view, it's better than short-term kind of fixes for shareholders.
And I mean, think about the IPO market over the past 2 years. It seems like a lot of companies have really agreed with that logic and applied it to themselves, because we know there's companies in the pipeline that just don't want to come out yet.
Especially not at valuations that might be a little suppressed based on some of the volatility we've seen this year. Meanwhile, the FDA is seizing thousands of counterfeit units from Ozempic, I should say, from the U.S. drug supply chain. The regulator advising wholesalers, pharmacies, and healthcare practitioners to double-check the information on the products they've received, as they haven't been tested for quality or safety. Demand for the blockbuster weight loss treatment soaring in recent months. The manufacturer, Novo Nordisk, saying they expect shortages continuing next year into Europe. Off-market brand Ozempic that people are buying, they found that there were some side effects, but they were simply in line with other side effects from, you know, more on-brand kinds of things. Are there going to be people basically like going to alleyways? Do you have any Ozempic shots? I need an Ozempic shot.
I think it's happening. I mean, you listen to public discourse and everyone, it seems like, wants to get their hands on Ozempic, but they can't. Supply's really constrained. Not to make light of the situation, does fake Ozempic work? It has the same side effects. Does it have the same actual effects?
I mean, are we going to really end up basically advertising fake Ozempic? Because essentially, it does seem like it has a similar kind of side effect. But this raises this question about the barrier to entry and how much other companies are going to try to follow suit with similar types of drugs. We saw this from Eli Lilly. We saw this from others that are trying to get in, considering how hot the drug has been and how a lot of people are, you know, indicated for it.
Oh, yeah. I mean, it's basically a gold rush that's going on right now. It feels like a lot of these drug makers are trying to come up with their response to Ozempic, their own type of Ozempic, because, I mean, it's been one of the stories of 2023, that and artificial intelligence when it comes at least to the stock market.
So we can all be skinny and basically outsource our thinking to computers. Joining us now, Deborah Cunningham, Global Liquidity Market CIO at Federated Hermes. Not on that at all. Deborah, thank you so much for being with us. I want to start with this idea that people have been talking a lot about cash on the sidelines. And we've talked about this before and how cash on the sidelines are going to start flooding into risk assets. Have you seen any evidence of that over the past couple of weeks?
Not really, Lisa. It's not something, generally speaking, people at the end of the year are trying to, you know, kind of allocate and close out their books in a normal fashion. And there may be some surprises, either cash inflows or cash outflows, things close, things don't close that we're supposed to. But ultimately, it's not a great time in a normal situation for, you know, what I'd call reallocation. That happens more at the beginning of the year. So we have not been experiencing or seeing that type of market shift at this point and cash flow out.
Well, I do want to get to what happens at the start of next year and in 2024, but I know I just said that AI and Ozempic have been really the stock market stories of this year, but I want to add a third thing, which has been the rush into money market funds. Of course, one of the big stories in markets this year, about $6 trillion sitting in money market funds right now. Where is that coming from? Is that investors saying, look at these high yields, I'm going to go there? Or is that people moving away, taking money out of their bank deposits, for example, and shifting into money market funds?
I think the bulk of it is coming from the deposit market. It's coming in as a retail trade, so it's a pretty steady trade. And if you look at what shifted out of retail deposits during the year, it's been about 1.3 trillion, and about $1 trillion has gone into money market funds. So it's hard to follow dollar for dollar exactly where cash goes. But from all we can tell, I'd say at least 80% of that is coming from the retail deposit market, where rates from a banking perspective just didn't follow, short-term rates in the market upwards with the Fed. Now, there has been in the last quarter, just really since we flipped into the fourth quarter, October and November, a little bit more of a cash flow from an institutional type of customer. And I think that has to do with, the flattening to some degree inverted yield curve, where the shorter end of the curve is no longer as attractive necessarily as what a product that has some weighted average maturity like a money market fund does. So we're starting to see some of that trade. I would expect to see more of that trade, though, in 2024.
So just to meditate on that point a little bit longer, that potentially 80% of what we've seen come into money market funds has been coming from deposits. How sticky is that money? Because it feels like one of the assumptions is that what we're seeing in money market funds that belongs to the equity market, or that belongs to risk assets, and it's going to return there. But if that's coming from bank deposits, that logic doesn't quite make sense.
That's exactly right. And certainly there are some risk assets that are in there as a hiding place, a short-term home until they feel like, their entry point back into their risk asset class is more palatable for them. But that's certainly not the bulk of what we've been seeing. Now, maybe that, will pick up again in 2024, but it's not been what we've seen mostly in 2023. It's come through the deposit market, through the retail trade, with the likelihood of that being very sticky. And I think the other thing that makes that a stickier trade than it has been even over the course of the last 15 years is we, as well as the market, and I don't think anybody out there expects the Fed to normalize at zero, where they have been, 12 out of the last 15 years. The expectation is the normalization is back to, 3.5, maybe 4%, depending upon where inflation plays out. And so that, again, keeps that retail trade generally in the market rather than back in deposits.
So do you just sort of reject, Deborah, this idea of cash on the sidelines flooding into markets once the Federal Reserve has cut rates 1, 2, 3, or even more times next year?
No, I don't reject it at all. I just don't think it's all coming out of money market funds. I think cash continues to come out of deposit products, and I think some goes into the direct markets through that, from that mode. And I do believe there will be some that comes out of money market funds, but I certainly don't think it's it's the vast majority of what will, let's say, fuel the markets, the risk asset markets in 2024.
Just real quick here, Deborah, are you seeing money go out of short term and go into longer term? Is that a theme?
It started, we run micro short and ultra short funds that are really just, a modest step out the yield curve in the 1 to 2.5 year sector. And we're starting to see positive cash flow in those products, but it's trickling. It's certainly not any kind of a flood.
Deborah Cunningham, thank you so much for being with us. Merry Christmas, Happy Holidays, Happy New Year. Deborah Cunningham of Federated Hermes, we appreciate you being with us. And that's what we've been hearing from a lot of people, that yes, there is a lot of cash out there, but it's being put to work in short-term debt financing. If you are just joining the program, we can see markets aren't doing much today. It is sort of sleepy ahead of that really important indicator coming out in about 45 minutes time. S&P futures lower by less than 0.1%, 47.95. I will just say, did you catch this, Katie? In the Financial Times, they did an interview with outgoing Morgan Stanley CEO James Gorman, and he was saying that markets are really going to take off once the Fed starts cutting rates. He said the shock of the rate increase recently has put a damper on banking deals and capital markets deals, and that is because everybody doesn't really know what their cost of financing is. That changes if the Fed starts cutting rates.
And of course, it really depends what market you're talking about. Of course, that makes sense for deal making, that the Fed finally cutting rates, those financing costs coming down would see a big resurgence there. But the equity benchmark level, it really hasn't. I mean, it's already priced in at this point. It's going to be interesting to see what the catalysts in 2024 are. I would assume it's going to turn into how many cuts we actually get.
I love this from James Gorman, who just has days left as the CEO before he hands over his reign to Ted Pick. He said that the banking system had become much safer at his 14-year tenure, leaving, quote, their own stupidity as one of the biggest threats still facing banks, maybe a little tongue-in-cheek relative to some of the March turmoil.
So they'll find some way to make their lives difficult, it sounds like.
Didn't we see that in March? I mean, that was sort of part of the issue.
Yeah.
Was the mismatch in maturities and the deposit base and the consolidation of the deposit base in particular industries versus the duration of some of their assets.
And that, of course, has been a big boon for money market funds. It's all very full circle.
Exactly, especially since they're actually paying something, and banks still are not paying very much on their savings accounts. Coming up at 8:30 a.m., the key economic indicator of the day, plus Michael Gapin weighing in on that, of Bank of America's securities. Right now, a quiet market as we finish up one of the last weeks of 2023.
Thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Over the summer, we saw a dip down in airline traffic, and especially domestically, and we saw the domestic-focused airlines lose money. Heading into December, the numbers have come off a little bit. Maybe people are just waiting till later because Christmas is Monday versus middle of the week day. And so you're seeing people getting ready to travel rather than traveling.
That was Elaine Becker of TD Cowen on the state of travel this past summer. And of course, leading into the Christmas holiday on Monday and then New Year's Eve right after that, a lot of people going on vacation. And this is definitely a sort of personal issue for me where I'm always sort of girding for the worst. I've had a lot of horror stories over this particular break.
Yeah. I hope you weren't flying Southwest last year.
No, but I did once catch the last plane out of JFK before it was closed down due to a snowstorm.
Oh,
and then that was after being delayed for almost 24 hours with a 9-month-old. But nonetheless,
you got out.
I did get out, and it was a little bit traumatic. Okay, so this is where I really want to get a sense of where we are heading into this, what kinds of disruptions we can expect, how people are paying for their travel, whether they are traveling. Brian Kelly, founder of The Points Guy, who did advise that I get rid of my points and spend them. Thank you for that. I'm trying to work them down. What do you expect in terms of this particular holiday season? Are we going to see another Southwest episode? Are things looking like they're pretty orderly? Are people going to have a not really deeply uncomfortable experience?
Well, I'm an eternal optimist, and things are looking really good, right? So the Thanksgiving holiday in November, we saw the most amount of air travelers ever, 2.9 million go through the TSA, and things were pretty smooth. And the biggest factor that I see would be weather. And right now, there's no major weather patterns that I see that could upend our air travel system. So I am forecasting, hopefully, smooth sailing for the next 10 days. We had 2.5 million people through the TSA yesterday, relatively low delays and cancellations. So fingers crossed, but I think this is going to be a good holiday travel season and certainly much better than last year.
Especially given some of those delays. International, though, does face some potential headwinds, in particular some of the strikes that we've been hearing about in the United Kingdom, elsewhere in Europe. Is that on your radar at all, or is that basically just sort of hand-wringing as people have to find something to worry about if they're not eternal optimists like yourself?
Yeah, no, anytime you travel to Europe, you have to worry about, strikes. They can happen any day. It's much different here than the U.S. But, in Spain, there will be strikes with Iberia's ground staff around the New Year holiday. Yesterday, we saw the Eurostar have a surprise strike that displaced a lot of people. They're actually not even selling trains today between Paris and London. But overall, there might be some German train strikers here or there, but hopefully no widespread strikes that we're aware of.
And so how should travelers think about that? Say that they do have a holiday European vacation booked. I mean, should they be thinking about insurance here, or how to best handle that?
Yeah, so what most people don't realize is when you use your premium travel credit card, as I'm assuming many people watching this program do, whether that's Amex Platinum, Chase Sapphire, Capital One Venture, those cards come with built-in perks. And this is what people don't realize. I was traveling to Puerto Rico in May, and my flight was delayed like 10 hours by United for a mechanical reason. United gave me a $100 e-gift card and told me to go away. But American Express refunded $500 for me to get a hotel, to get Ubers, to go out to dinner in Old San Juan. So always go to your credit card company for compensation. And when traveling to Europe, there's a rule called EU 261 compensation. And if you're traveling to or from Europe, and there's a flight delay for pretty much any reason, they are mandated by the government to give you compensation. Yes, go to the airline, but generally the airlines are pretty cheap when it comes to compensation. Your credit card is where it's at. The only time I really recommend travel insurance is if you're going on that mega trip on a big expensive cruise line, safari, you're bringing, people who could get sick abroad where you might need that evacuation coverage. But in general, your credit cards protect you a lot more than you realize.
Yeah, so maybe you actually should read the fine print there. But what are you actually seeing in terms of where people are going when it comes to this holiday season? Are they going abroad, or is much of the travel that you're seeing booked and happening right now within the country?
Yeah, I mean, most of the travel growth we're seeing is international. It's funny, I was looking up, where are the deals for, I was just searching from New York, and the best travel deals were Miami, Orlando. And a year or 2 years ago, we all knew Miami flights were like $2,000 each, crazy rates. So we've seen some of that demand from domestic travel now. We're seeing huge increases. United Airlines just started flying nonstop from San Francisco to Christchurch, New Zealand. They're betting big on the Pacific region, new flights to Tahiti. And so I think there are a lot of travelers who now feel comfortable traveling internationally, doing that big trip. Japan, I'm going there in February. We're seeing huge increases in that type of travel. And also when it comes to lodging, we're seeing a huge increase. Hotels.com saw 125% increase in authentic lodging. So whether that's a ryokan in Japan or staying at a riad in Morocco, I think travelers are sick of paying for overpriced cookie cutter hotels and are willing to shell out for those luxury experiences.
Are they looking for discounts, or is this still very much the experience world that's just continuing? And is this basically a sea change that has legs, where experiences will keep seeing people pay up for some of these unique experiences, even if they don't buy a shirt and an outfit that's fancy to accompany it?
Yeah, people, funny enough, discounts are happening domestically. JetBlue just ran a $50 off fare sale, Southwest. So the domestic airfare market and those carriers are struggling, where the premium cruise lines that are just launching, there's tons of new, really exclusive ships. I just did expedition cruising is huge. I'm seeing more and more of my friends go to Antarctica. I just went on Swan Hellenic to Greenland, and that was an incredible experience. So yeah, people are shelling out for unique, bespoke experiences. That sector of the market cannot grow fast enough. And even, domestically, theme park travel's big. Disney still continues to see growth. And it's not just Disney. Dollywood just increased prices and opened up new parts of their park, Mattel. So people really want to take their families, not just to a beach vacation, but they want to go and experience the new Mattel theme park that just opened up in Arizona. They really want these unique experiences, and that's a trend I can foresee happening more and more.
And Brian, you are the points guy, so let's talk about some news that broke this week. It was first reported by Reuters, basically about the Department of Transportation in the early stages of looking into airline frequent flyer programs, really checking whether airlines have engaged in unfair or deceptive practices when it comes to some of those programs. What do you make of that?
Yeah, I think it's much needed. A lot of times there are changes that happen overnight. And, it can be said that the airlines are banks nowadays. The airlines are making more money selling their currencies of frequent flyer programs to banks. So I do think there needs to be a little bit more consumer heads up, right? If you're going to have this multi-billion-dollar loyalty program that essentially is a bank where, you're creating your own currency, you should give consumers notice when making negative changes. We saw this year Delta and American Express rolled out some pretty punitive changes to their credit cards, increasing fees, et cetera. And there was huge consumer backlash to mostly Delta on that one. And we saw them roll back some of their changes. Now, do I think the government needs to come in and regulate every aspect of loyalty programs? Probably not. But having some more consumer protections when those negative changes happens, I think are a good thing for everyone involved, because people are getting sick of just constantly changing and moving of the goalposts.
And waiting in line at the lounge. That might be part of the issue. Yeah, Brian Kelly, thank you so much for being with us. Brian Kelly of The Points Guy, thank you. As always, as we all envy his life in having all these bespoke experiences in Iceland and with his friends.
I want to go to Japan. That sounds really nice. He said he was going there in February.
Yeah, you're going to try to join along.
I was going to go to the Olympics in Tokyo, and then COVID happened, so it didn't work out for me. Never been to Japan.
Well, this is something that is sort of indicative of where we're at, because a lot of people, I guess, are looking for some of those experiences more. Coming up next, we've got Joe Quinlan of Merrill and Bank of America Private Bank, looking toward that key indicator coming out in about 35 minutes' time, core PCE, the core PCE deflator, that indicator that the Fed looks at, the balance of risks right now. And this is something we've been talking about. Is it that if we get an upside surprise that raises questions about disinflation, or is it a downside surprise turbocharges people's conviction in the trade that's already been happening?
Well, you think about the potential of an upside surprise, and the conversation we had with Marvin Lowe at 6 a.m. this morning, saying that it's a credibility issue for the Fed, that if they are going to cut, they do not want to hike again.
Meanwhile, in markets, we see basically not a lot of activity. Why would we, given the fact that there isn't that much going on, and potentially things could be upended in about 35 minutes' time. The euro gaining versus the dollar, 110.19.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Really hard to find that person who's very bearish.
I think the bullishness is probably has a wider window to perform in going into 2024.
24 is going to be a surprisingly good year for the market.
I think we're going to feel a little bit pressure on the big caps coming into the new year.
The risk is the recession that the market is expecting doesn't happen.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The great hope comes in 30 minutes time. Good morning. Welcome to Surveillance. This is a Bloomberg Surveillance. Jonathan Farrow, Tom Keene, Lisa Abramowitz. John and Tom are both off today. Katie Greifeld very much here. We are 30 minutes away from that core PCE data that really is the key inflation metric that the Fed looks at a time of incredible hope built on this disinflation narrative.
Absolutely. And you look at some measures, as Julia Coronado was telling us earlier, if you really torture the data on some measures, we're already back to 2%, that Fed's target, of course. But of course, when it comes to the headline numbers, et cetera, not quite there, but we've come a long way pretty quickly.
And yesterday, people were picking up the fact that in the third revision of third quarter GDP, it sounds pretty esoteric. However, within that, we saw the GDP price index actually revised lower at 3.3% versus 3.6%. And core PCE, this was core price PCE, came in quarter over quarter at 2.0% from the expectation inflation of 2.3%. So already hitting that target at a time when people already had this enthusiasm. Could we see more of the same today?
Exactly. And how much is the risk that we do see too much of a good thing? Of course, the Fed has been very successful in engineering inflation down a lot more quickly than perhaps they expected, than the markets expected, certainly. And then, of course, you think about the bearish case becomes, okay, maybe they get a little bit over their skis here and we do come down much further than we thought.
Or it's because of growth concerns, right? And that's the other side of it, which is the reason why people were focusing on Nike coming out overnight, basically saying that they're expecting to take $2 billion of cost cuts and make that through cutting jobs, through cutting other expenses. The latest quarter, they were talking about a $400 to $450 million charge, largely due to severance expenses. You're seeing those shares lower by about 12%, bouncing around. Not a lot of liquidity pre-market, now down 11%. We're seeing a kind of commensurate move in Foot Locker, in Adidas, in Puma, in a whole host of other retailers. And again, this sort of goes to the core of, is there more weakness under the surface that we heard about from the likes of Patrick Harker, and that kind of we're hearing other Fed officials nod to as well?
And it's interesting in terms of signposting where we are in the cycle, because you think back a year ago, I think it was when you had all those big tech companies cutting jobs and getting rewarded in the stock market. Shareholders really wanted to see that cost-cutting discipline when it came to the business. Of course, now we're in a different part where people are worried about that slowdown, and this is just bad news.
Not that worried, though, if we talk to Ed Yardeni, considering that he's sort of like, yeah, I guess that it doesn't really keep me up at night. I kind of sleep pretty well. Right now in markets, not doing that much. And why should they? It's been already an incredibly volatile couple of weeks, a couple of months, and what we're seeing right now is a lack of action ahead of a key metric on inflation, 47.96 right now on S&P futures. Euro 110.23 versus the dollar, crossing that mark to the highest, strongest levels, I should say, going back to July. 10-year yields, 385. To me, this is just a shocking story of a round trip. And Katie, I love how you put it, basically pointing to the fact that we're ending the year right where we started it, but it hasn't felt that way.
No, not at all. Again, I feel like the summer felt like a year in and of itself. Of course, that big trip up to 5% that we took on 10-year yields. Certainly everyone was worried about the deficit. They were worried about Treasury supply, just the supply of bonds coming to market. And just quietly, all of those fears were quieted.
And it comes at a time of some shifting winds from the Treasury Department, from the U.S. government, as well as on the expectation of disinflation. Joining us now, I'm so pleased to say, Joe Quinlan, head of CIO Market Strategy at Merrill and Bank of America Private Bank. Joe, thank you so much for being with us. I want to start with just how much you've changed your view going into 2024 on the heels of the great Fed pivot.
Well, Lisa, I mean, I was more constructive on the market before the Fed pivot, and I'm a little concerned talking to our clients about how optimistic they're becoming. So you've seen the great run up since November. So we're still cautious and constructive on the markets in 2024 for sure, but maybe we pulled forward into 23 some of the gains in 24, but we'll see. We still see a good economy, good earnings, and more upside as we go deeper into next year.
What makes you concerned, Joe, considering the fact that we don't necessarily have the risk of the Fed staying overly hawkish for a prolonged period of time, and we don't necessarily have signs that the economy is really slowing down much?
Well, Lisa, that latter point is key in terms of the inflation outlook. You know, inflation expectations have come down, but maybe we have an economy that just has a mind of its own, keeps plowing ahead, more consumer spending, keep the unemployment rate under 4%. We could revisit this idea that the Fed is going to pivot and cut and maybe just go back on pause, and that could be a head fake for the market. But in general, this economy continues to surprise on the upside, and that keeps that inflation play out there. And you talked about it earlier. The last mile, the 2%, you know, how adamant is the Fed going to be to get there, and how hard is it going to be? I think it's going to be harder than Jay Powell thinks.
And Joe, I want to talk about how you position a portfolio against that backdrop, because I'm taking a look at your notes right now, and I see that your sector preference is for energy and it's for healthcare. Of course, two sectors that are in the red this year. Of course, energy after two awesome years. You think about double digits gains. Healthcare had a rough year last year as well. When it comes to that preference, is that just as simple as buying the laggards of this market?
Not really, Katie, in the sense that, healthcare has some value given the pullback. Energy we like, commodities, hard assets, hard power, because I think something the market is not really focused in on is the geopolitical risks that are out there, whether it's Europe, the Middle East, Asia. If something springs up and we have this bolt out of the blue, you want to be more defensive, more hard assets, U.S. centric. We're seeing a lot of money come from overseas into the U.S. assets, so we're playing more defense. But I do think as this economy proves resilient on the upside, we're going to lean more into cyclicals as we go deeper into 2024 as well, whether it's industrials, materials, financials. That's going to give a better breadth for the market as we go deeper into next year.
Well, let's talk about those hard assets a little bit more, because, of course, you talk about crude, and the conversation has been this incredible non-reaction to all of the geopolitical issues in the world right now. Which specific commodities are you looking at when you say own hard assets?
Copper, nickel, cobalt, some of these EV, the renewable sector in that sense. Energy, Katie, you nailed it in the sense that, the market response to what's happening in the Middle East has been pretty interesting with the oils. But remember, the U.S., a lot of people don't realize we're the largest oil producer in the world, 13 million barrels a day. That's 2.5 times what we did, say, 2005. So, our energy sector is very, very dynamic. It's a global leader. A lot of demand for our products in Europe and Asia. So we think long term that is a nice place to be, and you get the dividends, you get the share buybacks, and you get the upside and the hedge from any geopolitical risks.
At this moment, we're talking about a next year that is possibly going to look a lot like the one that some people expected for this year. I am curious about your view on U.S. assets. You do prefer U.S. assets over international ones, as at a time where we're starting to see some weakness in the dollar. Does that concern you? Do you think that that's going to be short-lived? Do you think that the dollar is going to strengthen again as you start to see some of the other nations and for the European Union kind of be forced into cutting rates?
Well, Lisa, when we talk about the dollar, I mean, to me, let it slide a little bit here against the euro, some other major currencies, because it'll be very good, beneficial for the big cap, large cap multinationals here in the United States. So, I'm not really worried about that just now. And, we look very carefully at the emerging markets. I mean, China has had a rough 2023. So does that mean it's better set up for 2024? We'll see. We debate that a lot. In Europe, it's more scattered shot. You want to buy the luxury brand leaders, some of the renewables later down the pipeline, insurance companies, life science companies out of Switzerland. But I hate to say this, but like when it comes to the dynamic nature of earnings, growth, innovation, all roads still lead to the U.S. So that's our core. When we build portfolios, that's where we start. That's where our core is, and then we go out and look at other parts of the international markets and more sector-specific and/or momentum.
Well, Joe, let's stay on the U.S. and let's talk about the U.S. bond market, because Lisa and I have been marveling at all morning. You take a look at the 10-year Treasury yield. It has been a round trip in 2023, a rocky one at that. How are you thinking about the bond market and the level of 10-year yields right now? Are we around fair value, or is this an overbought market?
Great question, Katie, and it's something we talk a lot about with our clients and internally as well. The round trip has been quite dramatic here. Shorter duration, but that 60-40 traditional portfolio, that's been more of a conversation as well with clients. But here, when it comes to kind of the bond market or money markets in general, we're starting to see for the first time clients want to get out of the money markets. I mean, they're actually having that conversation, say, hey, we should be more in equities. How should we position? So I think one of the key messaging that we're seeing with our clients is like, okay, we've got this excess cash. We want to get back in equities. How do we do it? So I do think that $6 trillion in money market funds, that's going to be fodder for fixed income and high quality, shorter durations, and equities over the balance of 2024.
Joe Quinlan of Maryland Bank of America Private Bank, thank you so much for being with us. Happy holidays as you head into the new year. Right now, we're not seeing that much reaction in markets, but to me, this sort of caution around the edges seems interesting. And this is the reason why. If we get a downside surprise, is that going to be more of some kind of impact on markets, downside surprise to the core PCE, rather than an upside surprise, in the sense that there isn't enough bullishness. I mean, that sounds crazy, especially coming from someone who tries to find the skepticism in the narrative. But that seems to be something that's just kind of percolating out there.
Yeah, there still feels like this skepticism to this rally, even though we have seen the broadening out that a lot of people said that they wanted to see before they really felt good about this market. We've certainly seen that, but then you think about all the money in money market funds, at least a good portion of that is a safety bid. And then you think about gold, for example. I mean, gold hit a record high and feels like no one really talked about it. That coming just in the past couple of weeks. So there's still a bid for havens out there, even with this big rally that we're seeing.
No one talked about it because how do you understand gold?
Yeah, I know.
When do you ever get the narrative right with gold? I'm not talking about
I think
you
it's
personally.
physical Bitcoin.
I mean, stop, you're trolling half the audience right now.
It's like Bitcoin, but shiny, I think.
If you're just joining the program, the S&P is basically flat right now. We're looking at just below 4,800, 47.96. Really, Katie? You're really going to do that? Is that basically your pitch for the Crypto Tuesdays?
I think I'm more than half joking, but I will say when people started describing Bitcoin as digital gold, it did start to make a little bit more sense why people were so obsessed with it. So,
but it also took some of the volume away from it. I don't know. I feel like gold is one of those things that the gold bugs kind of wake up every time there's some sort of threat, and sometimes it works and sometimes it doesn't. So I don't know. It's been a really hard one to really wrap my head around.
I like to think about the psychology of different asset classes. You know, bond traders, they're classically pessimistic. You know, they're very doom and gloom. That, of course, is the stereotype. But then you think about gold bugs, and it's totally different. You know, then you start to get into some conspiracy theories, and I found that really fun.
Yeah, sort of like the Armageddon trade.
Yes.
Right now, one thing that's not the Armageddon trade, I thought this story was interesting. Tesla's designer came out and said that the Cybertruck's design kind of gives it an edge because it makes it kind of funky.
I was thinking maybe a literal edge because it looks like if you sort of brush past it, you might get a scrape or something.
Which makes me think that probably if you parked it in New York City on the sidewalk or on the street.
Can you drive it over the bridge? They're so heavy.
Have you ever driven one?
No, I would love to. I think they're hysterical.
Hysterical is maybe not what they're going for. Coming up, I do want to say on Bloomberg Television and radio at 11:40 a.m., don't miss this, a really important conversation. Leah Brainerd, Director of the Council of Economic Advisors, joining Bloomberg Television to give her outlook on the economy, on the budget, on inflation, and of course, some of the latest comments also having to do around U.S. Steel and its acquisition by Nippon. From New York, this is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Likely to test Western red lines, but they're not going to seek a a catastrophic response from the coalition. Remember that we now have hundreds of missiles, hundreds of air defense missiles with an extraordinary array of naval capacity around Yemen. But inevitably, the Houthis are going to seek to test our fortitude.
That was former senior U.S. intelligence official Norman Rule speaking with us yesterday, as we do have this ongoing impasse between Houthi militants that vow to continue attacking container ships and world trade as long as they can in the Red Sea, which does, of course, lead to some key shipping routes that account for 12% of global trade. Welcome back. We are looking at markets that are very quiet ahead of a key data indicator, core PCE deflator, that comes out in about 13 minutes' time. S&P futures kind of nudging into the green. Again, basically unchanged, 47.97. Euro versus the dollar, 110.24. Yields lower on the day, and this comes after yesterday's gauge came in softer than expected from the third quarter revision. The third revisions of the third quarter GDP. It sounds sort of esoteric, and yet some people were saying this is the reason why markets moved, and you're seeing oil prices just a bit higher. But to me, honestly, everyone's been talking about the potential headwinds for next year. One of them is, what if oil prices go up in response to the conflict with Israel and Hamas war, as well as Ukraine-Russia war? And then there's this issue now of some of the potential blockages in a key shipping route that doesn't seem to have an easy solution.
Absolutely. We're talking about supply chains once again. Of course, you would hope that some of these companies, some of these shippers would be better prepared for this. But of course, after what we saw in the pandemic, but still some big implications when you think about the state of the flow of goods around the world.
So just to get a state of play and understand kind of what the potential risk scenario is and, how this might get resolved. Nick Wadhams is joining us now. He leads Bloomberg's national security team. Nick, can we just start with the state of play? We've already heard the Houthis vow to continue the attacks. We've learned of a coalition of allies to try to prevent it. What's actually going on the ground at this moment?
Well, in the last 24 hours or so, there has been a real sort of quieting down. We haven't seen any more Houthi strikes against shipping. That's in part, of course, because so many ships have diverted to go around the southern tip of Africa. So but the big question is the U.S. is in the process of pulling together this maritime coalition whose whole purpose is to essentially protect ships passing through the Red Sea. And the question is whether that's going to be good enough. Are we going to start to see ships deciding to route back through despite the potential danger from the Houthis? Because, again, though they haven't attacked, they've given no sign that they plan to let up when they see those ships again. So that's really what we're looking for, some statement of confidence or intent that would signal shippers are willing to go back through the Red Sea once again.
And so far, that's not happening, with hundreds of merchant ships being rerouted away from the Suez Canal into much lengthier passages to avoid this threat. Nick, there was a story in the New York Times that caught my attention about the potential for the U.S. starting to sell arms once again to Riyadh, to Saudi Arabia, and this being a potential kind of you scratch my back, I scratch yours for their assistance in trying to help negotiate with the Houthi militants. Do we have any sense of where the negotiating chips are to get more Middle East partners on board with that?
Well, it's a great question, and it's such a complicated dynamic. But essentially, look, I mean, you have a situation where there is a ceasefire, however tentative, between Saudi Arabia and the Houthis in Yemen. So the U.S. may be looking to reward Saudi Arabia for the fact that ceasefire is, to some extent, holding, saying, okay, we will send you these offensive weapons again, sort of on the condition that you don't really use them against the Houthis at the moment. But certainly, I mean, Saudi Arabia is just so central to all the U.S. plans in the region. I mean, the continued hopes for normalization talks with Israel, obviously, conversations on what happens next in Gaza, efforts to get the Palestinians on board. I mean, they just need Saudi Arabia for basically every major strategic initiative they have in the region. So this is sort of a nice little carrot for the Saudi government saying, listen, we appreciate your support. We're going to need a lot more of it in the months ahead. So here's a little something you can have that you so desperately want.
Well, Nick, that's where I wanted to go. You mentioned the importance here of Saudi Arabia. How worried is the administration at this point that this could spill into a broader regional conflict?
Well, I mean, that is essentially what they say is their overriding concern. So obviously there's the fate of the hostages and the civilian casualties and the concerns about how Israel prosecutes the war in Gaza, but the bigger fear there really for the U.S. is, okay, how do we keep this thing from spreading? You have Hezbollah in Lebanon. You obviously have the Houthis, both backed by Iran. And the U.S. is very, very concerned that this thing will spread even further. Obviously, Saudi Arabia, again, completely instrumental, essential to U.S. plans to tamp things down. Maybe there are some back-channel conversations that are able to be had with Iran. There's also influence that Saudi Arabia can exert on other players that can in turn influence Iran. So, you know, again, it's just, it's all part of this U.S. effort to keep things relatively calm. And the real feeling is that they are not sure how to do it. Again, you get back to that Houthi issue and the fear that more Houthi attacks really could pull the U.S. into a broader conflict.
Well, Nick, to that point, Bloomberg News reported this week that the U.S. is considering military strikes against Houthi bases. What's the latest there on the idea that maybe the U.S. could shift from just deterrence to actually going on the offense here?
Well, what we're going to have to see there is what happens when ships start routing through the Red Sea again, and what sort of intelligence the U.S. is gathering about Houthi intentions, because everything that's been done so far has been, as you say, deterrence, defensive. So they're shooting down drones, they're trying to stop the attacks, but they're not hitting the Houthis at the source. They're not going after those drones and ballistic missiles in Yemen itself. And obviously doing so would represent a massive escalation and, again, feed those fears of a broader war. But there is some talk within the administration that, listen, if you want to neutralize this threat to shipping, you can't just play defense. You have to go on the offense. So that's something they're certainly weighing. But again, we're really going to have to see what shippers decide and whether they're willing to put ships potentially in harm's way once again now that this coalition is formed.
Meanwhile, Nick, especially as we head into an election season, we hear a lot about domestic threats stemming from some of what's going on in the Middle East. I'm thinking about some of the rhetoric that the border issues are deeply related to this because we're at a heightened risk of terrorists coming in through the borders or other types of attacks in the nation. Based on your connections with people in the intelligence community, how much validity is there behind some of those concerns?
You know, I mean, the border situation is a great question. My sense is that really they are just in pure, almost panic mode about how to stem the tide of migrants who are coming in from the border. And it's not so much a question of concerns about terrorism. I mean, that is a concern that's raised by some people, particularly among Republicans. Democrats in the Biden administration, I think, don't see that quite as much as a major threat. But they are planning to send the Secretary Blinken to Mexico at some point in the coming days, as President Biden announced yesterday. They really need to figure something out with Mexico and are finally sort of getting to the point that they realize they need to do something about this. How they are going to be able to achieve that, though, that is the big question, and that's something they just do not have an answer to right now.
Nick Wadhams of Bloomberg, thank you so much. Happy holidays. Have a wonderful new year. This really is the year where we're ending on a massive geopolitical bang in all the wrong ways. And frankly, next year, it seems like that's one of the big questions that's keeping people up at night, not because they can trade around it, but just because of humanity issues.
Yeah, and it's, of course, a tricky moment for the Biden administration. You think about the fact that there's 2 hot wars going on right now in the world, and then you add what's happening to the Red Sea on top of that, the potential to exacerbate one of those hot wars, and you add in the fact that next year is an election year. There is a lot for Joe Biden to keep an eye on.
Especially given the fact that there's a lot of disagreement within his own party and within his own cabinet about how to handle some of these things. Look, it's not easy. We're dealing with 2 proxy wars, right? We're dealing with one proxy war with Iran, one proxy war with Russia, a lot of questions around how much the U.S. wants to get involved, what will potentially ignite an even broader war at a time where there's some very difficult, nuanced stances going on with Middle East partners and enraged kinds of rhetoric around the world. I mean, it really is quite a moment to try to delicately walk.
And a delicate dance, too, going on with China. Of course, the second largest economy in the world. Of course, 2023, we did see a little bit of movement on that front, normalizing that relationship, but that is top of mind for a lot of citizens and investors as well.
But even more important, inflation. Coming up next, we're going to be talking about that PCE, core PCE deflator that's going to be coming out. We are so pleased to say Michael Gapin of Bank of America is going to be able to help us parse through those numbers and understand the disinflationary hopes and dreams. Are they coming true?
used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We are just seconds away from the last important data release of 2023. It is exciting. It is core PCE deflator. We're going to take a look at the key metric for the Federal Reserve. Heading into it, just the setup is pretty quiet as people really have no reason to trade ahead of a key economic data point. What's notable to me today is the lift in crude, up about 0.7% or $74.44. Right now, across the terminal, we are getting some of the data trickling in. And right now it is showing, wow, that the PCE deflator month over month actually went down. So it declined 0.1% versus the expectation of being flat. That means that year over year, the PCE deflator came in at 2.6% rather than the surveyed expected 2.8%. And then when you take a look at the core PCE deflator, year over year, you're looking at 3.2% versus the expectation of 3.3%. So a good downside surprise for those who are looking for disinflation. And what you can see is markets like what they see, at least around the margins. Not a massive reaction at this point. S&P futures basically unchanged, but really kind of confirming the disinflation that we have been talking about and seeing in all of the other indicators. Just taking a look at the 2-year yield, not seeing a lot of activity, which maybe gives us a sense, Katie, that this was kind of expected and baked into the pricing going into this.
Yeah, perhaps it was priced in. Interesting to not see, though, too much of a reaction. We'll see how these numbers settle in and the market digests it. But 2-year yields now back to unchanged on the day. I will point out, you take a look at durable goods orders. This is preliminary for November. A big beat there, 5.4% actual. The survey was expecting 2.3%. So certainly a surprise. You're watching the market try to digest all of this. And I will say that S&P 500 futures moving a touch lower right now.
Durable goods orders, you mentioned that, and that I think is one of the key components here. Not only are they almost twice or more than twice the expectation in terms of the magnitude of the increase there, but the prior month was revised upwards. So it was lesser of a negative than originally reported. We're seeing across the board the disinflation, but still economic strength, which really sets us up for this question of, can this continue? Where we get this disinflation with ongoing strength. They will just bring you a couple other numbers. Personal income coming in as expected, 0.4%, and personal spending increasing 0.2%. That's a touch lower than expected of 0.3%. Downward revisions on personal spending for the prior month, but personal income increased more than expected the prior month. So pretty much people are being responsible. They're not spending too much. Their incomes are increasing. They're ordering more goods, yet inflation is still continuing to come in, Katie.
And with all that in mind, it's interesting to not see necessarily a positive reaction to these figures. Again, we're talking about small moves here, but you take a look at futures right now on the S&P 500, we're down 0.1%. Again, very small moves, but we were unchanged heading into this report. So it's interesting to see these narratives try to get parsed right now.
What gives? Let's ask that question to Michael Gapin, head of U.S. economics at Bank of America Securities. Michael, what is your reaction given the fact that markets seem to be a little put off by consistently disinflationary data?
I think the markets had, well, first of all, good morning, Lisa and Katie. Thanks for having me on. I think markets had priced this in already with the CPI data in hand and the PPI data in hand. We can make a pretty good projection of where PCE should come in. And we did expect the headline to be down a tenth and the core to only be up a tenth. So this number really wasn't a surprise to us. And if you do the implied CPI forecast from market prices, they're looking for pretty soft inflation over the next 3 to 6 months. So I think that the markets had largely priced in this number. As we all know, they're looking for about twice as many cuts this year as the Fed has planned. So I think this was a status quo number for markets.
That might be status quo. The durable goods orders, as Katie pointed out, not so much. It came in significantly higher than expected. And I wonder if on the margins there's some anxiety that it seems sort of incompatible that we could get ongoing better than expected growth while still seeing that disinflation that everyone's been hoping for.
Yeah, there's certainly a limit to that, right? So far the narrative is that the economy can cool, growth can remain modest or moderate, but away from recession, and we can experience both moderate growth and disinflation at the same time. That's our view. I think that's the Fed's view for sure, and why they've shifted to, say, a more balanced reaction function between bringing inflation down and wanting to support a soft landing. But you're right, there's a limit to that. There is a risk to shifting to a dovish stance now and coming out of the December meeting and tilting the outlook towards rate cuts, because markets have reacted quite quickly and financial conditions have eased. So the risk is that maybe you gin things up too much and you don't make as much progress as you want on the inflation front. So no free lunch in that regard. We think the Fed's in a good spot. We do think rate cuts are coming, but you make a good point. Too much easing in financial conditions could ultimately mean inflation is stickier to come down or maybe even rises a little bit and kind of puts off some of these rate cuts that the market is expecting.
Well, let's talk about just the magnitude of the rate cuts that the market is expecting. Of course, 150 basis points priced into next year, a big gulf between that and what we saw in the dot plot, just 75 basis points of cuts penciled in. When you take in totality what we learned today when it comes, of course, to PCE, to personal income, to spending, and of course, those durable goods orders, where does this land in terms of what the market is expecting? Do those 6 rate cuts look justified at this juncture?
I think the inflation data certainly support the idea that the Fed can start in March. So assuming the data flow trends in the way that it has, with a lot of evidence of disinflation and modest growth, but a cooling economy, we do think rate cuts can start in March a little earlier than the Fed thinks. We would say, curb your enthusiasm a bit for 150 or maybe more rate cuts over the course of the year, because we do think inflation will be a little more slower to come down. So we agree on the start earlier than later, but our view is you get about 100 basis points of cuts. So the market may need to reprice some of these as the data comes in.
So, okay, maybe that process back to target will be slower than expected. Compare that to what we heard from Jerome Powell last week. He said that he was reluctant to say that the last mile of this inflation fight will be more difficult. Is that your expectation, or does slower than expected sort of imply there's some pain ahead?
No, I would agree that at least again, the composition of the data flow that we've been seeing, I think, suggests we can enjoy modest growth and disinflation, and it does suggest that the last mile may not be overly difficult, right? So that does come from supply side effects, both on goods and on services, where reemployment has really helped increase services outputs. So we're getting a supply side effect there. As everyone knows, core goods have been falling for 6 months. So we'll see if things like shipping issues out of the Red Sea change that narrative. But otherwise, the last 3 to 6 months worth of data suggests maybe we can, it's more likely than not that we can get down to 2% consistent outcomes without needing to generate significant pain in labor markets, which would be a great outcome for the Fed, the average U.S. household and the average U.S. business. It would be a great outcome for the economy.
Well, I want to talk about that a little bit more because inflation has been enemy number one from the Fed's perspective for really the last couple years now. But now as we continue to get this march lower when it comes to some of these figures, does the Fed's focus shift here? Do they start paying more attention to economic growth, to the labor market, et cetera?
Yeah, I still think bringing inflation down is the number one goal, given where inflation's been, where it is, and the Fed's internal consistency about, hey, we really control inflation. We set that long-run inflation objective. We determine long-run inflation outcomes. So it's kind of, it's in their blood, so to speak, and in their DNA. So I still think that's, issue number one. But a very close issue number two, if not closer to balanced, is, hey, I think we can soft land this economy. We don't need to generate as much pain in labor markets as we thought we might have had to do 6 to 9 months ago. So we should keep an eye out for that. So yes, it does make an argument that one of the reasons why the market has so many cuts priced in is both of those cases, moving to a more balanced reaction function in an environment where the economy is cooling and inflation is slowing, that just increases the odds you're likely to get rate cuts. So I think the market is listening to that message.
Michael, what's the gap between just weakening that is good and weakening that is bad? And I ask this because I'm trying to still understand the language out of the CFO's office at Nike when they said that demand is cooling faster than they expected, revised downwards some of their expectations for sales, talked about cutting jobs. Is this something that is just an idiosyncratic business overlaid with a weakening economy in a good sense, or is this potentially something bad?
Yeah, I think I would put that narrative probably inside the rotation story away from goods purchases back to services. The goods side of the economy, the manufacturing sector, has been kind of on the edge, if not in a mild recession for some time now, at least in terms of production and inventory adjustment and so forth. So I think the goods side of the economy is reacting in part to that rotation story. What still looks pretty solid is activity and employment on the services side of the ledger, which is 2/3 or more of output. So I think to use your phrasing, the quote goods slowing and cooling is about the rotation story, the end of the COVID reopening impulse. Things should naturally slow down anyway. We need to provide an environment for the economy to do that while we bring inflation down without tamping on the brakes too hard. So you're right, there's a fine line between slowing that we think should happen as a result of a very unusual pandemic-driven cycle, and oops, we've got the monetary policy setting calibrated incorrectly, it's too tight, we have to back out of it more quickly.
Does anything about the services inflation concern you, given the fact that it still is running above what you would expect for 2% consistent inflation?
Yeah, certainly shelter and kind of the structural issues in the housing market without a lot of supply and inventory and available homes to contract for sale or purchase. So the shelter story, shelter is moderating, it is coming down, but it's coming down more slowly than our models would have suggested. So we think that there's stickiness there, and even non-shelter services inflation has been more sticky. So this is where we would say, maybe, curb your enthusiasm. We have inflation for PCE coming down to around 2.5 year-on-year by the end of this year, where market implied pricing is closer to 2. So it's easy to see how a stickier inflation path could mean some of these rate cuts are not realized.
Michael Gapin of Bank of America Securities. Happy holidays. Thank you so much for being on with us. Right now, we're looking at markets trying to figure out exactly how to respond to a downside surprise when it comes to inflation coming in less inflationary, more disinflationary than expected, kind of range-bound, bouncing around between gains and losses. But right now, to the upside, 48.02 on the S&P. If you are just joining the program, up about 0.1%. And I got to say, Katie, what we just heard there from Michael Gapin is kind of what Andrew Hollenhorst over at Citigroup is talking about. He just put out a note saying that right now the slowing is largely due to goods. Services inflation and wage growth are running faster than what is consistent with 2% inflation. December core PCE will likely be much stronger, but Fed officials will likely still proceed with their plans to cut interest rates. So this is kind of the debate. are there certain factors that are going to kind of roll over as the year progresses next year?
It's a great question, of course, one we're going to be grappling with for quite a while. I will say it is poetic that you take a look at 2-year Treasury yields right now. They are unchanged on the day, totally flat. And that sort of gets back to the point that Michael Gapin was just making, that this was a pretty status quo number overall. Of course, you toggle with some of the details there, but overall, this is consistent with what's already been priced in.
And this has been a lot of disinflationary hope, and this sort of raises the question, again, of whether people have priced in that hope entirely into markets across the board, including stocks, where you have seen an incredible rally over the past couple of months, some of the biggest gains that we've seen going back years. What I'm hearing from Neil Dutta over at Renaissance Macro is something that I'm also hearing from Robert Sinch, which is core inflation right now, if you annualize the past 6 months, is below 2%. So this is what people are looking at. Robert Sinch pointing out that core PCE annualized for the last 6 months is now 1.87%.
There you go. Maybe we'll get back to worrying about the fact that inflation's too low. That would be very 2018, very 2019 of us.
Yeah, that would be a throwback, wouldn't it? I think that that would be quite a moment. Right now, we're not thinking about that as much as just getting to the end of the year and figuring out exactly how to reset for next one. Coming up, Adam Pickett of Citigroup on his 12 trades of Christmas. This is Bloomberg.
The reception, the acceptance of Puro Sangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro Sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The Fed is going to need to see at least 2 or 3 months more of continued improvement. They're going to need to see sustained improvement before they're going to be willing to take more action. And so I think the market should expect that it's going to take a while and more sustained improvement before the Fed does something.
That's not at all what markets are currently expecting. That was Robert Kaplan, former Dallas Fed president. But right now, people are very much banking on a March rate cut after disinflationary data comes out, one data point after another. Right now, we are firmly pricing in a 77% chance of a rate cut coming at the next meeting that comes in March. So that's where we're at right now. Right now in markets, you can't really see much action. I guess it's all priced in.
It's all priced in. The S&P 500, when it comes to futures, at least getting a little bit of a lift there, up about 0.2%. Not a huge reaction, though, when you consider that this was pretty good news. But, you know, to your point, maybe it was all priced in.
What we did see, if you are just joining the program and missed it, we did see a personal income come in bang in line with expectations, personal spending a touch below, but this really was was the main course. We saw a negative 0.1% decline month over month in PCE deflator, and the core deflator year over year came in at 3.2% versus the expectation of 3.3%. Do want to just run through a couple stocks that we've been talking about all morning, because I think it is important to note it's not that we're seeing no weakness. It's just that it's been isolated in specific sectors that have been rolling through recessions. Nike shares lower by 11.5% after coming out and saying that they're planning to cut costs by $2 billion in the face of weaker demand than expected, talking about job cuts, talking about other expenses that they hope to slash. Other companies, Foot Locker and Dick's Sporting Goods, among those in the U.S. You also see Puma and Adidas over in Europe, all falling in tandem. And this real question of, okay, we've already seen the retail recession. Is it ongoing? Are we recovering? Is it China? Is it global? Is it the U.S.? These are some of the questions that people are trying to parse through away from just some of the euphoria.
And you think about the ripple effects of, okay, maybe Nike has some idiosyncratic issues that are specific to Nike, but then you think about a Foot Locker, for example. It relies on Nike for a lot of its revenue. It sells a lot of Nike products, for example. So again, one chain's problems has widespread effects.
Especially because they talked about also just maybe paring back some of their models.
I thought that was interesting.
And, you know, having a scarcity kind of a situation to ignite some of the interest. Igniting interest is very much had a position for a year that promises to be tumultuous, and that we've already seen a lot of one-sided buying. Joining us now, Adam Pickett, head of global macro strategy at Citi, who is feeling very Christmassy with his 12 trades of Christmas. Adam, how did you come up with certain pairs heading into the new year at a time where markets have moved very quickly and all in one direction?
It's a great question. I think for me, you know, one of the key themes that maybe is going to take us out of that, some of the big directionality that you talked about, is thinking about where some of the divergences are really going to come in. Obviously, we've had a bit of a one-way move in risk and duration, but for us, trying to think about picking certain spots within the central bank stories is quite interesting. You know, for us, looking at places like Australia on the more hawkish side and pairing that up against maybe the UK on the most dovish side, where we think, you know, sterling Aussie is a pretty good story. Knocky stocky within the Scandinavian central banks is a good bull case as well. And we also saw some very divergent guidance from the SNB versus the Bank of Japan, where again, medium term, we think that buying Swiss versus yen also makes a heck of a lot of sense, given some of the guidance there. So if you don't want to be too directional, we think that's a good place to start. But obviously, we've got a lot of interesting stories going on with the US and the Fed as well.
And is through the FX market really the way to play that idea, this divergence that you're seeing in different developed market central banks versus, say, their bond markets?
We think so. We think, you know, there's additional stories around, say, the oil dynamics in Norway, in the Swiss versus yen. Actually, a big part of the story for the Swissy is that really the SNB's influence on the currency has got nothing to do with rates. It's got entirely to do with the FX intervention story that is going on. Meanwhile, for the yen, it's a little bit of a BOJ story, but obviously it's got a very high beta to US 10-year Treasury yields, which again, we think medium term, there's a story there. So with that, we think there are other influences that additionally help the central bank divergence story. You know, gold is another nice one for the Fed, that take you away from the pure rate dynamics, and a little bit less priced in, we think, too.
Well, let's bring this conversation to the U.S. and to the U.S. equity market, because looking at your 12 trades of Christmas, I'm taking a look at trade number 1, and that is sort of playing a expected slowdown in the U.S. consumer. What's the best way to do that?
I mean, for us, you know, one way we think is maybe a useful way to kind of insulate yourself from the broad beta is to think about these kind of high quality names, still thinking with a little bit of a growth tilt. Ultimately, these guys still have very, very high quality balance sheets, very high cash to debt ratios, and pairing that up against some of the smaller firms. So, you know, even though there's maybe a bit of a lean towards the US consumer slowing down, ultimately, we think US household wealth is exceptionally elevated. It's up around 35 to 40%, depending on how you look at it, versus 2019. And that still skews, we think, towards consumer discretionary, which has this nice mix of growth, but also sort of top-line, high-level spending power versus, say, the Russell, that can be the best way to play that theme of, ultimately, we still have strong spending numbers as we saw today, but some of these lower quality firms are still going to be caught up in the credit cycle and the ultimate longer-term slowdown.
Adam, I do want to point out that you are definitely multicultural. You were talking about it's the 12 trades of Christmas, but you could have come up with a more succinct piece. The 8 trades of Hanukkah, although that's past. Adam, I am curious if this is a good time to be trading in markets that are of thin liquidity, where a lot of people have already gone home.
Yeah, look, I mean, we sort of joke that a lot of the year-ahead forecasts are stopped out by the end of January. I think for a lot of people, their year-ahead moves have already happened, in the space of a few weeks. For us, one of the themes that can potentially still run in a popular trade is something like the steepener in the US, but we like 530s quite a lot. 2s has already moved a lot. The 2s 10s profile actually is quite punitive carry. For us, something like 530s in the medium term still has further to go. The Sharpe ratio of getting into that kind of trade 6 months before the first Fed cut is about as good as the 2s 10s, but we still think it has a lot of legs. So exactly to your point, a lot of markets have moved, liquidity is thin. I think being patient, being creative with the construct of the trade still makes a lot of sense here.
Are more people in the office this year, given how much volatility there has been?
Absolutely. I mean, I've got a good friend of mine who will be in on Boxing Day, and I think we'll be far more staffed over the Christmas period than is normally the case. A lot of money to be made, and probably one of the most active ends to the year that we've seen in a long time. So definitely a lot of interest still.
Adam Pickett, thank you so much, and happy holidays with your trades. Good luck. Adam Pickett there of Citi. Interesting to hear that there are going to be a lot more people in the office at a time where we've become accustomed to pretty incredible volatility.
I know you're smiling because you're off next week. You're out of here.
Yeah, I am, but I've enjoyed this so much. That's the reason why. Thank you for being with us. Are you here next week?
I am here next week. Going to be working till the bitter end. Of course, I'm going to be doing my best Lisa, Tom, or John impression.
All three at the same time?
All 3 at the same time. I don't know. Maybe I'll switch every hour. We'll see what happens.
Like a skinny bow tie, or like a skinny tie, a bow tie.
Yeah. What should I wear for you? Maybe like a nice blazer.
No, just sort of, a sky is falling sign, and just sort of march around, but what if, and you can make it work. Honestly, it's been quite a year, and I will say that it's been really front-loaded. What he just said there, Adam Pickett, about the idea that the beginning of next year has already been front-loaded and brought to this year, which kind of sets up some interesting potential moves heading in.
Things that were projected for 2023 and the things that we spend a lot of time talking about right now that we weren't this time last year, to bring it back to the equity market. Of course, AI has been the thing to talk about. Weight loss drugs have been the thing to talk about. Maybe I was behind the ball, but those weren't necessarily on my radar last December.
Right. So what are we going to be talking about next year?
I shudder to think.
Exactly, indeed. Right now in markets, not a lot of action. A very important data point, but what it did was just confirm what markets already had been pricing as people parse through it. A little bit more of a lift, 48.07 on S&P, up 0.2%. The euro gaining versus the dollar, 110.28, the highest levels that we've seen going back to July. A little bit less of a bid into treasuries, 10-year yields at 3.87%. Coming up on Bloomberg TV and radio, do not miss this, a conversation with the lead economic advisor to the president at 11:40 a.m., Lael Brainerd, director of the Council of Economic Advisors, at a time of incredible question around why people are feeling so bad if the economy is on a good trajectory. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrell. Lift the markets after data came out that was the last most important data point. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrell.
Disinflation dreams kept afloat as PCE cools. Nike sinks on a weak revenue outlook, and oil set for a weekly gain as Red Sea attacks disrupt trade. We begin with the big issue. Growth worries start to slip in.
There is likely going to be a growth scare time.
We do see the economy slowing.
Growth slowdown, slow growth in 2024.
24 growth is going to be less than 23. Just because there's so much optimism in the markets right now.
An uber amount of optimism coming out.
Even if you get a soft landing, you're going to have slower growth.
The soft landing opportunity has increased.
When you think about the Fed's pivot, or change in language and direction, it really does take out one risk.
The Fed now has the latitude to start adjusting policy rates lower because inflation's come down enough.
In the second half of next year, there's a very meaningful risk that you see a rebound in inflation.
I wouldn't think that would be a huge risk into next year, growth being a much bigger one.
Can we get the best of both worlds? Can we get lower inflation and strong growth?
I don't really see any meaningful catalysts to sort of break us out of what could be a really sluggish growth backdrop.
This is going to be the main driver of market.
Joining us now to discuss is Morgan Stanley's Michael Kushba and Mary Ann Bartels of Sanctuary Wealth. I just want to start with you, Mary Ann, about whether you're more worried about just a reignition of inflation or some sort of more material slowdown that looks weaker than people are expecting.
So going into 2024, we think inflation continues to go down. And in fact, I would not be surprised either in 2024 or in 2025, we actually go to a negative CPI. And I don't think that's being factored in. In terms of growth, when I'm analyzing the year-to-year change in real growth, it's actually improving. So I think it's actually possible you have inflation come down lower than people expect in 24 and have better growth. That's positive for earnings. That's positive for the equity market. Now, for the income market, in terms of fixed income, I think short term we can get a backup in rates because rates have moved. But I think if inflation continues to drop and the Fed begins cutting rates, rates are going to fall a lot lower than people expect. So we're calling the year of 2024 the bucking bull. I think people are going to be bucking the bull market in both bonds and stocks for 2024.
Yeah, that seems like a good guess, given the fact that that's what we've been looking at right now in terms of PCA data that came in lower than expected. Michael Kushma, do you agree with that, this idea of immaculate disinflation on steroids with better growth and weaker inflation?
It does look pretty good at the moment. Inflation is coming down faster than expected, faster than the Fed expected, faster than I expected, faster than the market expected. And this sort of immaculate disinflation with growth stronger this year than it was in previous years, and inflation coming down sets the markets up for a very good 2024. The big question is, will inflation continue to fall as expected? If financial conditions ease too much, maybe inflation doesn't fall. The economy does better than expected. People had forecasted a pretty weak 2024. This easing of financial conditions, which is taking us back to the levels of early this year, if not previous in 2020 and 2022, will be supportive of the economy next year when there's no real evidence of a significant slowdown. But most importantly, it's truncating the downside risk. It's truncating that significant hard landing, which people have been worried about for a year until the past couple of months. And that really bolsters the longer term. Whatever happens in 24 bolsters the longer term outlook for the economy and for inflation.
So how low can bond yields go in this sort of immaculate disinflation, even with the potential risk of the reignition of inflation, or at least that it remains stickier just because financial conditions are easier? Michael, do you see yields getting below 3.5% on a 10-year?
3.5% will be a difficult level to get through unless you believe that the Fed's terminal forecast about 2.5% is the long-term fair value for the Fed funds rate. If that is achieved, if that is correct, and we're on the path to get back to that 2.5%, then 3.5% is easily doable. If, however, the economy rebounds in 2024, inflation plateaus above 2%, then 3.5% will be very, very difficult and more likely to be 4%. Going forward. So I think now we're getting to the critical juncture is how are things going to perform in the out years? We know interest rates are coming down in 2024. We don't know how much, but it'll be meaningful. 100, 150 basis points is easily doable, but farther out, are we going to get much below 4? That depends how the economy is perceived to perform in 25, 26.
Well, and then raises a question, Mary Ann, of whether you're going into some of these cyclicals, et cetera, and not necessarily betting as much on the bond space simply because it seems like the bucking bull theory of, yes, inflation coming in below expectations and growth remaining strong will keep alive some of those longer-term inflation goals.
So when I look at the 10-year Treasury yields, I just want to add, I think what people are not pricing in is that at some point, whether it's 24 or 25, the 10-year can go to 2.5. And I'm always looking for what is possible that the market is not expecting. And from technical analysis, 2.5% is actually doable. So if you actually do get in those inflation numbers down, I think that's going to be a huge surprise. And if rates continue to fall the way we think they can, that's really going to continue to ignite the equity market. Now, we're starting to see a broadening. You're starting to see what didn't work this year, like small caps, banks, and financials rally. But the question is, are those the new leadership? And we don't think that's where the new leadership is. We do think the market stays cyclical. We think the new emerging leadership is in the industrial space, leveraged into Biden's legislations that he's passed, which everybody's talked about, the CHIPS Act, the Infrastructure Act, and the Inflation Protection Act. But I think the true leadership in the market remains technology. And the pocket that we think sustains that leadership are semiconductors. I know they're up a lot this year. They certainly can consolidate going into 2024, but I still see significant upside. In fact, they're just starting a new cycle. And when they start a new upcycle, it generally lasts for a couple of years. And in terms of the Magnificent Seven, they were actually supported by earnings. It wasn't air putting in wind sauce for these stocks. They actually produced the earnings just this year when the other stocks did not produce the earnings. So I do think that they can continue to participate, but you'll see that tax base actually broaden out.
All right, the Fed's preferred inflation gauge is cooling in November, just basically in tandem with what you both are talking about. Even as growth worries start to pick up, Bloomberg's Katie Greifeld joining us now for more. Katie, it's been a while. What are you seeing out there?
Well, you take a look at some of the numbers that we got this morning at 8:30 a.m. We do have some superlatives here. You take a look at a monthly basis, the overall PCE price index actually fell 0.1% from October. That is the first monthly decline since April 2020. Meanwhile, you take a look at the annualized rate, that measure advancing 2.6% from a year earlier. That is the smallest gain since February 2021. Meanwhile, you take a look at personal spending, rising 0.2% on a monthly basis, just below forecast, while personal income rose by an as-expected 0.4%. You add that together, you have that sustained easing in inflation, you have still resilient household demand. It's giving a lot of juice to those who've been saying that there's a soft landing coming for this economy. Meanwhile, though, you take a look at the reaction in markets right now, it's not huge. You take a look at S&P 500 futures up by about 0.2%, as you can see on your screen right now. Then you take a look at bond yields, and they're pretty much unchanged, maybe down 2 basis points or so across the curve. But relative to what we have seen, not a huge reaction. And the reason why, we just had this conversation with Bank of America's Michael Gapin. This was pretty much a status quo number. Pretty much priced in, because a lot has been priced in over the last 2 months. The S&P 500, of course, rocketing higher. It's now 24% higher on the year, and a round trip in bond yields with a mile-high range. Currently, right now, the 10-year yield trading at about 3.85%. This morning, that is just about where it entered 2023. So a lot of muscle has been put behind this immaculate disinflation narrative. But of course, we'll see if that continues to be the case in 2024. Maybe some of those growth fears start to overwhelm what right now is a very, very broad-based rally, Lisa.
I love how we're trying to come up with the potential downside risk, Katie. It feels almost like a futile point when every data point is better than the next. Katie, thank you so much. Still with us, Michael Kushma and Marianne Bartels. I am curious, Michael, we're looking at the rally in risk assets and fixed income that has been quite significant as well. High yield bond spreads, the extra yield over benchmark rates, have contracted to the lowest going back to April 2022, not April 2023, at a time where people are still talking about default risk when people have to refinance. Do you think that this is adequately already priced in some of the strength in this immaculate disinflation kind of growth that we're talking about next year?
It has, but it's more than that. It's the fact that the Fed has pivoted in a relatively hard way. My original view was that the Fed would pivot to high for long, but no more rate hikes, and slowly in Q1 next year, they'll talk about rate cuts. Clearly, they've brought forward their worries about the economy and not so much worried about inflation anymore. But that truncating of recession risk, that reducing the probability of a hard landing by a meaningful amount by their pivot, that's the number one problem for a risk for high yield, is a recession. If there is no recession, their defaults will rise to a more normal level. There would clearly be pockets of companies that profited and did very well in a zero yield or a very low yield environment and will struggle in a higher interest rate environment. That doesn't mean the market as a whole won't continue to do well. My analogy, the best analogy I can come up with, is the mid-1990s, where the Fed pivoted hard in 1995, cut rates after raising them dramatically in 94, and off we went for 2 to 3 years of exceptionally strong credit performance, because the probabilities of recession had dropped to not to zero, but to much lower levels, which allowed high yield to continue to do well. In particular, real interest rates for even risk-free assets are still on the high side, and that it should likely stay where they are or come down, but not go higher, which will be supportive for the economy and supportive for risk assets in general. So high yield is definitely a lot more expensive than it was. They don't expect a lot more spread tightening, but on the other hand, do not expect spreads to widen meaningfully.
Is that the same thing in investment grade, Michael?
A little trickier, because spreads are contain much more contained in a range. But yes, there's still, I think, an upward or downward pressure on spreads at the margin, but it's kind of like pushing on a spring. The lower you get, the harder you have to press to keep it down. So it becomes vulnerable to negative surprises. So the negative surprise for me would be growth turns out to be stronger and inflation turns out to be not so low. And then suddenly the Fed has to pivot and say, well, maybe we're not going to have 3 rate cuts next year. We'll have 1. So the danger will be we pivot, the economy pivots stronger, and that undermines this very Goldilocks, immaculate disinflation kind of scenario.
Marianne, just very quickly here, are you also bullish on credit at a time when it seems like recession's being taken off the table?
We are, but we do want to stick with quality. We moved our duration and went to benchmark a few months ago. And we've actually been in the high yield market because of the lack of issuance. And one of the themes that we came out with earlier this year is that the 60-40 portfolio is back. But what we're stressing with our financial advisors, the key to the portfolio management of fixed income is going to be laddering over time. Because although we see inflation coming down this year, we think over time inflation is going to reaccelerate and that eventually yields will back up again. And you want to be able to have that steady stream of securities maturing so when rates do back up, you can lock those in.
Michael Kushma, Marianne Bartels, both of you are sticking with us. Let's take a look right now at what is moving ahead of the opening bell. Abigail Zulittle has that. Abby.
We don't have a lot of stocks that are specifically moving relative to that PCE number, but we do have some idiosyncratic movers. Take a look at the shares of Karuna Therapeutics, absolutely soaring up 47%. This is Bristol Myers Squibb, strengthens its neuroscience portfolio with the acquisition of the schizophrenia drug maker for $14 billion. It would add a drug that's close to an FDA decision. Marathon Digital Holdings on pace toward a record 8th up day in a row since going public back in 2012, even as Bitcoin on the day takes a pause. Speaking of taking a pause, Nike down 12%. Of course, their outlook for sales a bit weaker than expected. China's falling short. They're also talking about cutting jobs to save $2 billion. It's interesting, Lisa, because they also have commentary saying that there is a cautious consumer behavior around the world. The stock is now poised to open down on the year. Yesterday, higher on the year.
Abigail, thank you so much. Coming up, Nike, what you were just talking about, delivering a weak sales outlook.
Nike and consumer finickiness shows that consumers are back in control of pricing power. That pandemic wave of pricing power that companies enjoyed is gone. And now they have to offer consumers deals to get them to part with their money.
That conversation is still ahead in markets that are ending the week on a positive note. Not Nike, though. We'll discuss.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
consumers have jobs, they will spend. Exactly how much they spend and with how much they lean into the holidays, et cetera, is certainly up in the air still. But they are spending. Nike and consumer finickiness shows that consumers are back in control of pricing power. That pandemic wave of pricing power that companies enjoyed is gone, and now they have to offer consumers deals to get them to part with their money.
Nike under pressure thanks to a weak sales warning. The sportswear giant looking for as much as $2 billion in cost savings, planning to dismiss workers and simplify its product offering. Sales in China also falling short of expectations. The Nike CFO saying, quote, there are indications of more cautious consumer behavior around the world. Nike's competitors are feeling the impact. Adidas and Puma investors fearing a similar sales slowdown. Joining us for more is Bloomberg's Simone Foxman. Simone, what stands out to you and why do you think Nike's warning had such a big impact on its peers?
It's all about this macro negativity, Lisa, because we've watched the impact of Nike's earnings report spill both into suppliers in Asia, then following to rivals like Puma and Adidas in Europe, and now we're looking at weakness among retailers like Dick's Sporting Goods, like Foot Locker in today's pre-market trading. And it really suggests the consumer picture is getting worse from here and not better, and that's especially outside North America. In fact, North America was the only place where revenue actually kind of came in a little ahead of expectations, still down 3.5% year on year. But you look at China seeing $1.86 billion in revenue versus the $1.97 billion that analysts had anticipated. EMEA also coming in shy of expectations. The message here as well about the consumer weakness. We saw these massive shopping moments, shopping events from Nike. For example, they cited the strongest Black Friday weekend ever on digital and the record number of consumers in their stores. Even Greater China had greater brick and mortar growing double digits during the National Day holiday. But outside of that, the activity just very light, very promotional, according to Nike executives.
Simone, thank you so much. Michael Kushma and Marianne Bartels are still with us. Michael, I want to go to you on this. Does this concern you at all with respect to weakness that could spread?
Well, it's without a doubt that North American growth has been far better than growth outside the United States. There's all sorts of issues. In Europe, the energy price shock was a much bigger negative for Europe than was the United States, and that is still weighing on that economy. It's also true that the ECB has a single mandate of inflation, not growth. So as long as inflation's too high, they're not talking about rate cuts yet because inflation is too high for their taste. So they're not getting expectations of not benefiting from the expectations of rate cuts coming through, and the consumers are more cautious in Europe because of the surge in the energy prices. China, we know the economy has been suffering from the decline in the property market. The reopening post-pandemic wasn't quite as strong as maybe expected, and the consumer's cautious there. Property, I think, is the number one way to accumulate wealth in China, and consumer spending, not surprising then, is on the muted side over there. So growth outside the United States remains troublesome. Monetary policy outside of selected emerging markets is not being, interest rates are not being reduced in those countries. You look in Europe, you look in Australia, New Zealand, the UK, no one's cutting interest rates yet. So this is not buttressing the consumer. So I think the U.S. is still an outlier, and it has this sort of exceptional economic performance at the moment.
Marianne Bartels, I'm curious from your vantage point if this discourages some of the bull case that you've got with better growth and more disinflation than people expect. Does the international scenario worry you?
No, it actually doesn't, because Taylor Swift's Eras Tour is going international. So if we've learned that what Taylor Swift can do with her economics to an economy is top $10 billion in the United States. Imagine what she's going to bring to these other countries. So I'm not concerned. And if you look at the valuations of the equity markets compared to the United States, they're probably some of the countries, particularly China, are the cheapest that they have been in decades. And I do think you can get some mean reversion, maybe not so quickly from China, but definitely from Europe. And if you look at Japan, Japan is very close, maybe 20% from its all-time record high. And I do think we can go up and test that high. And if you break out and sustain that high, it means Japan is in a whole new secular bull market. And historically, they're very good with technology. And as we're moving to a whole new digital era with technology, I think Japan looks very interesting, and some select emerging markets. So I'm not as down. And when you look at the consumer here in the United States, if you look at the net worth, their net worth just reached a record all-time high. And when you do a year-to-year change to get the growth, it's growing. Now, the pockets of growth are very selective. The baby boomers really have the chunk of that money and are spending. Low income is more struggling a little bit more, particularly because of inflation. If we were to get some type of disinflation in 2024, actually getting some prices down, you're going to actually see consumer spending go up. But I am saying the consumer will spend, but very selectively.
Just real quickly, Michael, just to the final word here, what's your highest conviction trade heading into 2024?
Highest conviction trade is we like that the assets linked to the U.S. housing market, non-agency mortgages, some securitized credit, not so much agency mortgages, but household wealth, as just this was mentioned, is extremely high right now. And that consumers who own homes are in a really good position, and their creditworthiness still seems to be the most robust of any other sector in the economy.
Michael Kushma, Marianne Bartels, both of you, thank you so much. Happy holidays. Have a good one. Coming up, the morning calls, and later, the merry bells are ringing in Invesco's Brian Levitt on why he sees a soft landing for the U.S. economy. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
A look at some of the analyst recommendations on Wall Street this morning. First up, Needham naming Amazon as a top 2024 pick, raising its price target to $175, citing generative AI productivity advantages. Next up, Wells Fargo raising its price target on Ross stores to $150 and keeping an overweight rating, citing high hopes on softline retail following a material move in the space. And finally, Wedbush raising its price target on Tesla to $350 from $310, seeing the company reaching a $1 trillion market cap in 2024. Coming up, Invesco's Brian Levitt joins on why it is a very holiday mood on Wall Street. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday. Wowing toward an 8th straight week of gains, the longest streak of gains that we've seen going back to 2017, as everyone seems to celebrate around the idea of a soft landing. You can see S&P futures crawling upward toward the open, up 0.2%. NASDAQ up about 0.25%. If you want to take a look at what's going on outside of stocks, it is a bid into treasuries on the great inflation disappearance, the disinflation hope. 10-year yields down about 3 basis points, 385.96. You're seeing dollar weakness across the board with the expectation of rate cuts. The euro 110.30 versus the dollar, the strongest level that it's been going back to July, and crude lifting a bit, but it's been range bound around $74, $75, even with all of the disruption potential in the Middle East. 2 stocks to watch at the open. Bristol Myers, a drug developer, Karuna Therapeutics, who agreed to an acquisition deal worth $14 billion. Joining us with that is Abigail Doolittle. Abby.
Hey, Lisa, and we have Karuna Therapeutics absolutely soaring right now, up 48%. Its best day. I'll be able to tell you that in just one moment. Since August 2022, a relatively newer company, I'm guessing, based on that. But it is Bristol Myers Squibb, second sizable acquisition in less than 3 months. In October, they agreed to buy Mirati Therapeutics to expand their lineup of cancer drugs. Today, announcing that they have agreed to buy, as you mentioned, their schizophrenia drug developer, Karuna Therapeutics, for $14 billion. Now, with this transaction, they gain a promising treatment that is approaching the market, up for FDA approval in September 2024. So far, the late-stage data has shown promise to sharply reduce harsh side effects. The drug is expected to bring in as much as $4 billion by 2030, according to Mizuho Securities. And the purchase highlights, according to those analysts, a buying spree for drug makers paying big premiums to bolster their existing pipelines or enter new areas. Now, Bristol Myers would pay $330 a share in cash for the Boston-based company. That's roughly a 53% premium. Karuna is pretty close to that, but there's still a spread, suggesting some investors think that maybe it doesn't get done.
Abby, thank you so much. Turning to earnings, Nike warning of weaker sales and pressure from a more cautious global consumer. Simone Foxman has more. Simone, what you watching?
Yeah, Lisa, we're watching shares down over 11% in early trading. And remember that this name had been up about close to 30% since its last earnings report. Just today, we've wiped out about half of that gain. We talked about some of the macro drivers earlier. That seems to be what's driving part of the stock, but let's dive a little bit into the financials as well. Earnings per share actually coming in ahead of estimates, $1.03 versus 85 cents anticipated by the street. Revenue, growth just a little bit shy of the overall expectation for the second quarter, 13.4 billion versus the 13.46 billion, but reduced revenue guidance for the fiscal year that ends in May, now looking to be just up 1% for the year, and that's really what's driven a lot of the concerns. Talking about a $2 billion cost savings over the next 3 years, that was what the executives were doing on the call yesterday, including simplifying the sneaker lineup, increasing automation, and of course dismissing workers, something that will contribute to restructuring costs of $400 to $450 million. Most analysts seeing this something like Bloomberg Intelligence does. Near-term challenge, long-term remains a strong, dominant player in the industry. Inventory as well, Bloomberg Intelligence pointed out, is in great shape, and that's contributing to margins. HSBC also put it well as they cut their price target for the stock by $7 to $113. Results reassuring from a margin point of view, but if you want to buy sales growth, look somewhere else.
Simone, thank you so much. Sticking with China, I had some concerns there. Investors caught off guard after the country unveiled new measures reining in spending and content in online games. Katie Greifeld has more. Katie, what you looking at?
Well, Lisa, Chinese gaming regulator on Friday, they did publish those draft rules really aimed at clamping down on practices that would encourage players to spend more time and money in online games. This part of China's fight, of course, against gaming addiction. Now, these draft rules, they include a sweeping set of curves on in-game rewards for frequent logins and purchases. And this is really stoking fears of another industry crackdown. You think about what we saw in 2021 from Beijing, and that really sent shudders through some of these gaming stocks worldwide. If you take a look at China in particular, you had internet giant Tencent plunging by over 12% or so. That is the biggest drop since 2008. And as you can see, peers such as NetEase and Bilibili suffering as well. It's not as much on the angst side if you look stateside. If you take a look at EA, Roblox, and Take-Two, they are seeing much more muted moves right now, really small moves in context, but definitely some of the names that you need to keep an eye on here as this continues.
Katie, thank you so much. Turning to tech, or sticking with tech, Apple stopping online sales of its latest smartwatches days before a U.S. ban will take effect. Ed Ludlow joining us from San Francisco with more. Ed, it seemed like the Christmas gift to Apple to force everyone to rush and buy Apple Watches. What's the latest in this front?
Yeah, well, Apple's trading completely flat this Friday before Christmas. Good morning to you, Lisa. The latest is that as of 3 p.m. Eastern time on Thursday, Apple stopped selling the Series 9 and Ultra 2 watch on its website. On December 24th, Christmas Eve, Apple will stop selling those series of watch in its physical stores, around 270 of them in the United States. The news being that the International Trade Commission did find Apple to be in violation of 2 patents relating to blood oxygen monitoring through the Apple Watch. What happens next? Well, a number of options. Apple is working on a software fix. Bloomberg has reported they could go to Massimo, the kind of other end of this patent dispute, and do some kind of licensing agreement, or indeed find a hardware fix. What Bloomberg's also reported is that if you are the owner of one of these generations of watches that's impacted, as of December 24th, you'll no longer be able to exchange it or get it fixed, essentially. The only model or variant that's spared from this is the SE, which doesn't have blood oxygen monitoring. Put into context that even in the most recent fiscal year, wearables and other home goods as a broader category is only 10 to 11% of sales. But it's a bit of a black eye going into the holiday season. Still, Apple up 50% year to date, and the focus of our colleagues on the Tech Watch column is going to be really hard to replicate that performance in 2024, because think of all the other crises this year. The stock up 50%, but increasing domestic pressure in China from domestic handset makers, worries about supply chain, this longer-term shift to India. What a year it's been to cover a company like Apple.
Indeed, Ed, and if you listen to Dan Ives, next year will be even more exciting with the company becoming a $4 trillion market capitalization. Ed, thank you so much. Invesco's Brian Levitt looking ahead to next year, writing, the merry bells are ringing with inflation coming down rapidly and the economy remaining resilient. It appears, at least for now, that the trip down the chimney will be a soft one. Brian joins us now. And Brian, I got to say, that couldn't have been written more perfectly for a day when we got the disinflation data that everyone was looking for, the strong durable goods orders that no one expected, and suddenly we're off to the immaculate disinflation races.
Yeah, it is. It's been a year where things have gotten better relative to expectations, very different than 2022. And to your point, inflation has come down rapidly, and we certainly expected that at the start of the year. But even more so, this economy's been resilient. I think a lot of people expected that we could even be in a recession by now, and the economy continues to be strong, and that's really a testament to the lack of leverage in the economy and the good fundamental strength that we continue to have.
All I can say, Brian, is that you deserve a victory lap for when you came on and you said, you know, I'm a FOMO kind of guy, and we all laughed, and yet a FOMO kind of guy was the way to go this year. Are you still a FOMO kind of guy?
I am, and I appreciate you remembering that. I am still a FOMO guy. I'm hoping I get some good calls for New Year's Eve. We'll see. But, you know, look, it's a market that is really appreciating peak inflation over a year ago, peak interest rates, peak tightening. And historically, that sets up a good backdrop for risk assets. It's hard to find an environment where markets did not do well over the subsequent years after peak inflation. And this seems to be very similar to that. It actually is quite reminiscent of the early 80s when we broke inflation, and many didn't believe it to be true, and yet the markets did very well over the subsequent years.
So the recent rally doesn't worry you? I mean, I feel a little bit like Grinch, because every time people come on and they're really positive and they talk about immaculate disinflation and everything going well and people keeping their jobs and us not having to experience pain, which is a wonderful thing. I think about, well, what if we get reignition of inflation? What about Nike? Is there going to be weakness? Is there anything that's clouding the horizons, or are you just basically looking for ways to get more bullish?
Well, right now, I mean, we're expecting to see at some point in 2024 a slowdown in this economy, not likely the end of the cycle, but a slowdown. So, but that's what the Fed wanted. So when we hear some economic data that suggests maybe things won't be as good 6-9 months from now, remember, that's what the Fed was trying to make happen. And so what will likely happen is you'll see broader market participation in the beginning of the year, much better than just the Magnificent Seven and very concentrated markets. At some point, the lagged effects of all of this tightening starts to happen, and we slow down. I remind people that equities tend to do well in a slowdown. You tend to want to shift towards higher quality rather than, you know, the riskiest names. But I think the concern is around that slowdown. Do investors start to fear that a recession is forming? It doesn't seem likely, again, given the fundamental strength of the economy. But all years have pullbacks, and if you do get a pullback in the middle of 24 or later in 24, amid slowdown concerns, it likely represents another buying opportunity.
Which is what we've been hearing from everyone. Any dips are buyable. Whether we're going to get a dip because everyone's buying them, we'll have to see. I am curious about this concept of cash on the sidelines. So many people are saying there is so much cash on the sidelines that markets can get a lot more ahead of themselves than we've already seen. And yet then everybody pushes back and says that's kind of a bogus rationale, because a lot of this money has gone from savings accounts and checking accounts just simply into money markets, and it's pretty sticky. What's your view on that?
Yeah, I think you're exactly right on that. I mean, we went from, I think, 18 trillion in bank deposits down to 17 trillion and 4.5 trillion in money markets up to around 6 trillion. So you're right, it came out of one and into the other, and rightfully so, given the higher yield. So I'm not expecting all of that to come flooding into the market. Although, you know, maybe other people start to get some FOMO like I do. I think one of the things investors should consider, those that love 5% in money markets, think about how you can lock some of that in. I mean, we've been saying that for months now, and I think November and December proved that. These yields could come down pretty quickly, so you have reinvestment risk. I'd like to see investors move out into longer maturity treasuries or corporates or munis and, you know, take advantage of those yields for longer than 30 or 60 days. As for the equity market, no, I don't expect it to come flooding in to the equity market, but you do tend to see some momentum in these moves. The market's clearly not euphoric yet, and again, I come back to the simple point that markets tend to do well in the aftermath of peak inflation and policy easing.
You said that it's important for people to lock it in, and we were thinking earlier this year, are you going to be worried more about the reinvestment risk or the preservation of cash risk? Are you saying that still at 3.85% on a 10-year, 3.86%, that it's still a good buy, that you could still see yields going materially lower from here?
No, I don't think materially lower. I think for, investors who were begging for 4% in 2019, and we had to say, look, you have to go out into high yield bonds to get 4%. I mean, today that you can get close to 4% in a treasury or own a core bond strategy or a core plus and augment it some from there. To me, that seems like a better opportunity than sitting around in cash. I'm not saying it's a big total return opportunity, but it's an opportunity to compound 4% yield, especially if we're going back to a 2% inflation world. And, of course, you can look to the municipal bond market if you want to do it tax-free. So, no, it's not a big total return opportunity. That started in the fall. I think a lot of investors missed it, as they often do. But now it's thinking about how you can compound income over time.
In the FOMO world that we seem to be living in, how much is it concentrated and isolated to the United States and not really allowing Europe and the rest of the world to participate?
Well, it feels good right now in the United States, certainly. But if you believe in the soft landing trade, then you should believe in increasing exposure outside of the United States. We're seeing the dollar weaken, which is almost always what happens in the aftermath of Fed tightening. And so you don't need to see the dollar weaken significantly. Just the end of what had been like a 12, 13-year strong dollar environment, just the end of that could have investors looking elsewhere for where opportunities may exist. Valuations, as we all know, are more attractive in the international and emerging market spaces. So if you believe soft landing, if you believe end of tightening, then yeah, international makes sense.
Invesco's Brian Levitt. Brian, thank you so much for everything this year. Have a wonderful holiday.
My pleasure.
Happy New Year.
Thank you.
Let those Berry bells ring as everyone welcomes in a potential disinflationary, immaculate, soft landing type of situation. Coming up, Red Sea trade still in limbo.
The Houthis need to stop these attacks. They need to stop them now. That's clear and simple. And they really need to ask themselves if they've bitten off more than they can chew when it comes to taking on the entire international community.
We've got team coverage on that coming up. This is Bloomberg.
When you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
I think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. We don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
it's very important to understand that the Houthis aren't attacking just one country. They're really attacking the international community. They are attacking the economic well-being and prosperity of nations around the world. So in effect, they've really become bandits along the international highway that is the Red Sea. The Houthis need to stop these attacks. They need to stop them now. That's clear and simple. And they really need to ask themselves if they've bitten off more than they can chew when it comes to taking on the entire international community.
The Pentagon weighing in on the Red Sea disruption following ongoing Houthi militant attacks. Over 20 countries agreeing to participate in the U.S.-led coalition safeguarding commercial traffic, which has slumped considerably as shipping companies scramble to avoid the vital trade circuit. Meanwhile, insurance costs and oil premiums pay the price. Our tween coverage starts now. Kaylee Lyons in Washington, D.C., Javier Blas in Madrid. Javier, I want to start with you. We've been wondering why oil prices have not been responding very much at all to either what we saw with the Hamas-Israel war or what we're seeing with respect to the Red Sea disruptions. What do you make of that?
Well, it's as simple as there is too much supply on the market. U.S. shale is growing to record highs. Production in Brazil is very strong. The growth of the industry in Guyana is also very strong, as is Canada. It's just American oil production from the north all the way to the south is booming, and that is really what is putting a cap on oil prices, despite every attempt of the geopolitics and OPEC to push prices higher.
Do you have any sense, Javier, that that's going to stop, that we're going to see any sort of decline in production, or could it even increase further from here?
I don't think that we are going to see a decline in U.S. production at all. What we may see is a slowdown on the rate of growth as we go in 2024. But in general, the whole oil market, myself personally, we got it wrong in 2023. We thought that American oil production was going to slow on the rate of growth. It didn't. It is growing at a remarkable pace, despite lower prices that we have anticipated. And therefore, I think that making the same bet going into 24 that things are gonna get slow, it's very risky. I think that it will slow, but I'm very open to the idea that I could be very wrong.
This is the reason why I think a lot of people are looking out to next year with a huge question mark around oil prices. Kaylee, given the fact that we haven't seen a disruption in the market side of things, has that made it a less of an urgent issue for the White House that has been vocal about creating a coalition to combat some of the threat that the Houthi militants present?
Lisa, I would say the White House still very much views this as an urgent threat. I apologize, Javier, but to your point, Lisa, they have really reinforced this maritime coalition, this task force that the Pentagon says now has 20 nations that are involved. The Pentagon describes this as a highway patrol of sorts, Lisa. Effectively, what they're doing is trying to deter and defend, doing things like shooting down incoming drones and missiles from the Houthis, also coming to the aid of ships that need it. But there is an ongoing conversation, according to Bloomberg's reporting, about whether or not this is enough to actually neutralize the threat and allow merchant traffic to continue in the Red Sea once again, or whether offensive measures might be needed, direct strikes potentially on the Houthis. There are a few concerns there about that, though. One being that it could be escalatory, as the Houthis are a proxy for Iran. The other being how Arab allies in the region might react, knowing the Saudi Arabia specifically has been subject to retaliatory attacks from Houthis in the past that have damaged severely their energy infrastructure. And I would note I spoke with Congressman John Garamendi yesterday. He's on the Maritime Transport Subcommittee in the House of Representatives. He used to chair it, in fact, and he noted the Saudis tried for 9 years unsuccessfully to go after Houthis and damage their ability to conduct these kind of operations. He doesn't think the U.S. would necessarily be any more successful.
And meanwhile, we're also talking about the potential for other escalations as well. Kaylee, you are planning to speak with a chief economic advisor to the president later this morning. What are the key concerns that you plan to address with her?
Well, especially in light of inflation data that is going the way, Lisa, as we saw this morning, the White House would want. How great of a risk in their mind is there that it starts to reverse once more, given some of what we are seeing play out in the Red Sea, not just in terms of what it could mean for oil and energy prices, but also just supply chains potentially getting snarled, as a lot of these ships now have to go around the coast of Africa and add time to their journey. So we'll get some perspective on that, as well as the fiscal situation here in the U.S. As when Congress returns in just a couple weeks, we're going to be dealing with a real real showdown on spending. So there's a lot to talk to her about.
And Javier, before we let you go for the new year, what do you see out of China in terms of demand? This has been a huge question that I just don't have a good answer to.
At the moment, I don't see any particular bad situation in China on demand or more generally worldwide. I know that there is a lot of focus on the market about talk about weaker demand going into 2024. It was a recurrent theme also in 2023. I think that the demand is fine. Yes, it's going to slow down in 2024, coming back from a massive recovery in 2023 from the COVID era. But the 1 million, 1.1, 1.2, 1.3 that we are going to get next year is within the typical average for the last 20 years. So demand is fine, supply is the problem.
Javier, Kayleigh, both of you, thank you so much for this and for all your great work this year. And don't miss Kayleigh alongside Guy Johnson in conversation with National Economic Council Director Lael Brainerd at 11:30 a.m. Eastern. Coming up, the market-moving events that you need to be watching. That's next in our Trading Diary. This is Bloomberg.
The reception, the acceptance of Puro Sangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro Sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
This is Bloomberg.
Time now for the Trading Diary. What you need to be watching this week. New home sales coming at the top of the hour, plus the U.S. bond market closing early at 2 p.m. Eastern. Monday, a ban on Apple's latest smartwatches will go into effect, and markets are closed for Christmas Day. Thursday, another round of jobless claims. This was countdown to the open, with markets rallying for an 8th straight week. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears. Bankman-Fried had pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries? Soft landing, hard landing, no landing? I don't know. True. What the heck does that mean? I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in on that Nike story. Disappointing results, disappointing outlooks and problems in China, EMEA. Poonam Goyal, senior analyst for Bloomberg Intelligence. She covers all the retail stuff. She's going to join us here. Plus, Robert Schein, managing director and partner at Blank Schein Wealth Management, will give us his call. Tony Bancroft, portfolio manager at the Gabelli Commercial Aerospace and Defense ETF. He's going to talk to us about what's happening in his part of the markets. But first, we're going to kick things off here on this this hour with Nathan Hager down in Washington, D.C. for Bloomberg Business Flash.
We'll start off with the latest economic data. The final read on December consumer sentiment from the University of Michigan came in slightly better than expected. And check out the one-year expected inflation expectations for December, 3.1%. That is way down from an earlier reading of 4.5%. Now, we did also get some new home sales figures for November. They came in below all estimates at 590,000. The average economists were expecting 690,000. But it's this read on the Fed's preferred inflation gauge, the PCE deflator, that's rallying stocks this morning. Ed Yardeni, president of Yardeni Research, has been out in front with a 6,000 price target for the S&P 500 for 2025. In the short term, though, even Ed Yardeni says the market's maybe getting a little too excited.
At the beginning of the year, I was talking about 4,600. That wasn't bullish enough. We're already above that for the end of this year. And then I'm looking for 5,400 next year. And now there's more people talking about over 5,000. And then for 2025, I'm talking about 6,000. So I think I'm bullish enough.
And you can hear more from Ed Yardeni of Yardeni Research on the Bloomberg Surveillance Podcast. Let's check the markets right now as we do all day long here on Bloomberg. Right now, the S&P 500 is up 21 points, a gain of about 0.5%. 4767 is the S&P level. The Dow Jones Industrial Average up 96 points, or about 0.25%, 37,498. And the NASDAQ Composite is up 62 points, or 0.4%, at 15,026. 10 of the 11 main industry groups in the S&P 500 are in the green. The only laggard is consumer discretionary. Big reason for that, Nike shares. They are leading declines, down 10.5% after flagging $2 billion in cost savings it's going to be looking for in the later part of the year. 10-year Treasury right now is up 3/32 for a yield of 3.87%. The 2-year is at 4.31%. NYMEX crude is up 1.25% at $74.81 per barrel. COMEX gold is up 1.5%, up $31.30 at $2,082.80 per ounce. The euro is at 1.1040 against the dollar. British pound 1.2735. The yen is at 142.01. That's a Bloomberg Business Flash. Bloomberg Markets is on with Paul Sweeney, and I believe it's Simone Foxman.
Nice. You nailed it. Nathan Hager, thank you so much. We appreciate that. Simone Foxman.
It is. It was the surprise.
It was the surprise.
We kept
There
people
you go.
waiting. There
Absolutely.
you go. Happy to be back with you, Paul.
Awesome. Simone's going to be here for the next 3 hours as we drive you through here some of this morning trading here. Simone Foxman, Paul Sweeney, we're live here in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio, and that's where you will find the program. We've got some green on the screen here. This could be week 8 of gains for the markets here. The S&P up about 0.5% here. Let's check out where the action is under the hood. Elena Popina joins us. She covers all the markets for Bloomberg News. She joins us live here in our New York City headquarters studio. We're about the only folks here in the building, but we're here. Elena, what do you got for us?
Yeah, guys, a lot is going on under the hood. It's quite a bit of a downdraft in the China gaming industry. That is the biggest mobile gaming arena in the world, and China just unveiled a set of new rules curbing the industry. Tencent is down about 5%, Prosus and V is down about 20% in Amsterdam. Some of the peers are trading lower across the belt, across the curve. The concern is that there could be some more regulations to come, and that would impact the industry that has been quite thriving in China and in broader Asia. So that is one sector that
I don't know. When they started cracking down on the tech companies a few years ago, I talked to guys like Damien Sassower, the emerging markets analyst at Bloomberg Intelligence, and I'm like, I know China's a huge part of the MSCI, but how can you invest there? I mean, I just don't know what the government's going to do. First, it was just broader tech. Now it's the gaming. You just don't know that.
But the trick is when China wants to support one of the industries, that.
But even that, it's a complete total surprise at times, not always. But it's not like the FTC comes in and signals, oh, mergers are going to be more challenging. That they've communicated that. No, it's
the concern is a big one. China wants to limit how much people are spending on online video games, how much they are spending on their time, how much they're buying, and making in-app purchases. So that. There is no way to control that, and there is no way for companies to say what the impact on top line and bottom line is going to be. So that's quite
I think if you talk to any parent anywhere around the world, they would say the same thing. My kids are spending too much time, on games, online, things like that. But, I guess the difference is in China, the government steps in.
Yeah.
And you can control it, too, to a better extent, perhaps, than in the United States.
I don't know. It's just tough to be an investor, I think, in China. I grew up in an era where China was just really a tremendous opportunity for growth, and we saw all types of different industries invest in China. The most notable would be Apple. But you think about the risk now in that government. It makes it difficult if you're an investor, an emerging market investor. How do you gauge the risk there? I don't know. It's very, very difficult.
And China, mind you, was supposed to be one of the biggest of the reopening trade. It was supposed to be one of the gainers so far this year until all of the regulations kind of turned the sentiment around.
I was at a meeting recently down at Duke University, and I was pitched. This is a year and a half, 2 years ago, maybe just when this whole China crackdown on some of the technology companies several years ago, which is turn to India. India, you think China was good over the last 20 years? How about India over the next 20 years when you have a relatively supportive government? You think about all the growth dynamics that drew you to China. a very similar situation exists in India with, presumably a more helpful and supportive government. The next 20 years, all about India.
And the government there, importantly emphasizing its ties both with China and the United States, so potentially getting in on that. Let's continue, I guess, a little bit with this China theme. So we heard Nike's earnings come out yesterday afternoon. Everyone realizes, wow, the outlook is way less optimistic, especially in China. And then this is sort of played out around the world. What are we seeing, Elena? How's this playing out today?
So we are seeing repercussions across the globe, from Puma and Adidas in Europe to some of the China athleisure companies in the broader Asian markets, to some of the U.S. companies like Lululemon, Under Armour. All of these companies are down because China is supposed to be the bellwether for the global industry, and if the athleisure industry isn't doing so well, and if the the outlook is quite grim to flat at best, so that sends a bigger question of whether Puma should be concerned and whether Adidas should be concerned. These stocks have had their own set of issues internally, but there is a big overarching theme of like how saturated the market is going to be.
I'm a Nike person. Are you a Nike person?
Not really.
Do you have a brand loyalty on your shoes?
Yes.
First of all, do you call them sneakers or tennis shoes?
Sneakers.
Yes, sneakers.
Yes.
Okay.
Okay.
A lot of people, a lot of parts of the country, it's
I'm a
tennis shoes.
millennial here. It's sneakers.
I don't think it's age. I think it's regional. Like in the South, tennis shoes.
Tennis shoes.
Tennies.
My husband is from the South. He does not call them tennis shoes.
Really?
For what it's worth.
Okay, good to know.
But what's interesting in the market today? We're seeing names like Foot Locker down 4.5%, Under Armour down 5%, and yet Lululemon kind of holds up. There does seem to be a distinction between certain retailers and certain manufacturers who seem to be more best in class, and then others who get more hit by these periodic.
Correct, best in class. Yeah, Lululemon, is targeting a more wealthy audience. The audience that doesn't, suffer so much from the impact of inflation, doesn't suffer so much from, shrinking wage growth. So Lululemon, has obviously had its own set of issues. But some of the companies that target, audience that maybe not spending the top dollar on sneakers, like Crocs, Puma, these guys are down, flat to down. Again, the broader market is kind of turning higher at this point. So, it's going to be an interesting story to see these losses hold until the market close.
All right, Elena, thank you so much. We appreciate that. Elena Pupina, equities reporter for Bloomberg News, joining us here in the Bloomberg Interactive Broker Studio. We can break down this the story here on Nike with Poonam Goyal. She is the retail analyst for Bloomberg Intelligence. She follows this stuff. She's done it for decades. She knows what's happening. So, Poonam, thanks so much for joining us here. Is this a Nike issue? Is this just a reflection of the consumer? What's going on?
It's definitely not a Nike issue. It's more a reflection of the consumer and just the macro environment that we operate in. When you look at the results that Nike posted and you just look at the different geographies that they operate in, the miss was really in two geographies. One was China and two was EMEA. Now the China miss, consensus was looking for a 12.5% increase on sales in constant currency. They posted an 8% increase. That's not so bad. I mean, it's definitely, behind consensus, but 8% growth is still pretty respectable. Now, when you look at EMEA, the negative 3% that we saw there versus an estimate for a low single-digit gain, there I think, weather was really the culprit on apparel sales, which hurt them. And that's something that we wouldn't be too concerned with when we think about Nike for the longer term, because those kind of situations ebb and flow.
All right, so here we go. Hold on. Let's go to I'm going to go back to an earlier issue we were discussing, Simone. Tennis shoes versus sneakers. And Eric Malo, our producer, popped something in the chat here. A map showing the United States and where people call it tennis shoes and where they call it sneakers. So like the Northeast, kind of like from Pennsylvania up to the Northeast, sneakers. Southern Florida, sneakers. The rest of the country, including Alaska, tennis shoes.
I don't buy it.
You don't buy that?
But Poonam, what do you call them?
I call them sneakers.
See, Poonam's the expert. She's the expert.
That must be an interesting conversation to have at industry events.
Well, in Chicago and Cincinnati, you might lace up your, quote, gym shoes.
That I've heard, actually.
You've heard gym shoes? Okay. I'm sneaks. sneakers, that's the way you go.
Poonam, I want to get your sense, how much is this a story of sneakers? How much is this a story of apparel? And how much is this athletic wear? And how much is this a story of overall apparel?
Sure. So I think the bigger story here, which has been the story for some time, is broader apparel weakness. Now, we have seen this across the board because inventories were too high, and that's what caused apparel to be marked down. Now, the other thing with apparel is versus footwear is for Nike. Nike is dominant in footwear, but when it comes to apparel, they don't have that lead that they have in footwear with rivals. So it's anyone's game when it comes to apparel, and Nike has to fight for its share. So it's definitely a tougher marketplace. Though when it comes to footwear, I think they do have a lead. I think it comes back to innovation, which they're pressing the pedal harder on, and that will continue to really help them maintain that lead. So footwear, I do think they're very strong in, and you could argue that, there's been competition from companies like Hoka and On, especially on the running side, but those brands are very small. When you look at Nike's footwear market and its size there, it's multiple folds of those smaller brands. And we don't see them losing that lead, especially with Jordan, right? Jordan's positioned to be the second largest global footwear brand or athleisure brand in the world, and that says something for the Nike flagship.
But we also heard Nike introducing about $2 billion worth of cost cuts over the next 3 years. Will that impact innovation?
I don't think so, because the cost cuts are not going to be to limit innovation or to really reduce spending on innovation. They're really happening on the operations side, where they may have had redundancy and they're cutting back staff, or they're just reorganizing to make matters more efficient. It's more about driving efficiencies. So you could argue that, maybe they were too layered to start with, and now they're just peeling off those layers. I don't think this will impact their roadmap for innovation to drive newness into the business, especially in footwear.
So Simone, Poonam's one of the top retail analysts on Wall Street. Her job, a big part of her job, is literally going to shopping malls and just watching people. What are they buying? What's hot? Where's the traffic going? How are the promotions out there? And we actually pay her to do this stuff. Poonam, what are you seeing here on this holiday shopping? What's your outlook here for holiday shopping overall?
I think we're going to have a really good holiday season, Paul. Irrespective of what we have heard about the U.S. consumer and how they're shopping, where they're shopping, the stores are crowded. People are buying stuff online. Trucks are being seen all over the U.S. delivering multiple boxes. Lobbies are full. So it will be a good holiday. The question is, what happens after holiday? Do we go into a lull? Have you bought everything that you wanted and now you're just going to take a break? And that's really what we'll see into 2024. But for now, people are spending. They're using more buy now, pay later mediums, alternative payment mediums, to facilitate the spend, which is also something we'll be watching for. But holiday spend online, in stores, looks robust, especially at the key that have done a good job in just, harping their value message and also driving unique product into their stores and online businesses.
Are there any sectors of the broader retail space that may benefit going into next year? What's your take on that?
I think the online retailers are well positioned going into 2024 because now things have normalized where, we were past the pandemic and people went to stores that wanted to go to stores. They have that experience there. But now convenience comes back into play. You want to be able to shop from your home, shop from wherever you want, and just have things delivered to you, especially as things are coming faster now with 2-day shipping, 1-day shipping, with Buy with Prime that's being rolled out to companies that don't typically sell on Amazon, but to be able to use that service. So we do think that consumers will lean back a little more on digital in 2024 than on stores.
All right, Poonam Goyal, thank you so much. We appreciate that. Poonam Goyal, she's a senior retail analyst for Bloomberg Intelligence, one of the best on Wall Street, giving, again, a sense of kind of where the trends are for consumers and what retailers are best positioned to meet those. So check out Bloomberg's, Poonam's research on Bloomberg Intelligence. You can go to BI Go on the terminal and get all of the research from Bloomberg Intelligence, including Poonam stuff here. So it's good stuff. And calling for a decent holiday. Are you done your shopping?
Which is interesting because, traffic in store was so lackluster, it seemed like, on Black Friday. No, I have not done all my holiday shopping.
So you need to get going there. I need to click a few buttons myself. I'm actually waiting for a couple of things that have not been delivered. One by Amazon and one by another retailer. So maybe some supply chain issues out there. Logistics. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. Drug maker Bristol Myers Squibb has reached a deal to buy schizophrenia drug developer Karuna Therapeutics for $14 billion. Bloomberg's Abigail Doolittle has those details.
They gain a promising treatment that is approaching the market up for FDA approval in September 2024. So far, the late-stage data has shown promise to sharply reduce harsh side effects. The drug is expected to bring in as much as $4 billion by 2030, according to Mizuho Securities. And the purchase highlights, according to those analysts, a buying spree for drug makers paying big premiums to bolster their existing pipelines or enter new areas.
Bristol Myers Squibb right now, they're up nearly 3%, but Karuna Therapeutics, they're up 47%. Now, some concerning news for the popular obesity drug market. Bloomberg's Denise Pellegrini has that story.
The Food and Drug Administration has seized thousands of units of counterfeit Ozempic. They say this is fake versions of the diabetes drug made by Novo Nordisk that's been adapted into a blockbuster weight loss treatment so many people are taking. The FDA is asking advised wholesalers, retail pharmacies, healthcare practitioners, and patients to check the product they have received and not distribute or sell products labeled with certain lot and serial numbers.
Novo Nordisk down about 0.7%. And drug makers have a new strategy to get around President Joe Biden's plan to lower medication prices. Companies like Roche Holding are slow-walking products, suspending clinical trials and shifting timelines. The industry says pricing constraints hurt innovation, but meanwhile, patients, well, they'll just have to wait longer for new therapies. Roche shares right now, they're up about 0.2%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Coming up to 10:22 on Wall Street, I'm Nathan Hager. Stocks are on track for an 8-week bull run. Inflation readings are firming up Wall Street bets for rate cuts as soon as March. Treasuries are mixed ahead of an early close this Friday before Christmas. We check the markets all day long here on Bloomberg. Right now, the S&P 500 is up 20 points, or 0.4%. The Dow Jones Industrial Average is up 77 points, a gain of 0.2%. The Nasdaq Composite is up 0.4%, or 63 points. 10-year Treasury little changed at 3.88%. 10 of the 11 main industry groups in the S&P are in the green. The only laggard is consumer discretionary, led lower by Nike. Those shares right now down 11.4% after the athletic apparel maker said it's looking for as much as $2 billion in cost savings by cutting jobs and streamlining its lineup. Some of its competitors are lower as well, including Under Armour, Dick's Sporting Goods, and Foot Locker. They're all down anywhere from 4 to 5% right now. NYMEX crude is up 1%, up 77 cents at $74.66 per barrel. COMEX gold is up 1.4% at $2,078.90 per ounce. The euro 1.1029 against the dollar. The yen 142.19. Biggest gainer on the S&P right now is ANSYS. It's up more than 8%, nearly 9% actually. Sources tell Bloomberg the engineering software providers weighing options, including a sale after getting takeover interest. ANSYS makes simulation software for rockets and airplanes, so kind of a cool company. That's a Bloomberg Business Flash. Bloomberg Markets continues now with Paul Sweeney and Simone Foxman.
All right, Nathan Hager, thank you so much. We appreciate that. Simone Foxman, Paul Sweeney. We're live here in the Bloomberg Interactive Broker Studio. Doing a streaming thing on YouTube, so you can go to that internet. Go to youtube.com, search Bloomberg Radio, and that's where you'll find us. Let's talk about these markets continuing to rip here. I think we're going to have 8 weeks in a row of gains in the S&P 500. What a way to end the year. What do we do going forward? Robert Shine joins us. He's a managing director. He's a partner at Blank Shine Wealth Management, Palm Beach, California, right?
Palm Desert, California.
Palm Desert. What's it? Oh, yeah. What was I say? Palm Beach.
So
You're Palm Desert.
Yeah.
And in the summer, how desert-like does it get?
It gets pretty hot in the summer. You don't want to be there. It's 120 degrees at times. Cow. And add in some humidity, so you want to get anywhere but there.
Wow.
But you stay. You go through the pain.
It's worth it, because then you have to go through that to get to just beautiful weather right now. 70 degrees, sunshine. Today at home it's raining, but majority of the time it's absolutely gorgeous in Palm Desert, California.
Awesome. Hey, Robert, what do we do with these markets here? I mean, we've had just a phenomenal year if you look at the S&P 500. What are you telling your clients here these days? Because it's been a heck of a year, really.
It's been a wonderful year, and it's been unexpected, right? For the first 8 months of the year, if you follow, aside from the Magnificent Seven, right? That's majority of the total returns that we've seen year to date. There's 493 other stocks that haven't participated. What's been welcoming of late is now we're seeing the market rally broaden with some significant sort of breadth, which could set up really well for 2024.
Yeah, you look at the Russell 2000, now up 15.5%. It wasn't that way the whole year. We've heard from Nike yesterday afternoon about these warnings about the broader global consumer. Does this concern you, that the consumer that has led this economy for so long is suddenly feeling a little bit of a pinch?
It definitely could be the canary in the coal mine. Because you have to pay attention to a global leader like Nike on the retail side. They're on the forefront, right? They have their pulse on the consumer. And we know that the U.S. economy is 2/3 is the U.S. consumer. So the question is this an indication that the Fed, right, has really dug into the consumer's pocketbook in terms of, just everything costing more? Let's say if inflation now takes everything down, let's say your sneakers, if you will, come down, they're still putting that on a credit card. So that's 21% interest rate, and that's catching up to the consumer. So that could be a concern going into next year.
All right, so what do we do about next year? I mean, Simone's been in the Magnificent Seven stocks all year. She's riding it right to the bank. Me, not so much. Do I chase Simone and try to get these Magnificent Seven stocks, or do I try to find stuff that maybe just didn't participate in 2023?
Yeah, this is a perfect opportunity to sort of, take some off the top and rebalance, strategic rebalance. We do that for our clients all the time. We love selling into the strength of what's working. It's also dollar cost averaging into what's not working. Year to date, we're looking at stuff where we're allocating into sectors that haven't participated as much. Let's think about this like energy, even financials, but energy specifically. We like Occidental Petroleum, and they haven't participated. They're even down about 4 or 5% year to date. But you look at the likes of who's actually, who you're investing next to. Warren Buffett, right? He's now accumulated about 28% shares of the total outstanding shares of that company. The question is why? So he's been allocating dollar cost averaging all the way. And if you look at the participation of what energy is relative to the S&P earnings, energy is going to catch up again, and they're going to start over-contributing, sort of punching above their weight.
Is there a fundamental energy story looking forward? Because, shale production has gone crazy this year, despite OPEC, cutting their production. Is there a fundamental fundamental energy story of a reason you should be invested in specific names.
Well, going back to OPEC, I mean, one of the reasons why Warren Buffett's doing it is also national security, right? It's the United States play. I mean, they just took over another one of their largest competitors on Oxy, and they're consolidating. Now they have about 13 billion barrels a day. But on a global scale, to your point, yeah, you look at the geopolitical tensions in the Red Sea right now. That's 12% of the shipping. Of just not only consumption but also oil, so that could be a sort of a catalyst for oil into the next year. But also look at what oil has been able to do with OPEC, cost controls, price cuts. They're going to get a handle on putting a bottom under oil, we believe.
Google is also one of the names you call out here. It's a name I know pretty well. It's at a 52-week high today, a little bit shy of its all-time high. But it's had a nice bounce over the last 12 months. What's your thoughts there on Google from here?
Yeah, Google, again, out of the Magnificent Seven, they are sort of, I would say, late to the game, but they still have room to run, right?
Okay.
And so with Google, there's so much going on. A couple of, about the last couple of years, they've been doing a lot of internal restructuring. Now their top line and bottom line revenue are both trending in the right direction. So revenue growth and operating efficiencies of 57%. Coupled with next year, you're going to add in, let's say a political year, more sort of activity on the ad spend, right? That's about 10 to 12 billion in the U.S. alone, and Google will get a fair share of that. Obviously, there's some antitrust issues here and there, but at the end of the day, even if they're broken up, right, the baby bells in the early 80s, think about that. That unlocked tremendous shareholder value moving forward. And if they're not, you still have a great diversified business right there, even with Google. And obviously, the AI play is in the early innings.
The other big play this year, and I know this is one of your recommendations, has been GLP-1s, these diabetes turned weight loss drugs that seem to be game changing. You like Eli Lilly. We've seen an absolutely phenomenal run in their shares so far this year. They're up 56% to date. Why do you like it from here?
Yeah, Eli Lilly, their competitor Novo Nordisk. If you own both of them, you're owning the total addressable market. Right now, think about that. If you combine both of them, it's about $15 billion today. It could go up to $150 billion by 2030. And so both of those stocks have tremendous sort of runways ahead with regards to what the market is out there. And it's not just for vanity anymore, right? Obviously, you've seen the headlines with Oprah, or maybe the Kardashians are sort of on this train, right? No one really knows, but I think Oprah has basically disclosed that earlier this week, or last week specifically. That being said, there's also a lot of health benefits. And that's what makes this story even more interesting, because then you're going to bring in the healthcare providers such as insurance to support that. And if that happens, it's tremendous. There's heart health as well as Alzheimer's.
Well, are there any other names other than Eli Lilly and Novo Nordisk that you are, tiptoeing around? There was a report about Amgen and its potential drugs. Pfizer's tried to get in on there. Anywhere else? Any other names in the healthcare space?
At the end of the day, if you look at what we discussed before, what's not participating in the market, right? Large cap value. So that's healthcare again, right? Energy, healthcare, financials. Those look sort of attractive from a valuation standpoint. If we believe that the market would broaden out, which we do for 2024, you want to rebalance and add some, again, healthcare to your portfolio, such as, let's say, Pfizer as an example. And also, they pay a good dividend, right? So you get paid while you wait.
What do your clients ask you about crypto? And if so, what do you tell them? Like in terms of exposure?
First, personal disclosure, never invested in crypto.
Yep.
Don't own it.
Yep.
And my clients are older, retired.
Right.
So they're retired. They like being retired and they want to stay retired. And so, not to say that crypto is not that asset class that's interesting, with our kids and everything else in the future as sort of an alternative to take a look at. But just for us right now, we're just not in that space.
Well, for retired folks looking for income, you can actually go fixed income these days. So how do you kind of talk to your clients about that?
So fixed income is sexy again.
Yep.
I constantly use that line simply because we haven't seen sort of 4 to 5%. Obviously, we saw treasuries over 5 for quite some time. We did lock in a lot of U.S. treasuries And I know that it's not so, on Wall Street, they basically say, oh, well, that's just boring. But boring's good, especially when you're trying to sort of just compound wealth. And it's not a bad place to be. We also use that cash, right? It's a cash liquid alternative to strategic rebalance. So we believe there's going to be more volatility ahead in 2024. There hasn't been that in this past, trading year. So when that happens, we strategic rebalance. We take advantage of some opportunities, dislocations in the market. And so long term, it really helps out for our client total return.
All right, Robert, thank you so much for joining us.
Thank you for having me.
Really appreciate it. Robert Schein, he's a managing director partner at Blank Schein Wealth Management, and he had a Kardashian-like entourage come in with him to the Bloomberg office today. I mean, it was like, I think there's like...
I hear it's family as well.
Yeah, a whole brood of kids, right?
And adding to the New York economy.
Yeah, it's right.
Staying the whole week for us.
Exactly. We love that kind of stuff here in New York. Right now, let's head down to Washington, D.C. We got world and national news with Amy Mars.
All right, thank you, Paul. Sorry, that was odd. The U.S. is signaling it would support a resolution as the United Nations Security Council would increase aid flowing to Gaza after drawn-out negotiations threatened to defeat the measure. More on this now from Bloomberg's Bill Ferries.
You've seen the U.S., particularly for weeks now, trying to straddle this divide between signaling its support for Israel and saying it has, continues to have the right to defend itself after those October 7th attacks by Hamas, but also signaling its real concern about the rising civilian death toll.
Bloomberg's Bill Ferries reporting. Meanwhile, a group representing hostage families says an American dual national seized by Hamas on October 7th died in captivity. Gad Haggai is the latest confirmed fatality among hostages held by Hamas in Gaza. He's 73 years old. He was abducted along with his wife, Judith, who is 70. She is thought to be the oldest woman remaining among the hostages. His kibbutz community says his body is still being held by Hamas in Gaza. The U.S. is preparing to lift a ban on weapon sales to Saudi Arabia. Officials tell the New York Times the Biden administration is prepared to relax some restrictions after taking note of Saudi Arabia's de facto ceasefire with the Houthi militia in Yemen. The White House has announced new plans to go after banks that make it easier for Russia to fund its war machine. Bloomberg government White House reporter Courtney Rosen.
Well, the system that brought the heavy rain to pour.
The Kremlin has found ways to get around the current sanctions that are very significant. Russia has found ways to use banks to facilitate payments, and the U.S. wants to target those banks.
Bloomberg government's Courtney Rosen in Washington. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
$10:40 on Wall Street. I'm Nathan Hager. We check the markets all day long here on Bloomberg, and right now the S&P 500 is up 21 points, or about 0.4%. The Dow Jones Industrial Average is up 0.2%, or 87 points. The Nasdaq Composite is up 70 points. That's a gain of about 0.5%. So stocks are firming on track for an 8-week bull run, after the Fed's preferred inflation gauge came in a little bit cooler than many economists were expecting. But Michael Gapin, head of U.S. economics at Bank of America Securities, says the market had largely priced in a softer core PCE.
With the CPI data in hand and the PPI data in hand, we can make a pretty good projection of where PCE should come in. And we did expect the headline to be down a tenth and the core to only be up a tenth. So this number really wasn't a surprise to us. And if you do the implied CPI forecast from market prices, they're looking for pretty soft inflation over the next 3 to 6 months.
And you can hear more from Michael Gapin of Bank of America Securities on the Bloomberg Surveillance podcast. Checking treasuries right now, not a whole lot of movement with an early close on the way for bond traders. The 10-year is little changed at 3.88%. The 2-year's at 4.33%. NYMEX crude is up 0.5%, up 40 cents now at $74, I should say. $74.32 for a barrel of West Texas Intermediate. COMEX gold is up 1.1%, or $23.40 at $2,074.70 per ounce. The euro, 1.1020 against the dollar. The pound is at 1.2727. The yen at 142.32. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Simone Foxman.
All right, Nathan Hager, thank you so much. We appreciate that. Simone Foxman, Paul Sweeney, we're live here in the Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so head over to youtube.com. That's the internet, and search Bloomberg Radio. Got a couple, at the very least, hot wars going on. One, obviously, in the Middle East and Ukraine and some other hot spots around the world. So presumably, that means some demand for the folks in the commercial aerospace and defense industry. So let's break that down a little bit with Tony Bancroft. He's a portfolio manager at Gabelli Commercial Aerospace and Defense ETF Funds, over at our good friends at Gabelli Funds. Tony is a lieutenant colonel in the United States Marine Corps, so we thank him sincerely for his service. He's a graduate of the Naval Academy and got his Columbia MBA, so good stuff there. He's been with Gabelli for a while. Hey, Tony, thanks so much for joining us here. Kind of what's the call here for your coverage here of aerospace and defense? Again, unfortunately, it's an unsettled world, so presumably there's a lot of demand out there.
Yeah, thanks for having me, Paul and Simone, and happy holidays to you and everyone. I think the call for defense is probably, all things being equal, unfortunately, probably higher for longer in general. What we've seen since February of 2022 up to today is just relatively more geopolitical instability, obviously beginning with invasion of Ukraine, and then October 7th, the conflict in Israel and Hamas, and then just obviously recently with the Red Sea and the issues around the Horn of Africa with shipping. So I think all things being equal is what we're in. Of course, you heard what President Xi noted the other day about about Taiwan eventually realigning with China in the long run. So obviously there are near peer threats and are facing threats, and we're probably just going to see more of the same, all things being equal. And the U.S. is obviously has buttressed that with increased defense spending. Over the last 5 years, our CAGR is about a 5%, well above
Tony,
global GDP.
Can I ask you about some of the negotiations that have been going on in Washington, D.C., Republicans appearing to block more funding for Ukraine without some sort of deal on the U.S. border. How does this play out for you? Because this must be an important catalyst for the companies you cover.
Right. So, the budget was passed by Congress with about a over 3% increase in funding, and that's in line with the president's budget request. And then inside of that, the investment accounts, which are what in general what the defense industry focuses on, procurement and research and development. Those were above that. They were coming in at a high 3% increase. So you're seeing still strong spending even without the supplemental spend agreement for Ukraine and Israel. And I think all things being equal, eventually that's probably that is going to work out in some capacity, and you're going to see increased spending there. And that's not even taking into account the increases that NATO you've seen over the last 2 years of spending increase there. And just put a number on that. If you were to actually spend at a 2% clip, NATO, the 30 members would be about an increase of 80 billion, a little over 80 billion annually. So that's a 7% increase in NATO defense. And global spending is about 2 trillion in defense. Of that, NATO's 1.2, and the U.S. is almost 900 billion. So it's a big number.
But with respect to that global spending, I guess the concern that a lot of commentators on this subject have raised is that the U.S. Challenges in passing this Ukraine aid will lead other countries to potentially curtail their own support for Ukraine. When you look to the United States, European allies, do you think that that's likely to happen given the conversations, the negotiations that we've heard and the headlines that you've seen so far?
I guess that's probably unclear how that's going to work out, but I would say that, the U.S., NATO, except for essentially except for the U.S. and, continental North America, NATO is in the footsteps of it's a lot hotter there than it is here in a sense. So I think NATO has definitely been energized, and I think that's probably going to overall in the long term continue. I don't think NATO obviously likes the actions of Putin, and I think in the long term it's definitely a changed organization post events of February 22.
So Tony, what are some of the names that we should be thinking about if we're we're kind of looking at some of these macro tailwinds?
Yeah, I mean we like we can there's obviously two pieces of where I cover commercial aerospace and defense. Boeing's is a good right in between those. They've got a huge tailwind with the amount of commercial air travel that's been going on and the demand for aircraft. And on top of that, they've got some great defense businesses which are going to see increased spending. I think they're a great opportunity. And as well as a company like Textron, they have a very large defense business, and they just recently won a large contract to replace the Black Hawk helicopter as the world pivots to the Pacific, or at least the U.S. pivoting to the Pacific, needing longer range aircraft, which is what this replacement does. So I think there's a lot of good ideas in defense and then commercial aerospace as well.
Tony, I got to ask you, you flew F-18s for the Marine Corps. Why would you land on a boat when you can land on a nice long, runway like a good Air Force pilot? What's wrong with you people?
I don't know. I wasn't smart enough to get into the Air Force. That's the reality of it. I got stuck flying fighters in the Marine Corps, but. No, it was a great experience. It's a lot of fun. I wouldn't say at night. Night is never fun. I don't think anyone ever gets comfortable with a night carrier landing, especially with weather and pitching deck. That's always a tasty treat. But yeah, I don't know. It is a different business.
You're different. I mean, you're different people that can get that done. And when we, all of our thanks to you guys, all the folks out there doing that good stuff. Tony Bancroft, Portfolio Manager, Gabelli Commercial Aerospace and Defense ETF. He's at Gabelli Funds. A lot of smart people that Mario has hired over the years. Have done a ton of business with Gabelli because they've been big in the media TMT space, and they're also, thanks to Tony's work, doing some good work there in the commercial aerospace and defense business. So we thank Tony.
And Tony, interestingly, has flown a lot of the planes that he
exactly.
covers.
So he knows what he's
cool.
talking. He knows what he's talking about. We appreciate that. More coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. Nike shares, they are lower. They're down about 11%, and this is after it warned of weakening sales and said it expected as much as $2 billion in cost savings by simplifying its product lineup and slashing jobs. Now, sales in China also fell short of expectations, and Bloomberg's Tim Lowe said that has investors on edge.
As recently as September, CEO John Donahoe had, voiced confidence and kind of a bullish take on where the Chinese consumer is going in the sporting goods sector. So kind of walking that back a little bit, spooking not just Nike investors, but, it reads across the sector.
All right, so let's check in across the sector. We have Adidas right now. They're down about 5%. Puma, ADR is down about 4%. Foot Locker, same there, down 4.5%. Well, new limits on video game spending in China are sending ripples through stock markets around the world. Tencent led an $80 billion rout in Chinese tech companies. Bloomberg's Kriti Gupta has more.
China saying, look, we're going to really draft some new rules around how these companies are regulated. So it already, the announcement already wiped off billions of dollars for Tencent, the major game company there. Ubisoft over in France as well taking the hit. Now that's feeding into some of the U.S. stocks as well.
All right, so Tencent's down about 10.5%, but Electronic Arts, checking in the U.S. right now, it is up just about 0.1%. Lionsgate Entertainment set to go public. It'll launch Lionsgate Studios as a separately traded company through a deal with Screaming Eagle Acquisition. Now, that transaction values Lionsgate Studios at $4.6 billion. Those are the company stories we're following this hour. I'm Lisa Mateo.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, looking at these markets, we are higher for the day here. We're up about 0.4% on the S&P 500. The Dow's up about 0.2%. The Nasdaq also up about 0.4%. Looking at the yields here, yields coming in just slightly. The 10-year Treasury, the yield's up just a pinch, 3.89% on your 10-year. WTI crude oil steady, $73.84 a barrel. Gold higher, $2,060 an ounce. And Bitcoin pulling back just a little bit, 43,700 with the Bitcoin. We'll call that out for Tom Keene since he's not here. Right now, let's head down to Washington, D.C. Let's get world and national news with Amy Morris.
All right, thank you, Paul. The U.S. signaled it could support a resolution at the UN Security Council that would increase aid flowing to Gaza as Hamas rejected that week-long truce deal that would have seen the release of 40 hostages held by the militant group. Yesterday, leaders there said they would not take part in any more negotiations without Israel agreeing to a more permanent ceasefire. President Biden is getting ready for a 2024 rematch with former President Trump, but with bigger stakes than in 2020. As Bloomberg government White House reporter Courtney Rosen tells us, the president plans to put, quote, threats to democracy at the center of his re-election campaign.
His first opportunity to do that in the new year, to really underscore that contrast, will be the third anniversary of January 6th. It's hard to believe that we're coming to that, the third anniversary of the attack on the Capitol. So that will be an opportunity to highlight that theme going into the 2024 campaign.
Bloomberg government's Courtney Rosen in Washington. Southwest Airlines says it's taken all necessary steps to prevent a repeat of last year's nightmare that saw 17,000 flights canceled. They've invested heavily in de-icing equipment. They've revamped their computer system, and they say they have plenty of staff available. Analysts expect about 39 million air travelers this holiday travel season. That's a record. And it is the weekend before Christmas. Kids all over the world are eagerly awaiting Santa's arrival, and the military is standing by to help. Pentagon spokesman Brigadier General Patrick Ryder.
This is NORAD's 68th year conducting this important mission, and children and families worldwide will be able to call to ask NORAD's live operators about Santa's location on the 24th, starting at 6 a.m. Eastern Standard Time.
Pentagon spokesman Brigadier General Patrick Ryder says the North American Aerospace Defense Command is able to track Santa by following the light from Rudolph's nose. Very convenient. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul and Simone.
All right, Amy Morris, thank you so much. We appreciate it. Simone, fake Ozempic?
That's right. The U.S. FDA has seized thousands of units of counterfeit Ozempic. And this is Novo Nordisk's blockbuster diabetes drug, but it's gotten this reputation for the massive amounts of weight loss that it causes. So plenty of people using it off-label, and also sister drug Wegovy. Anyway, the regulator apparently advising wholesalers, retail pharmacies, health practitioners, and patients to make sure they have actual Ozempic, not counterfeit stuff. But, you look at the kind of demand for these products, and that's had an enormous impact on share prices. Novo Nordisk out of Denmark up 48.8% year to date.
The Danish company has struggled to ramp up supply of Ozempic and an associated weight loss medication, Wegovy, and has said it sees shortages continuing into next year. Novo has repeatedly raised financial guidance this year on the back of the obesity drug demand. Goldman Sachs analysts predict the market could reach $100 billion by 2030 with Novo and Eli Lilly, which makes a similar drug capturing about 80% of the obesity market by then. It's amazing.
We were talking about this with Robert Schein earlier. He was talking about a $150 billion market.
Yep.
And so much interest here that people are producing counterfeit options. And those counterfeit options actually do sell at a substantial discount sometimes to the $1,000 plus list price of these drugs.
The U.S. drug regulator said it's aware of 5 adverse effects from the counterfeit Ozempic, none of which were serious and are consistent with known common adverse reactions to authentic Ozempic. So, but again, cracking down on some of the counterfeit drugs out there for Ozempic and other weight loss drugs. We'll keep up with that. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up, it is Friday. That means we talk municipal bonds. We did that today with Joe Misek in studio. He's from Bloomberg News. He's our guru in all things in the municipal bond market. We'll break that down. Plus, we're going to check in with Lukacs Tomicki, founder and managing partner of LRT Capital. Just get his market call. And then we're going to bring you a simulcast Bloomberg Television and Radio. Lael Brainerd, director of the U.S. National Economic Council, is going to join Kaylee Lyons and Guy Johnson for a discussion on the economy and today's inflation rate that's coming up later this hour. But first, let's kick things off with the Bloomberg Business Flash.
Yeah, still a lot of focus, Paul, on the Fed's preferred gauge of inflation coming in cooler than expected. We're still seeing stocks pointing to an 8-week bull run. If this holds up, this will be the longest winning streak for the S&P 500 in more than 5 years, and the NASDAQ is poised for a similar run as well. But as we head into this long holiday weekend, Citigroup has come out with its 12 trades of Christmas. Citi's head of global macro strategy, Adam Pickett, says one of those trades when it comes to stocks is consumer slowdown.
Even though there's maybe a bit of a lean towards the U.S. consumer slowing down, ultimately we think U.S. household wealth is exceptionally elevated. It's up around 35 to 40%, depending on how you look at it, versus 2019. And that still skews, we think, towards consumer discretionary, which has this nice mix of growth, but also sort of top line, high level spending power.
And you can hear more from Citi macro strategist Adam Pickett and his 12 trades of Christmas on today's Bloomberg Surveillance podcast. Looking at stocks right now, as we do all day long here on Bloomberg, still holding on to gains with the S&P 500 now up 13 points or 0.3%. 4760 is the S&P level. Dow Jones Industrial Average is up 35 points, a gain of about 0.1%, 37,440. The NASDAQ Composite is up 44 points, 0.3% higher at 15,008. 10-year Treasuries down 2/32 now. The yield 3.89%. The yield on the 2-year 4.33. NYMEX crude is down 0.4%, down 32 cents, trading at $73.58 per barrel. COMEX gold is up 1%, up $20.20 at $2,071.60 per ounce. The euro 1.1014 against the dollar. The pound 1.2716. The yen 142.36, and Bitcoin down 0.7%, right around 43,700. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Simone Foxman.
Nathan Hager, thank you so much. We appreciate that. Simone Foxman, Paul Sweeney. We're live here in a Bloomberg Interactive Broker studio. We're streaming live on YouTube, so head over there and check us out. And Bloomberg is now in your dashboard with Apple CarPlay and Android Auto. It gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. How do you get it? Well, first of all, it's free with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your phone in the Apple iStore or on Google Play. Just download the app, connect your phone to your car, and get started. It's all presented by our sponsor, Interactive Brokers. So how about that? Looking at the markets, as Nathan was just reporting, we got some green on the screen. Let's see where the action is under the hood. We'll check in with Elena Popina. She covers the equity markets for Bloomberg News. Elena, what do you have for us?
Hey guys, so I'm watching home building stocks. They are fluctuating between gains and losses as home sales data unexpectedly fell in November to a one-year low, below all of the analysts' recommendations and consensus projections. I'm watching a stock with the ticker IBP, Installed Building Products. It was down 0.5% early. It's now kind of in the positive territory, in line with the broader market. And I'm also watching some Chinese ADRs.
Home builders?
Yeah, the home builders. Oh, thank you very much for the blue button. Yeah, the home builders this year have just been ripping. I mean, they're like 70, 80, 90%. It's just been it's a good business beat because people aren't selling their existing homes. So if you want to buy a new home, you got to buy like a newly constructed home.
Right, and there is a big
Got it.
supply-demand imbalance, which has been driving
Nice.
these stocks higher. But, the data today, is weighing on some of the building products companies, some of the construction companies. That was unexpected. We expected the demand to be going up forever. It wasn't there last month for several reasons. Seasonality is one of them. But so far, these stocks, the home building, the building companies are kind of, fluctuating between gains and losses. Not tanking. Nothing is tanking today, except for Chinese ADRs.
Chinese ADRs. All right. Why are Chinese ADRs tanking today?
A really big crackdown on the industry from Chinese authorities. We are talking about the largest online gaming industry in the world in China. And, some of the stocks that are focused on that industry, squarely on that industry, are down as much as 17% today. Check out NetEase, ticker NTES. It's down 17%. Its major revenue is online video gaming industry and revenue from, regular Chinese, mom and pops who are paying for their online gaming apps. That could not be the case in the future, if that, if that law, that bill rather comes into fruition. But, so far, 17% decline in NetEase is weighing on the peers. Check out Tencent, also down. Some of the, companies in the broader Chinese markets like Vipshop are also down. It's going to be an ongoing story next week as well.
I mean, Alibaba down 1.8%. My buddy Joe Tsai, who runs that thing over there, I don't know what you do when you got the government beating down on you.
I know. And not keeping up with the holiday spirit that is going on here in the United States. We're setting us up for 8 straight weeks, the longest streak since 2017.
Here's something that kind of jumped out of my attention.
Mm-hmm.
Lionsgate Entertainment, which is a media company, a movie studio, they're going to go public via, they're going to list their studio business in a $4.6 billion SPAC deal, merging the studio with Screaming Eagle Acquisition Corp. The new entity does not include Starz, which Lionsgate bought in 2016. So we're going to get another. I'll talk to Bailey Lipschultz when he comes here because he's all about the SPAC
SPACs
stuff.
have not been doing well.
No,
this
they
year,
haven't.
Let me
really.
tell you that. Yeah.
No, but
short sellers made a lot of money.
Did they?
Wagering against these companies.
I mean, we had Alex Rodriguez, baseball player. His SPAC. He's merging his company into a SPAC. We got Lionsgate here, who is a real company. Was public for a long time. It's a real company, and Lionsgate is merging its studio business with a blank check company that will trade on the NASDAQ stock exchange in a deal that values the business at $4.6 billion, including debt. So this is a real company, a real deal. Anything else there, Elena?
Nothing other than the Chinese ADRs,
Yep.
some of the stocks that are connected to Nike. Obviously, Nike is down a lot on its weaker than expected sales outlook and sales figures, but it's pretty much quiet. Volumes are 20% below the 30-day average. Holiday spirits are kicking in. The Treasuries market is going to close at 2 p.m. So
Say what? Treasuries closes at 2 p.m.?
Yeah, 2 p.m. The bond market is going to close at 2 p.m.
Here too. I'll have to ask somebody. All right, Elena Popina, thank you so much for joining us. Elena Popina, she covers all the equity markets. I'm here. Simone's here. Elena's here. We're all here. And Joe Mysek is also here. Focus on Munis is brought to you by Build America Mutual. Build America Mutual insures U.S. municipal bonds that finance essential American infrastructure and provides guaranteed income to improve any portfolio. Be part of Building America. Invest in BAM.
BAM.
Insurance bonds. Matt Miller brings the BAM.
BAM.
Exactly. We need Miss Matt on the BAM. Joe Mysek joins us here in our Bloomberg Interactive Brokers studio. Joe, what's new here we've had the Treasury, U.S. Treasury, 10-year go from 5% to 3.9%. What's going on in the muni space here?
Man, munis, we're seeing big returns over the last, I would say, 2 months, since October. And, where have yields gone? I mean, we were at 360, I think, on the 10-year muni, and I think we're in the 220 range.
Well, look at this. I mean, Joe, the Bloomberg Municipal Bond Index total return year to date, 6.18%. You guys are doing okay over there.
Big, yeah. It just goes to show what, different reading on the Fed will do. But they seem to have, a soft landing in sight. So we've seen this real swoon in muni bond yields.
And yet at the same time, you have high interest rates, part of apparently the reason that Citi shutting down its muni bond department. Yeah, explain what's
you
behind.
segued right into that. I love
Try.
it. Wow. Yes, Citi.
I mean, this is Citi. This isn't some podunk investment. This is Citi.
Right, Citi. When I heard about this, I said this is the biggest one since Salomon went out.
Yep.
If you remember, Salomon went out in '87, and it was stunning to the market.
Yep.
Salomon had more than 200 employees. It went out as #1 underwriter of municipal bonds, which was shocking.
Yeah.
And the line there was that, hey, this unit made money, but they didn't make enough money. And
is that the line here?
Yeah, pretty much. Now, this is a little bit different because Citi, is number 6 or 7, depending on, which day you were looking at it. And the department had lost people because during this year it had been telegraphed that this unit, the municipal bond department, is on the shopping block. So that, that, and yes, munis are not as lucrative as other things are to underwrite and deal in. There's also the political risk where you had, Texas and other GOP-led states saying that they didn't want certain banks doing business if they were going after the oil industry, or if they were pitching ESG, or if they were, doing any of these other things that GOP lawmakers didn't like.
Right.
So there's that political risk, and Citi was losing out on that Texas business.
And Texas is the biggest issuer, right?
This year, biggest issuer. Danielle Moran had a nice story out.
Well, everybody's moving to Texas. You got to build infrastructure for them, right?
Well, and you know what's going to happen to those low taxes. You could say what you want and, try to stick up and say, oh, no, we're going to keep these low taxes in place. Well, no, you're not, because all this debt has to be repaid. And this year, Texas, $58 billion. And I think they said that they were looking, next year and the year after, big issuance as well.
All right, so Citibank, shocking. But Jefferies Financial Group, they're stepping up. You guys, Amanda Albright's got a story about Jefferies. I mean, which is I kind of consider a high quality, but kind of a smaller middle market niche investment bank, very high quality. They've actually become a big player in the mini space.
Oh yeah, they moved up this year, and Amanda had a very nice story about Kim Arnone, who runs the municipal bond department there, and she attributed their rise to blocking and tackling. Also, they didn't take. Jefferies does not take a stance on ESG or oil or guns. So they were able to do business in Texas and these other states easily enough. And they bring a lot of intellectual capital to their clients. So, they come up with new ideas and different ways to finance. That's a very winning combination. And Jefferies, as you said, all this year they've been moving up steadily. So that's a different story in the muni market. Citi really overshadowed everything, and then it was like, yeah, but wait a minute, some banks are actually building up and hiring.
Is there more room to run for Jefferies specifically?
Oh, sure. Well, if you have Citi going away, which they are, you could pick up several billion there easily.
Does it have any overall, to see Citi go away, what's the impact on local borrowers, public borrowers themselves?
After Salomon, people said, oh, there's going to be a big liquidity crunch in the muni market, and it's going to be tough for borrowers to sell bonds. No. No, the remaining players will pick up the slack, and I know there is some concern about liquidity, but I don't think so. I think the remaining players are going to step up. And I know that, we have a declining number of underwriters. I think we have 87 firms have managed a municipal bond offering somewhere in the United States this year. But really, once you get out of the top 20, you're going, or maybe 25, you're really heading south rapidly. So the top firms are going to step up and fill cities' place.
Speaking of interesting niches to be, there's a story by Martin Braunout about Baird getting into a very unusual, it sounds like, corner of the municipal bond market. Can you talk to me about what they're eyeing here?
Well, a couple of weeks ago we talked about there's very few how can I put it, opportunities in the muni market, but this is one of them. And Martin sussed out this little story about their municipal bonds sold by housing agencies, backed by Ginnie Mae's, Fannie Mae's, and therefore highly rated. And yet, because of the nuances of the transaction, mainly involving calls, you're getting 100, 150 basis points extra in yield. So that's a really nice kind of opportunity in the muni market that you don't see. And yet, there it is.
Wait, stop there. How does that work exactly? How can I get that much more yield?
You have, these housing agencies in the municipal bond market sell debt, and it's backed by payments from Fannie Mae and Ginnie Mae, and they're over collateralized, and it just happens to be this niche product. Now, the thing about housing bonds all the time is that they have all sorts of various calls, mainly involving early payoff of mortgages. So you don't know whether you're getting a 5-year bond or a 7-year bond or a 10-year bond. It kind of depends on the local market. But, guys are saying, hey, that risk, I'll take that yield for that risk.
Guess what?
It's no, wait a minute. That's it?
That was pretty quick. Joe Misek.
The hook.
Bringing it every week like he does on the municipal bond business. Big part of my portfolio. I've been a big New Jersey municipal bond investor for a long time. I like to tell every governor that I'm probably the largest private creditor to the state of New Jersey out there. But Joe Misek, he covers all municipal stuff for Bloomberg Brief, part of Bloomberg News here. So good stuff there, getting the lowdown there. We got some positive return in the municipal bond market. The fixed income market across the board, definitely putting up some positive returns this year. Big rally in the last several months in the municipal bond market right there, 6.2% gain for the year. High yield is really where the gains were for this year in fixed income, north of 13%. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Hey there, Paul. Just days after Comcast announced that customer data was stolen by hackers in October, the cable, broadband, and phone provider is facing a pair of lawsuits. Bloomberg's Steve Potisk has that story.
2 federal punitive class actions claim the company failed to properly secure valuable, personally identifiable information of customers, exposing them to a lifetime of potential identity theft. Comcast did not immediately respond to a Bloomberg Law request for comment.
Shares are up about 0.5%. Grocery chain owners Kroger and Albertsons have avoided at least one obstacle in their attempts to join forces. Bloomberg's Gina Cervetti explains.
The two escaped a second attempt by consumers to block the almost $25 billion merger. A federal judge said the plaintiffs failed to allege harm from the deal. The Federal Trade Commission is still weighing whether to intervene in the merger.
Now, Kroger is up about 0.3%. Albertsons is little changed. And shares of U.S. Steel, well, they're lower. And this is after President Joe Biden's top economic advisor said the purchase of the company by a Japanese company, quote, appears to deserve serious scrutiny. Now, earlier this week, Nippon Steel said it would buy U.S. Steel for $14.1 billion to create the world's second largest steel company. Now, Lael Brainerd pointed to its potential impact on national security and supply chain reliability. U.S. steel shares are down just over 0.5%. And shares of Rocket Lab, they are soaring. They're up about 25% almost after the satellite company won a $515 million U.S. government contract. Now, analysts say it's good news for the stock as it more than doubles the backlog for its space systems business. Those are the stories we're following. I'm Lisa Mateo. This is
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Coming up to 11:22 on Wall Street, I'm Nathan Hager, and we check the markets all day long here on Bloomberg. Right now, the S&P 500 is up 17 points, or 0.4%. The Dow Jones Industrial Average is up 54 points, a gain of almost 0.2%. And the Nasdaq Composite is higher by 52 points, a gain of nearly 0.4%. Stocks are holding on to gains, an 8-week bull run. Stocks are on track for after the Fed's preferred inflation gauge came in cooler than expected. Treasuries close early today on this Friday before Christmas, and Treasuries right now showing up kind of mixed. The 10-year's down 4/30 seconds, the yield at 3.90%. The 2-year little change to the upside, it's at 4.33%. NYMEX crude is little change now, up 3 cents. $73.92 for a barrel of West Texas Intermediate. COMEX gold is up 1%, up $20.70 at 2,072 even per ounce. The euro 1.1011 against the dollar. That's little change. The British pound 1.2719. The yen is at 142.48. 10 of the 11 main industry groups in the S&P 500 right now are in the green. The only laggard is consumer discretionary, with Nike still the biggest decliner on the S&P 500, down 10.5% after the sneaker, or is it gym shoe, or is it tennis shoemaker, said that it's going to, thank you, Paul, try to trim costs by as much as $2 billion. I mean, that's the real story here for Nike, and some of its competitors are trading lower as well. That's a Bloomberg Business Flash. Bloomberg Markets continues. Paul Sweeney and Simone Foxman.
All right, Nathan, thank you so much. We appreciate that. Nathan Hager with our Bloomberg Business Flash. Simone Foxman, Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube, so you could head over to youtube.com and search Bloomberg News here. One of the questions here, we've had this monster move, as Nathan was just reporting, 8 weeks of gains in the S&P 500. Are we too far, too fast on the back of what appears to be a pivot from the Federal Reserve? Lukasz Tomicki joins us. He's a founder and managing partner of LRT Capital Management. Lukasz, how do you view kind of what we've seen here in the markets over the last 8 weeks here? Does it make sense to you, or is the market maybe a little bit ahead of itself?
Well, good morning, and thanks for having me. I mean, I think it all depends on the context. Speculation is well alive on Wall Street, and it seems that, what's gained the most in the last 8 weeks are the most speculative, most risky companies. And I think that makes perfect sense, because those are the companies that need most relief from high interest rates.
So next step here, I mean, where do we go from here? I mean, everybody's kind of closing out of what's been a very good 2023, just looking at the index numbers. What are you telling your clients for 2024 for an encore?
Yeah, I mean, I think, the market today is kind of like Tiger Woods before his affairs were discovered. In other words, it's really priced for perfection. And so we have a situation where people are expecting record profits from the S&P and rapid interest rate cuts and a perfect soft landing. And I think that kind of scenario is a scenario of plenty of risk. To me, this seems like December of 21. Even a small deviation from a soft landing scenario, I think, sets up a lot of downside for the market.
Okay, so beta is not going to get it for you next year if that's your call. So what sectors, what names, where do you want to be in 2024?
Well, I think it depends, on your position. If you can be in hedged strategies, absolute strategies, absolute return, market neutral strategies, I think those are going to be much better positioned relative to the market for next year. And beyond that, we're looking at some beaten down stocks, and we can talk about specific names or sectors if you like.
But hedge funds have underperformed the market for quite a few years, and they've, the more active strategies have lagged. How do you differentiate between strategies that are going to actually work and deliver more than beta, and ones that are just going to kind of saunter along?
Well, I think the term hedge fund has become a bit of a misnomer because today the only thing it really means is a compensation structure because there's so many different types of funds. But I think those that have delivered steady returns year after year, are probably the ones that have a repeatable, systematic process. And I think that's always what you want to focus on.
What's your repeatable, systematic process?
Well, we focus really on quality companies. So we're looking at things that have high rates of return on invested capital, have the ability to actually grow and redeploy, capital at those high rates of return, meaning they're not just returning cash to shareholders. And most importantly, the ones that have management teams that have done a good job of allocating shareholder capital over the long term.
All right, how about the tech space? We've seen it really drive the return for the vast majority of the year. Then things have kind of been broadening out a little bit. Can the Magnificent Seven remain as magnificent?
I think they remain as magnificent because reality is they're incredibly resilient businesses, and they're very good businesses. There's, you'll get no quarrel from me that Google is one of the great businesses of the world. I think they are going to be very sensitive to any mention of higher for longer. And, I realize that that's a phrase that we seemingly banished from the lexicon over the last few weeks. But as long as the economy stays strong and inflation doesn't, collapse, I think the market is pricing in quite a few too many Fed fund rate cuts going forward. So, if we don't get the 7 or 8 cuts that are expected, and instead we just are getting 1 or 2, then you can very quickly get another rise in long-term yields and a decline in the valuations.
Dollar General is a name that you highlight. The stock is off 46% year to date. Why is that on your radar screen?
Yeah, so we're looking at companies that have short-term difficulties that we think are operational in nature, that are really not related to their core business, meaning the business itself is not broken, and we like the businesses long-term. So Dollar General is one of the names. In the convenience store, dollar store space, there's really not many companies to pick from. And if I have to pick one, to me, Dollar General is the one to be at compared to, say, Dollar Tree. They've had some operating difficulties recently due to too much inventory. And it's one of those names that did extremely well during COVID and now is kind of feeling, a bit of a backlash due to hard comps. But I think with new management, as we move into the next 12 months, we're going to see the company start comping same-store sales positively again. and it's quite bombed out and hated. And so that's probably, where we think there's opportunities for alpha next year.
How about Estee Lauder? This cosmetics company is down 42% year to date, but up 17.5% over the last month. And you own it in your fund. What's the thesis here?
Yeah, so I think if you can look even more back over the last 5-6 years, Estee Lauder has gone nowhere, right? So again, it's a name that's quite bombed out, that has some operational difficulties, especially in China. China has been slow to recover. They're facing increased competition there from Perfect Diary. But again, this is a business that has a long history of operating many premium brands across many different price points and doing so successfully. So I think they're going to get through the problems they're having in China, and the comps are going to look a lot better going into next year. And again, it's a name that's not loved. So there's plenty of opportunities for active managers to start seeing the turnaround and fall in love again. And of course, the valuation today reflects the difficulties it's had. So you're getting, a good entry point.
Lukasz, are you guys at your firm, are you kind of net long or net short here, and why?
Well, we're net long. We're net long roughly 30% on a dollar basis and roughly 20% on a beta basis. So the things we're long tend to be more stable, more slower growing businesses, and we tend to be short indexes, and primarily small and mid-cap indexes, which tend to have an above average beta. So we try not to carry a lot of beta to begin with, but we're looking really at these long-term kind of growth businesses all around the world.
Now, I know you're a systematic guy, but, we were talking about looking for beaten down names that could have some short-term upside, Dollar General and Estee Lauder among them. What other signals simply differentiate for you between a name that's going downward because the company's bad and the ones that stand to regain some enthusiasm?
Well, we always start by analyzing the business model of a company and trying to understand how it creates value for consumers and for shareholders. And ultimately, our analysis, right, of the business models should indicate that the stock and the company does well. And then you can distinguish short-term operational problems from the long-term strategic goals of the company. So if you're in a situation where the stock may be going down, we're not contrarians for contrarian's sake. We see how it fits into the overall portfolio. But after a name has been down for several years, like an Estee Lauder, and is kind of left for dead, and everyone's telling me how terrible it is and how Perfect Diary is going to take over the Chinese market, and I look at it, I look at their long-term history, it seems worthy of a 1% position, if you know what I mean.
All right, Lukasz, thanks so much for joining us. Always appreciate getting your thoughts and perspective. Lukasz Tomicki, he's a founder and managing partner of LRT Capital Management, located just outside of Austin, Texas. Right now, with our news in Washington, D.C., Amy Marsh.
All right, thank you, Paul. A group representing hostage families says an American dual national seized by Hamas on October 7th has died in captivity. Gad Hagai is the latest confirmed fatality among hostages held by Hamas in Gaza. His kibbutz community says his body is still being held by Hamas there. This as the U.S. signaled it would support a resolution at the UN Security Council that would increase aid flowing to Gaza after a drawn-out negotiation threatened to defeat the measure. More on this now with Bloomberg's Bill Ferries.
You've seen the U.S., particularly for weeks now, trying to straddle this divide between signaling its support for Israel and saying it has, continues to have the right to defend itself after those October 7th attacks by Hamas, but also signaling its real concern about the rising civilian death toll.
Bloomberg's Bill Ferries reporting the U.S. is preparing to lift a ban on weapons sales to Saudi Arabia. Officials tell the New York Times the Biden administration is prepared to relax some restrictions after taking note of Saudi Arabia's de facto ceasefire with the Houthi militia in Yemen. A Pacific storm that pounded California's coastal areas and stranded motorists is poised now to pounce on the southeastern area of that state through today. More on this now. Bloomberg meteorologist Rob Carolyn.
Weather system that brought the heavy rain to portions of Southern California, especially around the Santa Barbara area, is going to be shifting eastward. So we'll look for the axis of heavy rain to pull out of Southern California today, set up across Arizona and into New Mexico. Much of the southern half of Arizona under flood watches.
Bloomberg meteorologist Rob Carolyn. That rain coming as millions of Californians are scrambling to finish their holiday shopping or getting ready to head on the holiday highway. Motorists were stranded yesterday in their vehicles on flooded roadways northwest of Los Angeles. They had to be rescued. Global news 24 hours a day and whenever you want it. With Bloomberg News Now, I'm Amy Morris, and this is Bloomberg. Paul and Simone.
Thanks so much, Amy. Well, we're looking at some economic data coming in, again, seeming to further this narrative, this soft landing, Goldilocks narrative that we've seen. And, you know, the market's loving it with stocks up again on the day, setting us up for potential record 8th straight week, the longest run since 2017. And here to help us break this down is Abigail Doolittle, who joins us. She's a reporter at Bloomberg TV. Abigail, you know, what's driving the markets today? Is it just this, you know, Christmas-inspired enthusiasm?
I think that their volumes are light once again. This time of the year typically is going to be a little bit lighter. A lot of traders are on vacation. I think relative to PCE, the fact that it came in just slightly better than expected, basically in line, but again, slightly better than expected, is enough to give us the small gains that we have for stocks right now. We have the S&P 500 up about 0.3%, the NASDAQ up about the same amount, heading to an 8th up week as you were talking about. You know, it's interesting, you were just talking about the soft landing, and right now it's a soft landing, but we don't know about 2024. There had been so many recession calls and they've gone away. If you take a look at the commodity complex, and I think that two of our commodities people, Vincent Piazza, and I think that's his first name, and then Mike McGlone, they're both talking about the idea that some of the indicators around commodities speak to economic weakness, demand, you know, a demand weakness, a demand air pocket, and that commodities, the more than 10% decline this year, could still be speaking to some kind of a recession next year. So, you know, I feel as though there are a lot of people that are now in this soft landing camp. If we were speaking 6 months ago, everybody was hard landing, no landing, and now. So I just think that whenever, you know, the majority of Wall Street is on one side of the boat, you want to think about what does the other side look like, especially when there's fundamentals that support it. It could happen not the way that everybody's expecting.
So I'm looking at the RSI function for the S&P 500. It's at 71. I don't know. So it feels maybe, you know, kind of at the upper limit of maybe being, you know, a little overbought here in the marketplace, but not egregiously so.
So let's talk RSI, and let's put it into the context of this week, because it was some of the more fascinating RSI behavior that I've ever had the opportunity to chart, which is saying something since I've, you know, charted thousands of charts over the last more than decade. So I'm just pulling up a copy right now, and so on Wednesday afternoon, it was after commodities closed, so let's call it 2:40. I just happened to be looking at charts, and I was putting together the evening chart note, and I wanted to pull up the RSI. On the S&P 500, it had been the day before at 82, its highest since 2020. So I was going to send out a preview note that afternoon just to say to our newsroom, you know, we have this very overbought S&P 500. As I was trying to put that note out, and I'm pretty fast, the S&P 500 went from being positive to negative, and the RSI that day went to 66. So the fact that we now have it back at 71, which is overbought, but it's a lower high, significantly lower high from 82, tells you have the S&P 500 higher today, but on weaker momentum than it had been just a few days ago. That's a bit of a bearish divergence, so the RSI is something to keep an eye on. Unless that RSI goes back above 82, 83, right now being overbought is a bearish signal. Not because it's overbought, but because the bulls are less enthusiastic than they had been. And it suggests that it's probably going to come back into a more normal momentum line.
Gotcha. All right, Abigail Doolittle, thank you so much. We appreciate that. As always get a little technical bent to the market analysis as well. Abigail Doolittle covers all the markets for Bloomberg Television. So we've got a green on the screen here, and coming up in just moments, Lael Brainerd director of the U.S. National Economic Council and former Fed member, is going to have an interview on Bloomberg Television, which we will bring you forthwith in just a moment. Looking at the markets here, S&P 500 up 0.3%, and the Dow is up 0.1%. The Nasdaq up 0.33% as well. Russell once again outperforming, up a solid 1% here. And I'm going to call out the VIX for Tom Keene. I know he's enjoying a surveillance cocktail, midday cocktail at the moment. The VIX is 13.5, so decidedly muted in terms of the volatility, the VIX index. Right now, let's bring you a discussion with Lael Brainard, the director of the U.S. National Economic Council, former Fed member, with Kaylee Lines and Guy Johnson of Bloomberg Television. Let's go to that right now.
We welcome now our Bloomberg television and radio audiences. The top story, of course, today, cooling inflation in the United States. Core PCE barely rising in November. You want a cool figure? Take a look at the 6-month annualized number. The core metric there up 1.9%, i.e. below 2%. Let's get some reaction from Washington. Lael Brainard, director of the National Economic Council at the White House, and of course, former vice chair of the Federal Reserve, joins us now, along with our own Kaylee Lines. Lael Brainard, great to see you. We've all been anticipating this number and looking forward to seeing exactly what it was going to deliver and what the data are going to deliver. It's a really solid number, and I'm wondering whether we are now at the point where we can declare victory, whether it is time for a victory lap, whether the inflation dragon has now been slain.
Well, look, it is really good to see that we're closing out the year with inflation on a 6-month basis at 2%. That's the pre-pandemic benchmark, and it's a very significant milestone. And if you look back over the course of the year, it is really stunning how much progress the economy has made. Inflation's come down faster than even the more optimistic forecasts, and growth has remained very resilient along with a strong employment. If you recall, a year ago, the consensus projection was that getting inflation down would require a spike in unemployment and a recession. But in fact, the unemployment rate has remained below 4% for 22 months in a row. And of course, we're still seeing more data suggesting growth is resilient. But no, it is not time to rest. It is time to continue working. And that's what the president is determined to do. Keep working to keep bringing down prices and improving the economy from the middle out and the bottom up.
Well, and Director Brainard, it's Kaylee in Washington. Obviously, he has tried to do that domestically, but geopolitics are a factor here as well. If it's not time yet to declare victory on inflation, if there may still be upside risks to inflation out there, how worried are you about what's happening in the Red Sea and what it could mean for energy prices and supply chains?
Well, the Red Sea situation is one that we are monitoring very closely. Our national security team is in constant contact with partners in the region, with shippers, and we are doing everything we can to make sure that those shipping routes disruptions do not lead to broader disruptions, supply chain disruptions in the U.S. economy. And of course, we're much better equipped today than we were just 2 or 3 years ago, because we have, under the president's leadership, done so much to work in partnership with the private sector on supply chain resilience.
Dr. Brainard, are you confident that the current outlook when it comes to wages is consistent with, let's call it 2%, and the target that we're all shooting for here? Are you confident that some of the deals that have been done this year that are going to take effect next year are going to really take us in that direction?
Well, as you said yourself, that core number, which is the really important number on inflation, is actually slightly below 2% on a 6-month basis. And that should give everyone a lot of confidence that inflation is sustainably down, and we can continue to see good growth in real disposable incomes, in real wages. And in fact, if you look at the real disposable income growth over the past year that we saw today, 3.7%, very strong. And it is coming in the context of rising productivity. You can see that in the last year, productivity's been nearly 2.5%. So that gives room for American workers to continue to enjoy that take-home pay that allows them to purchase $3,500 more today than they could pre-pandemic.
Okay, so let's talk about American workers, or perhaps more specifically, Director Brainerd, American voters. You've mentioned a few times here the work the president has done on addressing supply chains, on trying to bring inflation down. And clearly the economic data supports this idea that the economy is held in there even as price pressures have eased. Where it is not reflected, though, is in the president's approval. In consistent polling we are seeing, it's not really a question of whether there is a disconnect, because clearly there is one. But how do you advise the president, as an economic advisor, how to address it? What does he need to do?
Yeah, so when I talk to the president, he is focused on one thing. He always wants to know, what does the strong data, the strong economy mean for American workers? What does it mean for their wages, their wallets? We've already noted that American consumers are now seeing declines in prices over the year on things that really matter to them: a gallon of gas, a gallon of milk, toys for the holiday season, appliances, and, you know, for the holidays, car rentals and airfares. Those are all down over the year. Wealth is up 37% since before the pandemic. Home ownership is up. Housing wealth is up. Retirement accounts, as you know, is up. And today we saw consumer sentiment jumping. And that's the biggest jump we have seen in years, which suggests that Americans may finally beginning to feel a little bit more confident, a little bit more secure. But the president is going to continue to push us to work to lower costs for American families and to keep these gains over the course of the next year and years.
Do you think these gains in inflation should be taken for granted, Dr. Brainerd? The financial markets are pricing in 6 rate cuts for next year. Do you think this is an economy that needs that level of easing?
So, look, this is a president who respects the independence of the Federal Reserve, so I won't comment on Federal Reserve policy making. Sure. What I can say is that the conditions are very favorable in the sense that inflation has come down to 2% on a 6-month basis, much earlier than people predicted, at a time where the labor market is in much better balance. And why? It's because supply chains have healed and workers are coming back into the labor force at much larger numbers, 3.3 million over the last year alone. So that work on supply chains that the president has really pushed forward since the first month of his presidency is showing up in those lower inflation prints. And the market does seem to be taking that to a more benign set of interest rates. I mean, you look at mortgage rates, 1.5 percentage point decrease in mortgage rates just over the last few months.
Yeah.
That's very welcome.
So I understand the restraint around what you can say on the monetary policy side, but I wonder what all of this means on the fiscal policy side of the equation as well. Knowing when Congress returns in January, there is going to be a massive spending fight that has to take place in terms of the budget. Are we looking at a U.S. economy right now that is able to withstand greater fiscal restraint?
Well, this economy has proven to be remarkably resilient, defying all the predictions. And looks to close out this year certainly on a much stronger level of growth than had been anticipated. In terms of the fiscal trajectory, President Biden really wants to see the agreement that he put in place that would cut an additional $1 trillion in spending, a bipartisan budget deal, the Fiscal Responsibility Act, to be put into place. Congress needs to move forward and do its job. And of course, he's already seen a $1 trillion reduction in deficits just in the time since he's been in office. So we'll continue to work with Congress on a bipartisan basis. The president is really very focused on being fiscally sustainable.
Does big fiscally sustainable mean as well that we need lower interest rates? There's a growing discussion about the interest bill that the American economy now carries, that the federal government now carries. Significantly lower interest rates obviously would make that challenge much easier to handle. Do you think there is a case of fiscal dominance beginning to emerge in the United States, that the economy is not capable of sustaining itself unless it has lower interest rates, given the interest bill that has now been built up?
Well, I would come at it from the reverse direction and simply say that the benign data that we are seeing that suggests that inflation really is sustainably coming down on the back of these great improvements in supply chains, with the inflation on a 6-month basis now at the 2% pre-pandemic benchmark. That's a benign outlook that will be much better for our fiscal outlook all around in terms of growth, revenues, and the longer run fiscal sustainability. So this is a benign outlook, and yes, it's very positive, I think, for the fiscal trajectory, but there's more work to do there.
I'd like to switch topics, if we can, to something else that you've addressed this week, which is the proposed takeover of a Japanese steel company, Nippon Steel, and U.S. Steel. You have written in response to this that the purchase of an iconic American-owned company by a foreign entity, even one from a close ally, deserves serious scrutiny. Why does a U.S. ally as close as Japan deserve this scrutiny?
Well, I think it is long-standing position of the U.S. government and long-held view of President Biden that steel is a very vital sector for U.S. national security and for critical supply chain resilience. And we've seen that in past policies that have been undertaken by this president. So it is important to review or to make sure that there is serious scrutiny of these kinds of transactions from the perspective of national security and supply chain resilience, while we continue, of course, to welcome investment from abroad and have seen record foreign direct investment in the U.S. economy.
Dr. Brainerd, have you spoken to, has the administration spoken to the United Steelworkers on this issue? Have you got any feedback from them, and is that feedback influencing in any way your thinking?
Well, I will say that the steelworkers are a vital part of our steel strength here in the U.S. They are partners with industry, and they are at the center of President Biden's vision for growing the economy from the middle out and the bottom up. So it is important to continue to see strong, good union jobs continuing to sustain our steel industry, which is vital to U.S. manufacturing, vital to our supply chains, vital to our national security.
We really appreciate your time today. Have a very happy holiday. We end on a good note with that data. Lael Brainerd, Director of the National Economic Council. And of course, our thanks to Bloomberg's Kaylee Lyons.
All right, that was Bloomberg's Kaylee Lyons. Guy Johnson speaking with Lael Brainerd, Director of the U.S. National Economic Council and former member of the Federal Reserve, talking about some of the recent economic data and inflation data showing that the economy remains pretty solid. Inflation is moderating. Kind of all things that you like to see on the economic front there.
And stocks like to see it too. We are in the green across
Absolutely, we're
all
in the
the major
green.
indices.
Stocks up 1/4% on the S&P 500. Right now, let's go to, where are we going to go here? Let's go to Nathan Hager, get a business flash here.
No, like you said, Paul, the S&P 500 is up about 1/4%, up 13 points. Going right to the numbers here, the Dow Jones Industrial Average up 44 points, or 0.1%. The NASDAQ Composite is up 41 points. That's a gain of about 0.3%. So stocks are pointing to an 8th straight week of gains, their longest bull run in more than 5 years. That's after the Fed's preferred inflation gauge came in cooler than expected. But as we heard moments ago here on Bloomberg Radio and Television, National Economic Council Director Lael Brainerd says now is not yet the time to declare victory on inflation.
A year ago, the consensus projection was that getting inflation down would require a spike in unemployment and a recession. But in fact, the unemployment rate has remained below 4% for 22 months in a row. And of course, we're still seeing more data suggesting growth is resilient. But no, it is not time to rest. It is time to continue working.
And taking a look at treasuries right now, the 10-year is down 6/32 for a yield of 3.91%. The 2-year is little changed at 4.34. NYMEX crude is down 0.3% at $73.66 per barrel. COMEX gold is up 0.2%, pairing some of their gains now with gold at $2,064.60 per ounce. The euro, 1.1011 against the dollar, now little change. The British pound, 1.2716. The yen weaker against the dollar at 142.62. That's a Bloomberg Business Flash. Now here's Amy Morris with a look at world and national news. Amy.
All right, thank you, Nathan. President Biden is getting ready to send a trio of top officials to Mexico to discuss new ways to tackle illegal migration. We get more from Bloomberg Government White House reporter Courtney Rosen.
President Biden yesterday spoke with the Mexican president. We're seeing an increase in illegal crossings. In the next couple of weeks, we're expecting the president to continue to engage directly with the Mexican president on this issue while his legislative team negotiates with Capitol Hill.
Bloomberg Government's Courtney Rosen in Washington. President Biden also amending 2 executive orders that will, for the first time, allow the U.S. to impose so-called secondary sanctions over the Ukraine war. Senior U.S. officials tell Bloomberg that means banks could face severe financial penalties for doing business with firms already sanctioned for their links to Russia, whether they know it or not. While many international banks no longer do business directly with Russia, they can act as correspondent banks for financial institutions in third countries that still do. Thousands of people convicted of using and convicted of simple possession of marijuana will be pardoned. President Biden's latest round of clemencies will focus on those who were arrested for using or possessing marijuana on federal lands and in Washington, D.C. 11 people serving what the White House calls disproportionately long sentences for nonviolent drug offenses will be granted clemency. Good news for those of you anxiously awaiting a visit from Santa. The Department of Agriculture's Animal and Plant Health Inspection Service has issued a transit permit to allow Santa and his flying reindeer to enter and exit the United States through or over any U.S. border port, and port personnel will be on hand to clean and disinfect the runners on the sleigh and the underside of the sleigh when he enters the country. Mr. Claus has also been asked to disinfect his own boots and wash his hands to prevent the entry of any livestock diseases from other countries. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul and Simone.
All right, Amy Morris, thank you so much. We appreciate it. All right, Simone, bankers in the U.S. debt capital markets are optimistic that a pickup in mergers and acquisitions next year, along with lower borrowing costs, will induce more lucrative blue-chip bond sales. Deal-making has suffered the worst year for transactions in a decade as private equity sat sidelined and geopolitical tensions intensified. But deals such as Bristol-Myers Squibb's purchase of neuroscience drug developer Karuna Therapeutics and Occidental Petroleum's acquisition of Crown Rock are giving investment-grade syndicate desks confidence that next year could see a return to buyout funding that once dominated their calendars.
So the expectation from Morgan Stanley is that an 8% year-on-year increase in gross sales. So that would get us to $1.35 trillion worth of debt sales. And this outlook roughly copied by the rest of the street. Citigroup, Bank of America come in with their numbers somewhere between 1.2, 1.35 trillion. I guess Morgan Stanley's a little bit at the top of this. But you know what I wonder? We've seen all these big deals announced. There's $250 billion of announced M&A in the pipeline.
Yep.
But isn't this all contingent on getting approvals from regulators? I mean, one of the
Good
biggest
point.
ones
Yep,
is
good point.
Broadcom VMware. I mean, we're still waiting on some approvals for that. We've seen various pharma, maybe potential to go through, but we've looked at airline M&A that has just gotten stalled in mid-motion. Isn't that a bigger risk to the overall sector?
Yeah, I think you're right. And Jennifer Rhee, who does antitrust research for Bloomberg Intelligence, has been calling this out, that under the Biden administration, it's a lot tougher to get deals approved. Assuming they do get approved, borrowing costs for high-grade issuers have fallen dramatically over the past 6 weeks. The average spread for investment-grade bonds has dropped to 102 basis points from 130 basis points on October 30th. That's according to data compiled by Bloomberg. At the same time, the average yield dipped to 5.13% from 6.35% at the end of October. So if you do get stuff approved and you do need some debt to close it, i.e. it's not an all-stock deal, it's a little bit cheaper today than it was a few months ago.
Yeah, but again, there are bond dangers lurking in 2024. That's the headline from our MLive Markets Live blog team. Everyone's betting on all these cuts, 3 interest rate cuts by the Fed next year. But, what happens if not?
Yeah, we'll have to see. I mean, clearly the S&P, the Dow, the NASDAQ, which are all up about 0.3% today, they're betting on some rate relief going forward. Again, this will finish out the week, make it the eighth week in a row of gains in the S&P 500. Not too shabby. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Stuart Paul, U.S. economist with Bloomberg Economics, and break down some of the economic and inflation data we got today. Stuart might be, I'm going to guess, on the slopes of Windham Mountain if I had to guess. Eric Lynch, Managing Director at Sharp Investments. Sharp Investments can join and talk about these markets going forward. And then in our C-suite conversation today, Peter Platzer, CEO and founder of Spire Global, joins to discuss his company and, quote, space as a service. I got to hear this one. All right, but first, let's start things off with our good friend, Charlie Pellet.
Hi, thank you very much, Paul Sweeney. And here's what's going on. The Dow, the S&P, NASDAQ, they are all moving lower, higher. As you mentioned, we're on track for an 8th week of gains on the S&P 500 index. So right now, the S&P is up 14, gain there of 0.3%. We've got the Dow up 47, up by about 0.1%. NASDAQ up 48, now higher by 0.3%. The NASDAQ 100 index up 40 points, up 0.2%. And once again on this Friday, the Russell 2000, the outperformer. Right now, that index of small cap shares up by 1%. 10-year 3.90% with a 2-year 4.34%. Spot gold up $7 the ounce to $2,053, up by about 0.4%. And West Texas Intermediate crude 73.89 a barrel on WTI. Nike shares are plunging after earnings, down now by 11%. Nike saying it will slash jobs in response to weaker sales. Robert Schein is managing director and partner at Blank Schein Wealth Management. He was a guest this morning on Bloomberg Markets, and he was asked about the Nike numbers and what it suggests about the broader consumer outlook.
It's definitely could be the canary in the coal mine. Because you have to pay attention to a global leader like Nike on the retail side. They're on the forefront, right? They have their pulse on the consumer. And we know that the U.S. economy is 2/3 is the U.S. consumer. So the question is this an indication that the Fed, right, has really dug into the consumer's pocketbook in terms of, just everything costing more? Let's say if inflation now takes everything down, let's say your sneakers, if you will, come down, they're still putting that on a credit card. So that's 21% interest rate, and that's catching up to the consumer. So that could be a concern going into next year.
And you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcasts. Not just Nike, which, as I mentioned, down now by 11%, but footwear retailers, Foot Locker FL on the ticker there, down 5.2%. Dick's Sporting Goods tumbling by 3.1%. Other retailers include Lululemon Athletica. It is down now by 0.9%. Again, recapping, stocks higher, on track for an 8th week of gains. S&P up 14 right now, up 0.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you very much. We appreciate that. Simone Foxman and Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We're streaming live on on YouTube. So head over to youtube.com and search Bloomberg Radio. As Charlie was just reporting, a little bit of a lift to the market here. The S&P 500 up about 0.3%. But again, we're calling out the Russell. That's up 1%. That broadening out of the breadth of the market that we've been seeing over the last 7-8 weeks, which is generally a positive sign for market sentiment. Let's see what's happening under the hood here on these equity markets. We do that with Elena Popina. She covers all the equity markets for Bloomberg News. Elena, what are you looking at?
Hi, guys. So I'm looking at Karuna Therapeutics. Is actually up 48% ticker on the Bloomberg KRTX after Bristol Myers agreed to acquire the schizophrenia drug developer for $330 a share. So mind you, that is a big premium to its closing price on Thursday,
Wow.
but a premium of about 50%. So that, that's a big, level of trust in Karuna Therapeutics as a drug developer. Whether or not that's justified is an open question. We are seeing a wave of downgrades of Karuna Therapeutics. At least 4 companies downgraded the outlook from overweight to neutral earlier today after the news.
Oh, yeah, explain that for us. Because we have, here this huge pop, and now just people think it's overbought?
Yeah, essentially. So, people are thinking that that 53% premium to that closing price on Thursday is not justified. The average premium is about 20 to 35%. 50% is a big stretch. That's basically because the rush for the mental health drugs, the schizophrenia drugs, is really high right now. And we are also seeing a number of other deals in that biopharma market. So the market is getting elevated, getting really hot. AbbVie just a couple of weeks ago announced a takeover of Cerevel's Therapeutics. That was an $8.7 billion deal. So that market is getting very hot right now into the year, and whether that 53% premium is justified, I don't think so. And looks like.
But it's an announced deal.
It's an announced
Okay,
deal.
so
Right.
Bristol Myers Squibb is buying this thing.
Right.
So the stock's up. If I'm an analyst that had a buy on it, I'm like, done. My buy rating worked. I'm going to go put a hold on it. You don't buy it from here because it's only now an arbitrage play.
Right.
Between here and
there is that, and it's also a faction, a matter of the stock price advance today.
Yep.
I'm
I'm taking my profits. I'm done. My work is done here. I recommended you buy the stock. You bought the stock.
Shares up 47%.
47%,
Exactly.
yeah, 50%.
Perfect.
That's quite a problem.
Take my victory and go home. All right, what else we got?
Yeah, I'm also continue to be looking at Chinese online gaming industry. Early in the morning, most of the stocks were down today. Some of them are still down, but what Evercore just said is that that decree to curb the online gaming industry could just be the last one this year before the authorities set the tone next year and kind of reverse their bearish sentiment on the industry.
You know what? I'm not buying that at all. Every time we think we've seen the last of China cracking down on some of their industry, they come back again on another industry. Again, it's tough, man. It's tough to have any kind of positive view on investing in China, I would think, given what they did to the tech industry, which was, you could look back and say, those tech companies like Alibaba and Tencent, they were just, if I were China, I'd be like, see how great we are? We see how technologically
they were on a
advanced
roll.
We're ripping it, and the world is rewarding us. Then you say,
do you remember a fraction of a day when Alibaba had a larger market cap than Amazon.com?
Yep. So it's it's just tough to do business over there. Yep. And now they're coming after the video game business. So again, it's what they call in the business when you go to the risk section for these S1s for these IPOs. China risk.
And when you look at the MSCI China index this year, if that's the way you've been exposed to China, you're down over 17%.
Yeah.
Reflecting perhaps that risk.
Absolutely. And plus, the economy, the reopening of the Chinese economy wasn't as robust as I think people thought January of last year, a year ago. Now people were probably writing their 2023 outlook saying, hey, China reopening is going to benefit X, Y, and Z industries.
Right, but at least so far this morning, this early afternoon, some of the online gaming stocks in China are pairing their losses. NetEase was down 22%. It's down now 15%, still a lot, but looks like traders need some optimism to hold on to.
Before the holiday weekend.
No, I've had enough of China. I learned my lesson. So, all right, very good. Elena Popina, thanks very much for joining us. Lots of economic data today. Personal income, PCE deflator on the inflation front, durable goods, UMISH, coming in a little bit better than expected. They don't just have a good football team, they have good economists over there at the University of Michigan. So some pretty solid data coming across. Let's check in with Stuart Paul.
Another good economist.
Another good economist, Bloomberg Economics. Now, he usually joins us in studio, but he's joining us via Zoom here today. So I'm going to go out on a limb and say he might be at Windham Mountain. Now, he's got this cheesy background on his Zoom, which I'm not buying whatsoever, because I think if we really had the real background, it would be like the slopes of Windham Mountain. Stuart, I got to ask you, where are you, dude?
I'm in Windham.
There
we got a nice light dusting of snow, and as soon as I hang up with you guys, I'm going out for a hike. All the data is out. The data was a gift to Jay Powell. I'm taking it personally as a gift for the holidays, and after this, I'm done.
And just full disclosure on behalf of Stuart, he is an all-mountain ski patroller at Windham Mountain Resort. He's been doing that for many years, so that's good stuff there. So, Stuart, what did you take away from, again, a lot of this data this morning? It seems, I guess, give a little bit more leeway for the Fed to be a little dovish here, maybe.
It does. But the real question that we need to be thinking about in the background is just why does the data look as good as it does? So we saw headline PCE inflation actually deflation during the month of November because energy prices globally declined. So we got 10 basis points of deflation for the headline. Core PCE inflation slowed to just 10 basis points, allowing the 6-month annualized pace of core inflation to decline to 1.9%. So if the Fed is thinking about what trend core inflation looks like, they're thinking, oh, wow, it's actually at our target. But in the background, we have a lot of core goods deflation during the month. And if you think, as we do, that destocking of inventories will allow firms, particularly goods producers and retailers, to avoid price cuts in the future, then that drag that we're getting from core goods would be set to reverse, at which point we would have about 3% annualized core inflation. So if that inventory destocking takes place, it's not really the case that the Fed can declare mission accomplished on inflation quite yet.
So then if we see that, does that threaten the 3 cuts next year outlook that we heard from the Fed, or does it simply threaten the potential timeline?
As far as I'm concerned, it does not threaten the Fed's forecast of three cuts. What it does threaten is the market pricing that's showing, nearly double that. So that's what's going on the inflation front. If the fundamentals that we think are going on in the background, in addition to inflation, if we think that the labor market, for example, starts loosening more materially, which we expect, but let's face it, others out there don't. If that starts taking place, then we expect the Fed's going to revise its inflation forecast to show actually more cuts than it currently is showing, even if it means that inflation has yet to fully reach the target. It's just the case that the last mile of disinflation is difficult.
So my personal Paul Sweeney daily inflation gauge is gasoline, $3.12 a gallon. That's down just big time, just over the past few months here. So talk to us about, you mentioned before, the impact on energy, and you got to adjust for that, don't you? And I guess when you do, maybe you're a little bit less sanguine about inflation abating?
Yeah, so declining energy prices does allow for declining headline inflation. More importantly, probably for the Fed, is that declining energy prices matters a lot for consumers and their inflation expectations, and inflation expectations matter a lot for consumer behavior. So, for example, if folks think that prices are going to be much higher in the future, they go out and rush and buy goods and services today, and that actually begets inflation in the future. Seeing declining gasoline prices helps consumers to slow their roll a little bit, and it does allow for softening consumer inflation expectations, which we saw in UMich today, particularly in year-ahead inflation expectations, and it does allow them to sort of slow the pace of their spending, which we've seen. There has been a little bit of a shift from consumer spending on goods for which they have inelastic demand to nerd out a little bit, but it allowed them to get a little bit of savings on gasoline. That was directed actually a little bit more to holiday shopping, we saw in the PCE report. But we don't think that that really has legs. If you look at credit card data through December, rather than just the November PCE report, sales are a little bit more tepid. Consumers are taking that gasoline savings and just kind of sitting on it a little bit in December. So we're not fully out of the woods in terms of an economic slowdown quite yet.
This has been a political, I guess, issue that's come up. Biden very unhappy, according to reports, that people aren't feeling the impact of his economic policies. People seemingly trusting the Republicans more on the economy than the current Democratic administration. Now, I'm not going to ask you to weigh in on politics, but what kind of indicators do you need to see to think, hey, well, consumers actually think that the economy is good now? How far are we from that point?
So, at least in terms of election outcomes, and I'm not speaking as a political analyst, but strictly as a statistician and as an economist, it really matters where the economy is 3 to 6 months before the election. There's still a lot of the game to be played before then. There's still a lot of data that we're going to see before then. And if we start getting rate cuts in Q1, that could help to avoid the worst case economic scenarios. And that could be helpful for the administration in the 2024 election cycle. But again, it depends why we're getting those rate cuts potentially in Q1. If we're getting those rate cuts because we see the unemployment rate inching up, not just inching up, but gapping up, which tends to be the case once Sam's rule is triggered. If we see the unemployment rate gapping up and that's why we get those rate cuts, it probably would not be enough to offset any sort of alleviation of interest rate pressures and financing costs that consumers might find helpful. That softening of the labor market would be more influential in determining election outcomes than, say, the change in interest rates.
So, Stuart, bottom line, Bloomberg Economics, what is your GDP call for 2024?
Well, so for Q4 specifically, we have an estimate of 1.1% Q over Q annualized. Again, that's better than we would have been anticipating. As we do more of the bottoms up work and as we get more of the data, things are looking a bit better than we would have expected, especially a year ago. But we're not quite out of the woods yet. We are still expecting a bit of a slowdown, we think that that's the reason why the Fed is going to have to start cutting rates in 2024.
What's the black swan for you looking ahead to next year?
Look, I think that there's still a lot of risk around commercial real estate. I don't know if that's totally a black swan because, it is what a lot of folks are keeping their eye on. But in terms of what could be a major shock to the system, I think that that's probably it. The ability of banks to work with their borrowers so that they don't have to take back keys. The ability for banks to work with their regulators, perhaps to allow those banks to lend to borrowers at below market rates that those borrowers could then cash flow any sort of debt obligations that they have, which regulators frankly don't love. They don't love when banks are lending at below market rates. Those are the sort of financial conditions issues that are a bit orthogonal to most of the economic data that we think about day to day, and so it could catch some folks by surprise just because it's sort of retreated to the back of everybody's minds.
All right, Stuart, thanks so much for joining us. Really appreciate it. I know it's been a busy morning for you with all the economic data hitting the tape here. Stuart Paul, he's a U.S. economist for Bloomberg Economics. Go hit the mountain and enjoy the day. S&P 500, we're up about 0.25%. The Dow's pretty much unchanged, and the Nasdaq's up 0.25% as well. The Russell is seeing some outperformance here, up about 0.9%, 2036 on your Russell 2000 index. 10-year Treasury, 3.91%. We'll have more coming up. This is Bloomberg. Let's get some company news now with Lisa Mateo.
You got it, Paul. More than 100 container ships are said to be taking the long route around Africa to avoid the violence in the Red Sea. Increased attacks have companies like Mandarin Shipping expecting shipping rates to rise. Here's Chairman and CEO Tim Huxley.
it is very significant, and it will lead, if this goes on for a long time, because you've now got, certainly in the container sector, 70% of the world's container lines have said we're not going in there, and they're going to reroute around the Cape. So that will have a significant impact on trade.
Now to earnings now, where Nike shares are lower. They're down nearly 11% after it warned of weakening sales and said it expected as much as $2 billion in cost savings by simplifying its product lineup and slashing jobs. Bloomberg's Tim Lowe has more.
That's going to hit like employees, mid-level managers, et cetera. A lot of costs being flagged for, letting some workers go. They're trying to take some of that savings. They're investing it into a lot of automation, speed up product pipelines and innovation.
All right, so now we have the trickle-down effect to other sportswear giants. I'll hit a couple of them. We have Adidas. They're down about 5.5%. Foot Locker is down about 4.5%. Well, a few recalls to tell you about this afternoon. Tesla pulling back more than 120,000 2001 through 2023 Model S and Model X cars, and that's due to cabin doors that can be unlocked during a crash. And we also have Ford recalling nearly 190,000 U.S. vehicles due to a faulty turn signal. Now, it's for certain 2022 through 2024 Maverick pickup trucks. Those are the company stories we're following. I'm Lisa Mateo. This is...